Good morning, ladies and gentlemen, and welcome. Welcome to day 2 of Emergence. Today we have an absolute jam-packed lineup. Who enjoyed day 1 out of curiosity? Fantastic. So yesterday was, we had 2 panel sessions focused around venture capital and digital assets. Today, the panel sessions are focused around Australia's favourite theme at the moment, private credit. We've got Greg Paramor, who's the absolute industry legend for property, speaking on what's happening in the Australian property market at the moment. We've got an incredible private equity panel session as well. And then we've basically got the final panel session for today, which is the family office investment trends. Now, this one's super interesting because there's been a lot of changes take place in how family offices invest at the moment. And, that's going to be covered all different diverse angles, from digital assets to international markets to private equity, and also active investment as well, and what that looks like. So very much, a multi-stage theme for today. So basically, to give you a bit of and then the other part is we've got a keynote from Charles Chong from TNB Aura on what's happening in the ASEAN Venture Capital ecosystem. I've known TNB for a long time, and they're one of the most respected, Asian VC firms. So it's an incredible opportunity to listen to him talk and also to chat with them directly. I said they're one of the leaders sort of in this space. So a couple of things. I'll go through my notes to sort of start with. I won't go through that because I went through it yesterday. As mentioned, we're going to be covering a range of different. One of the things I promised I was going to be talking about AI. To me, I think AI is one of the biggest game changers from what's happening in the markets right now and the potential that it can actually create for businesses. So I want to talk about that this morning, and I've got a bit of a shortened time, so I'm going to be super fast with it. All these things up here absolutely changed the way business is done. I found it really, listening to the venture capital panel session yesterday, they didn't really touch on it as much as sort of what, I'd probably sort of ask them to if us to do it again. Here's a simple reality. I think enterprise AI changes everything. When you've got the memory of an organization sitting inside the file structure, so whether you're using Google, Google Workspace, or you're using Microsoft, etc., the fact that you can query the entire company, or every person can do it, what's made available to the entire company, makes everything so much easier. The solutions like Google's Workspace has absolutely blown me away. It's blowing me away in that how much more efficient it is making me. And I've been one of the biggest advocates of AI. And do you know why? Because 2 years ago, this emergence 2 years ago, I genuinely feel like if with ChatGPT, we transformed our entire business, right? And more than that, I think AI has personal benefits as well. The 3 layers of benefits you're going to get from overlaying AI across your entire business and your entire personal life is number 1, productivity and efficiency. That's the obvious one. The second one is your cognitive capacity. Every single one of us get decision-making fatigue. If you're a business builder, business owner, etc., we have to make thousands of decisions every single day with our businesses, and it's very easy to get decision-making fatigue, with that. And even when it comes to an email, you can make 30 minor decisions on an email. So that makes a massive difference. But there's a third layer that very few people talk about, and that is the increased capacity amongst a team because they don't need to lean on each other for different things. Previously, tasks would have to go across 3 or 4 people can now be done by 1. And that makes so much difference and means why we're about to see a difference when it comes to the potential of what small teams can do. AI agents and deep research, now they've all come out with it. They've made it available to all of us. When I did my meetup series, the deep research wasn't available to Australians. Now it is. It is unbelievable. Who's used deep research so far? Only a few of you. Do yourself a favor, go onto ChatGPT, go onto Google's Gemini, or go onto Grok's, and just go and basically utilize the deep research function for any topic that you're actually interested in. Watch that thing work away for over 10 minutes and go and scour 100 to 150 websites and come back to you with a detailed summary on whatever topic you want it to go down. There's people talking about online where they're saying that some of the information it's coming back with, they've previously paid $150,000 to $200,000 to consultants to do. And it took them months to come back with. That is now being done in seconds. And when you can access real-time information, real-time trends, etc., it becomes a game changer for what all we can do as individuals. AI avatar, I think, is one of the greatest opportunities for companies scaling, high performers inside companies. Every founder's always said, oh, I wish there was 5 of me. Well, guess what? Now you can have that. And that's the exciting part about sort of AI avatars, whether it be across the sales function, customer success function, whatever it may be. So the avatars change a lot. The big trend I'm watching is AI development tools. It is getting so close now. The more you see that people are able to build off natural language prompts, it means that everyone can become builders of applications, builder of products going forward. And what becomes interesting about that is that there's going to be an explosion of new companies, an explosion of new tools, and also you see the trend now, there's a deeper vertical integration the way people are thinking about AI. So when AI got released, all the hype was on the LLMs, right? 12 months later, there was a whole bunch of different products that people were building on top of the LLMs, and they were called wrappers, right? ChatGPT, and they were being laughed at. They're saying, oh no, ChatGPT is going to destroy the value of these companies. Now, that seems to be where the money is flowing because people can get very specific on vertical. Like for us, for example, we want to get very specific with AI across private capital markets and also with capital raising, right? That's our vertical. We want to use it across. And there's so many different things that you can do now with that. So that's interesting. This one excites the hell out of me. Everyone knows I'm a big Tesla bull, right? If you speak to me for 5 minutes, you'll figure that out. But Tesla and Waymo, like Waymo is an interesting one. Even though it's done on LiDAR and everything has to be pre-mapped and pre-done and all that sort of stuff, in San Francisco, they've now already, about a month ago, they highlighted that they've matched the traffic, which has been done through in comparison to their competitor Lyft, they were actually equaling the amount of the rides that they were doing. And that's just within a year of operation, right? So that's Waymo already. Tesla is coming out with their version. If anyone's seen the videos, has anyone seen the videos of their full self-driving online? Has anyone seen those videos? Some other Tesla bulls in the room? Unbelievable. You know, and they just released something out of China yesterday where they got approvals to actually do full self-driving in China. But there's people literally uploading videos of their car driving for 30 minutes to 3 hours and them not touching the wheel, right? And basically, because of the way in which they actually designed it, it's based off cameras, so it's based off computer vision, and also off just neural networks of how they expect a good driver to drive. Robo-taxis is coming faster than what people think, and that changes the future of mobility. When you go out today, you go have a look. Have you ever noticed, for the Tesla bulls would know, I love going to traffic lights, I love walking past traffic lights and roundabouts because you always see a Tesla, right? Imagine what that looks like when robo-taxis come out and they don't need a driver. It changes everything. It changes deliveries, it changes taxis, etc. And now they're coming up with basically a little charging station can just basically sit under the car, and they've got their Optimus to actually clean the car, right? So this area of what they're doing, I think, is one of the most exciting things that we're seeing, and the combination of that with robotics. The question I have is, I've got a nephew who's 13, I've got a son who's 3, and I've got another nephew who's 10. I continuously ask myself, what jobs will there be for them in 5 years' time, right? Because AI agents change so much because of the ability to execute a task from end to end. So if tasks can be executed from end to end, then, you know, effectively white-collar jobs or, you know, knowledge-based jobs will be transformed over these next 5 years, and it happens faster than what people think. The only reason why it's not happening faster in corporates is because they have the typical corporate immune system amongst the middle management layers, right? But the reality is, inside startups, you don't have that issue. So it really asks that question. I think new business models are going to be created. Last year, we had a company called Rolo Robotics, which is a robotic kitchen, you know, coming out of Singapore. And, you know, to me, I look at that and I said, I can imagine someone buying that franchise and having their own robotic kitchen go out to different fairs or different public places and so forth, because it can deliver everything perfect, on time, exactly the way that the initial chef wanted it to be made, right? But that is the potential that's coming down the pipeline. Likewise, for us as investors, if there is such a thing as, and people always say, oh, it's not going to get approval in Australia. Tesla can just hand over the data to say, here is why our car is much safer, you know, under full self-driving than under a human. They have billions of kilometers worth of data to prove that. So then if they do that, that changes everything, because imagine if we as investors could just go and buy 5 taxis and let it go and work for the day, 5 cyber taxis. Right, so I really think there's going to be a whole bunch of new business models created. The tools and I've got 5 minutes left. These are the tools I use every day. Take a screenshot. I'm not going to be able to go through all of them. Google AI Studio is unbelievably impressive. Their screen share feature is incredible. And, you know, for medical stuff, you got to turn off the safety settings, just a hint. For medical things, if you've got any medical diagnosis, if you've got family members going through some serious illnesses, just go and put those scans in there and watch what comes back. It is incredible. You will know more about what's happening with that person before they even see their doctor, right? So that's all the different tools I use, and Notebook LM is another favorite. The other ones you would all probably know. So this is the real thing that goes through my head. Sam Altman made the comment that he expects that he's got a friend's betting pool when the time in which a company will have one person and become a unicorn. And when you see what I showed beforehand across enterprise AI, AI agents, AI development tools, etc., you can see how that's going to potentially happen. This is going to continue. Redundancies will continue. Middle management will continue to be laid off. Just go and have a look at all the announcements. Take screenshots. Go and have a look at all the announcements. These are the areas that are actually being taken out at the moment. Companies are going to look for outsourced team members and going to train them with AI, because it's a lot more efficient than hiring in Australia, because hiring and then sort of the replace is very difficult sort of in Australia. And then the last one is the death of the salesperson, right? So that's on the negative side. Second one, I think that reshaping of the VC model, because VCs won't need as much money as what they used to for scaling companies. Obviously, there'll still be some bigger VCs in some bigger tech things. There'll be explosions of new startups, consultants, and advisors because people can do a lot more by themselves. Reduced need for large rounds, as mentioned, and incredibly profitable companies. There is one other benefit. I think the industry which will benefit, one of the industries will benefit the most, and I mentioned this on LinkedIn yesterday, will be entertainment, sports, and leisure, because fundamentally, people that go all in with AI will have more time. They'll have more time to spend with family, they'll have more time to spend with friends, so the area of entertainment, I think, then becomes an opportunity going forward. So I won't mention about AI in life science just because I'm out of time. Other trends, these are some of the other trends that I'm observing. We're going to be talking about this today. I think fractional executives is a big one, and we want to empower that going forward. The rise in active family offices, you see it today. We've got lots of different family offices that are participating today that sit on both sides. They're investing in staff, they're raising money for staff, they're actively building their own businesses because they make money and then they obviously want to still continue building businesses. I'll move through that one. So now onto the formal part of today. Make sure you take photos, make sure you share. There's plenty of seats up front, by the way. There's plenty of seats sort of around in the front, so feel free to come and sit down. Make sure you take photos, tag hashtag Emergence 2025. Now I'm going to do my part to say a big thank you to, I know I went through them in detail yesterday and I'm sort of running out of time, so I won't be able to today, but I just want to say a big thank you to all the sponsors. We are super lucky that we have incredible sponsors that can add value to your lives in different ways, whether it be wanting to get access to crypto assets or trade at a high level. If you're a family office or a professional investor and want to get access to crypto, then we were talking about MHC yesterday. If you're an active trader or if you want to trade through your SMSF, go have a chat with OKX. If you're also an active trader, companies like Bybit, etc., InvestHK, Flanders, who I just saw come, for anyone looking to use Europe, looking to go into Europe and use Flanders as a base, have a chat to the charming Italian man just there, Luca. Startup nerds helping startups in their business, ReachLX, everyone. Just big thank you to all you guys. These events don't happen without sponsors, and also, as I said, they can absolutely contribute to you, your life, your business in some way, shape or form, so take the time to go and chat with them. So, keynote speakers, Vignesh and Charles, as I said, I can't say any more about them. Said the fact you get the opportunity to understand directly what's happening in that ASEAN ecosystem, this is one of the biggest, fastest growing marketplaces to tap access into. These guys see absolutely everything. I'm so fortunate they've got the helicopter view of what's happening in that entire region. So to have them as keynotes for today is something special. Matt Barrie, everyone here probably knows Matt Barrie. Once again, incredible guy to have come to the event to talk about, what he sees happening in this actual landscape. Evan Thornley, as mentioned yesterday. And then one of my favorites to invite to the event, an absolute property industry legend in Greg Paramor, said for the guy that sort of has built several businesses, and obviously, Folkestone was his most recent one where he built it up and then sold it off to Charter Hall. It's like he is across every single aspect of the Australian property industry. So for the family offices and ultra high net worths in the room, I'm sure you all know Greg because he is that sort of profile in this space. So incredible presentations right throughout today. Now, one thing I just will mention, these are going to be the 3 different panel sessions. They're all in the schedule that I emailed through to everyone this morning. We've got some incredible companies that are going to be featuring today. I'm going to do my best to go through them. So CleverCow, supporting the sort of carbon trading, make it easier for individuals to get access to the carbon trading. Pallas Capital, I'm sure most of you know Pallas Capital by now. They've become one of the absolute leaders in sort of commercial property and industrial property lending. They've been a big fan they've been a big favourite sort of amongst our investor subscribers. Incredible team. You've just announced some big deals with Goldman's, taking up sort of $500 million of some of their facilities, and then another one last week as well. So make sure you come and have a listen to them. And then also Rapid Response Revival, one of my favourites. So I keep mentioning as Rapid Response Revival. On their banner, it's Call AED. The way I like to talk about rapid response is that, remember the story about Kerry Packer when he almost died and then he went into the ambulance and it was just lucky that it had a defibrillator machine? They provide an at-home defibrillator that everyone can use in their own home. They're an Australian company, absolutely saving lives, with what they do, and that's why, heart is basically the #1 killer amongst people, and so the at-home defibrillator is almost a must-have for anyone with heart issues. So make sure you have a chat to those guys. Salter Brothers, one of the most well-renowned sort of investment groups in Australia. Super happy to have them as part of the event. Harness Projects, with connecting students with industry projects for real learning experiences. Got some really high-quality clients. Great team behind it. Incredible business. Medigrowth, using plant-based medicine through research, trials, and obviously sort of patient education, an area that's sort of passionate to me as far as how you can use sort of natural, but doing it in the proper way. We're actually going through trials, etc. Venturely, as I mentioned yesterday, private equity focused on the marine industry, a lot to learn from how they're approaching it. Saiiv Monitoring, which is helping with chronic disease care with wearable monitoring devices. This is actually the biggest trend that I'm seeing at the moment. Clinical grade at-home devices, that people can use for themselves or use as sort of diagnostics or, basically understand what's going for themselves. This is probably one of the biggest trends I'm seeing in it. Creek Partners, which is focused on investing in the Indian venture capital scene. If you haven't been inspired by the India 2030 vision, make sure you take your time to actually have a research of that. As far as leadership, setting out a plan and then executing it, India's done an incredible job, and we're looking forward to making some announcements with that shortly as well. Scriptsee enhances film production with automated data-driven script analysis tools. The guys behind this stuff, the team, I'm probably going to say this slightly wrong, the team behind Scriptsee were part of the team that actually did a lot of the animations for like Marvel and so forth. So the guys behind this used to lead a team of 80 to 90 people creating some of the most famous TV production that your kids would have loved at some stage. Tessara Therapeutics, incredible company focused around accelerating neurology breakthroughs with safer, more effective drug development. So they've actually got almost like a replica of what drugs look like when they go into the brain. Strong backing, raised some really good money and got some great capital in, but massively important area for neurology. ChatESG, which is a platform for enhancing ESG strategies for companies. Neopharma Technologies, which is doing AI-driven rapid diagnostics with cutting-edge medical technology. Cannaponics, which is sustainable cannabis farming. I'm definitely over time. V-TOL Aerospace, developing AI-powered aerial robotics for infrastructure maintenance and surveys. Very, very cool company. And then agribusiness, mentioned yesterday. Ready short-term rental funding. As mentioned, a great example of a family office is now building their next business, making it easy for Australian investors to get access to high yields in the sort of short-term property rental market. synergenMet, a great sort of sustainability-focused company developing clean tech innovations in basically around the sort of chemical area. Innofocus, an advanced manufacturing company with cutting-edge photonic technology applications. Nano manufacturing, so really going quite deeper. And once again, some very high-profile clients in what they do. CosmoInnovations, revolutionizing daily personal skincare. I said, as someone who's got a Korean wife, I can really appreciate their innovation and their desire for people's use. And then also innovyz, who's been one of the most incredible companies in Australia at taking deep tech research and turning it into actual commercial products. They've listed 4 companies on the Australian Stock Exchange and built several 9-figure business with what they do. They are the best at it in the country, hands down. So make sure you chat to Stuart and Brett. And then Directo, incredible company. Basically what the business Gavin's built is basically helping streamline pharmacy purchasing with B2C-like transparency, efficiency, and supply connections. I think they deal with about 60% or something like that of the top sort of pharmacies or healthcare outlets in Australia. So incredible business. So that's the lineup for today. I hope I haven't missed everyone. I do my best to give everyone their shout out. I've curated all these sort of opportunities myself to bring them to you. So key things for today, each company gets 8-minute presentation, right? So after the keynote, each company gets an 8-minute presentation. And we've also got a fantastic entertainment project as well, which we're going to have Elliot come and talk about, where they've done licensing deals with a large entertainment provider. He's going to speak for 5 minutes, but every other company is 8-minute presentation. And at 1 minute to go, we're going to ring the bell. At 2 minutes, we're going to ring the bell twice just to let them know that their time's up. We want to do the best to make sure we keep today as on time as possible. So when we ring the bell outside, please come inside. So we want to make sure everyone gets the opportunity to have a great presentation. So on that note, enjoy Emergence Day 2.
Thank you, Steve. Good morning, everyone. It's good to see familiar faces today again. Our first presentation will be Expression Capital Partners. It's an independent private equity firm based in London, specializing in rapidly growing entertainment sector. Please welcome founding partner Elliot Hall.
Hello everyone, Elliot Hall from Expression Capital Partners, as I just mentioned. I specialise in the entertainment industry and I'm here today to speak about two of our main partners. So not everybody will have heard of Hasbro, but for sure everybody and their children and everybody within their family will have had some sort of interaction with Hasbro products over the years, whether that be toys, games, movies and many different things. Hasbro have been testing the water over the last 10 years to start to use those products in live, real-life experience entertainment businesses. And it's actually less than 1% of those businesses where they're bringing them to life in real venues. As you can see, they've already been doing quite well on their numbers, and Expression Capital Partners has been really in a lucky place at the moment that we are their global partner to exploit all of these types of businesses and bring them to life. Surprisingly, not everybody wants to sit at home playing on video games and 2 screens at the same time, watching TV and so on. And there's been lots of surveys done where good numbers of people say they'd actually prefer these days to go out and experience real life games, but built into a venue rather than just on a TV screen. And this was largely driven through COVID, where people were enjoying the games and socializing with people rather than just on screens. At Expression Capital Partners, we're going to leverage all of the heritage brands of Hasbro, and we're going to pick all of the largest ones. In total, they have 1.2 billion social media followers, So many of the brands that there are. And in total, there's 1,500 brands which we can leverage and turn lots of them into real-life experiences, including themed holiday resorts, themed cruise ships, themed water parks and theme parks. The main thing which is really a booming business in the world today is social competitive gaming centres. So there are literally hundreds of those brands which we can turn into real-life experiences. I don't know if people have been to London recently, but there's quite a few popping up that we're working with. Then another really good opportunity that we have, and we've got quite a few sites on the go, is Monopoly hotels and Monopoly casinos. And in total, we have over 1,000 new site opportunities around the world already in the pipeline, and that's growing on a weekly basis. Then the next part that I'm here to speak about today is over 100 years old, as Hasbro is also over 100 years old, is the International Association of Amusement Parks and Attractions, or IAPA for short. They have 7,000 members around the world in over 100 countries, and those members range from a small startup business right through to Universal, Warner Brothers, Village Roadshows, Disney, Looping Group, and Merlin Entertainments. The entertainment industry has been around forever, and it will be around forever. When times are good, people are affluent, money in their pocket, they'll always want to go out and enjoy themselves. When times are not so good, you still want to go out and let your hair down. We have a great team that spans across many different entertainment sectors, including finance, design, operations, build, and so on. So the important thing here is the partnership between Expression and Hasbro, but then also between Expression and IAPA. because we have over 1,000 opportunities around with Hasbro, but also with IAPA. From all of their members, they have inundated with inquiries every year where people are either looking for investment for the industry, want to invest into the industry, they want to buy, sell, or merge a business in the industry. And Expression Capital Partners is going to have a section on the IAPA website, and all of their members will be directed to Expression for any of those things. So buying, selling, merging, investing in, or searching for investment. So Expression Capital Partners, we created a fund, Entertainment Investments 1LP. It's a £1 billion fund. Minimum investment is £10 million, unless it's through a nominee company where as many investors want to chip in towards £10 million as they like. So £10 million minimum investment. Expression Capital Partners, 2 great partnerships with IAPA and Hasbro that have been around for over 100 years. Thank you very much, and I'll be around until 7 p.m. if anybody has any questions. Thank you.
Thank you, Elliot. I was so excited to actually introduce Elliot. I forgot to introduce myself. My name is Bella. I'm going to be your MC today. And next up, we have an insightful keynote from Charles Chong, the co-founder of TNB Aura, a venture capital firm focused on empowering visionary and entrepreneurs in Southeast Asia. Let's welcome Charles to the stage.
Hi, morning everyone. Before I start, let me see if this works. Okay, so very pretty image. Thank you for all enjoying this.
Do you believe in the right moment? What if I told you there is a place in that moment? A place where what if becomes what is. Where tradition and innovation seamlessly work together. Where technology can create entire markets. Southeast Asia is in the advent of a breakthrough. A new wave that is set to change the world as we know it. But how exactly do we amplify this wave? Well, it starts by looking inwards and finding visionaries, innovators who dare to make a difference. And who are these market creators? And what do they hope to see for the future?
Tôi thấy một tương lai nơi mọi lao động phổ thông đều được tiếp cận với những giải pháp tài chính số nhân văn. Di mana semua individu, dimanapun lokasinya, mendapatkan akses yang sama pada barang dan kebutuhan pokok dengan harga yang terjangkau. A world for homes that are smart, connected, and green.
Masyarakat di mana setiap orang memiliki akses ke pendidikan yang lebih baik.
Saya melihat satu masa depan di mana petani dan seluruh komunitasnya bisa mendapatkan segala apa adanya dalam hanya satu klik.
Where we can keep our streets clean and our air fresh.
Pasar di mana ada transparansi di berbagai bisnis.
See a world where age does not limit one's potential.
So what do all these uncommon companies with uncommon goals have in common? The shared mission to uplift the lives of the next billion.
Thanks, everyone. Good morning. And welcome, and thank you for joining me at the Emergence 2025 conference. My name is Charles Chong. Before I start, can I get a quick show of hands? How many of you in the audience in the last 5-10 years have been to Southeast Asia? Can you please raise your hands? Wonderful. Okay, I feel very enthused at the moment. So, by background, my name is Charles. I am the co-founder of TNB Aura, joined by my partner Vic, who is in the audience today. For those of you who are wondering, TNB, as the initials, stands for the next billion. It often gets asked, is that mixed $1 billion, guys? Isn't that a bit on your nose? No, that's the next billion users. And where will that come about from? It's from the emerging markets, of which 600 million of those are sitting in Southeast Asia today. In short, and I'll keep this part fairly brief, I'm happy to have a chat with many of you after this today. We are a thesis-driven Series A venture capital investor, investing all across Southeast Asia, particularly Indonesia, Vietnam, the Philippines, and of course markets like Singapore where our headquarters are based. We're privileged today to be now investing out of our third fund, backed by many global, highly renowned investors around the world. I'll share some more of that a bit later. And it's my pleasure today to share with you guys a little bit of that journey. In terms of the team, we are a team of, let me just switch to a different mic because I like to walk around a bit. We're a team of 20, based across and on the ground in every single one of the markets that we operate. The team are comprised of experienced investment professionals who work together for the greater part of a decade. Every single one of us has grown, built, and exited businesses in our regions in the past. In addition to being top-down, highly networked across the region, we are also very much building capabilities that help our portfolio companies. So you'll see across the team, from Glenn, who runs exits for us, Joe, who runs our investments and research team, to David, who runs value creation, each of these capabilities forms a fundamental part of how we think about the world. In building up our organization, we build for the future. We're now onto our third fund, as I mentioned, backed by global DFIs, sovereign funds, fund of funds. And I think for many of you, if the objective today of myself is just one-fold, is to get more of you to look at Southeast Asia as an opportunity for investment in the coming decade. So, why Southeast Asia? I enjoy this a lot because I think for many of you in the crowd, it seems you've been there, visited there, hopefully looked at investing there in the past. So a little bit about myself and my journey. So I started my career here in Sydney, Australia, as a management consultant, working with Booz Allen and Hamilton back when it was called that. From that, I helped develop Booz's first private equity business called Booz Capital, following which I went to Harvard in the US, where I had classmates and colleagues who came back to Southeast Asia to form the biggest billion-dollar companies that many of you would have used in your trips there, such as Grab and Gojek. My first fulcrum moment of where to invest as a venture capitalist came following my MBA, where I decided to go to the Wild West of China. This is back in 2012. And I felt at that point the the undeniable need to be one of the biggest markets that was encroaching and developing and changing the shape of the world. It was true. So that was China back then. I worked there for about 5 years. Even ran one of the larger tech businesses there called Groupon. And then following that, met my co-founder Vic. Following that, I decided the next fulcrum moment was Southeast Asia. So I will not, and you'll, for those of you who know me in the crowd, I don't like to read from slides, so let me give you the highlights. Southeast Asia is a population, this is now slightly out of date, of over 660 million people. The ages are inverted. Rather, so instead of Australia, where you'll have over 50 to 60% above the age of 35 in an aging population, it's the opposite here in Southeast Asia. Number two, we're one of the most digitally connected markets in the world. And three, mass adoption of technology is just native. So what makes for Southeast Asia, in addition to these great stats, different, and why is it different now than it was in the past? And I think that's useful just to go past the surface. Three primary things. The first is 660 million people, 140 million of which will be added to the consumer population within this decade. That's 140 million people, all of which, to Steve's point earlier, are completely mobile first and AI native. I have a 10-year-old and an 8-year-old kid. They no longer use Google. None of their friends, none of their cousins, my relatives in all the various markets that I live, none of them are using this anymore. It's completely different. The usage of technology is already shaping, and much like China with credit cards, if you ever go to China, you won't find one. We will leapfrog that in our side of the world. Number two, the market of Southeast Asia used to be one of many that was bundled together within the Asia bucket of allocators. The eyes of the world are, and increasingly will be, on Southeast Asia. Just looking at allocation itself, Southeast Asia consistently grows at about 10 to 12% CAGR in terms of the AUM pool growing. And unlike other developed markets, but much like other developing markets, the largest proportion, the majority of this, is in venture capital. And why is that? It's because it's not the legacy businesses that will build the future of Southeast Asia, but the new ones that are there. And the third, and perhaps the most interesting point to me, about why Southeast Asia is so relevant today, and the consumers are so relevant today, is because it's one of the most amazing places where you can do good and make great capital returns at the same time. Just to be very clear, we're not an impact fund, no big I in our name or anything like that, but we find that every investment that we make affects lives of those next billion. This is just a quick snapshot of the maturity of the ecosystem. Already to date, we have over 39 unicorns printed in the last 10 years, of which several have already gone to IPO. There are 19 companies, including some of our own portfolio companies, that have announced that they will IPO in one of the local exchanges, or even Australia, or in the US, in the next 3 years, waiting for the gates of the IPO market to open, as I'm sure many of you guys are here as well. And the examples on the right-hand side just give you some flavor of the scale of the businesses that we can build in a market that has 600-odd million people. So let me spend a couple minutes now on how we invest. And I'll try and, to many of you who have invested in venture capital in the past, draw a stark comparison with how venture is historically done. I think that's quite important because as I started this whole spiel so far, we are a thematic-backed, thematic-driven Series A investor. The way in which we invest, I can characterize into 2 dimensions, and maybe to make it simple. Most VCs out there take out an approach which is highly spray and pray, very, very diversified portfolio, 50 to 100 portfolio companies per fund. We think that's the wrong way to approach it. We think conviction is key in a market where you have a few but huge outlying performers. In that market, you want to be highly convicted to an investment, make a smaller number of these, but have a higher proportion of investment, ownership stake in each. So when they exit, you return the fund spades and spades over. So on that dimension, we are a high conviction fund. On the second dimension, most other VCs are extremely inbound. Not to say that that's bad at a seed level or an angel level, but as a Series A investor, being inbound is fraught with bias. Today you meet a marketing technology company, a financial services company, a logistics company, one in Indonesia, one in Vietnam. How can you be an expert in all of these at exactly the same time the moment the company comes to you? So we find, and we have only ever prosecuted deals this way, it's important to go outbound, to look at a theme, evaluate that, and to identify the companies that we want to invest into. As usual, we take a 4-step process. There's a procedure to this. It starts with something which we as TNB Aura have developed with the top universities, originally in Singapore, but now across all of Southeast Asia. In addition to obviously being guest lecturers, we help support and develop the curriculum of the universities in Southeast Asia for entrepreneurship. We think that's really important to not use Amazon, Spotify, things like that, even Singapore Airlines of old. It needs to be based today on new examples. And so in order to do that, we developed what is now the most robust, extensive data set of unicorn and near-unicorn businesses in all of China, India, and Southeast Asia, probably in the world. That data set is a time series over the last 15 years, and we use that to look at what has happened first in other markets so that we can identify what should happen next in Southeast Asia. The way in which we use that data is then with a combination of demographics, socioeconomics rather, and infrastructure level meters to evaluate, all right, if it's this large in China, this large in India, roughly how large should it be in Indonesia as a theme? The goal is not to copy and paste. Just want to make that exceptionally clear, as made point by this third here, where we develop deep dive research. We have a dedicated research team based out of the Philippines with a team also in Singapore, working together on over 40 different industries and sectors. I'm almost 100% sure if any of you are looking at a particular industry and sector, you can come chat to us. We'll very happily share with you our research, our sprint in a particular area. The goal of this research is to take those thematics that we see in other parts of the world and determine what is the nuance, what is the relevance to Indonesia, Vietnam, Philippines, as I mentioned. The final step in our whole process here is to understand where to invest, of course. But we don't do it by waiting for a company to come to us. As I'll give you an example over Leaf, we always go outbound, and the goal is for us to canvas the market. When we find a theme we like, we understand a sector that we want to invest into, and a particular business model that we think is relevant, we only back the best. It's why we're well known, and for many of our investors, their only allocation to covering Southeast Asia. I'll give you one example, and I'll do this briefly. It's far too small to see the specifics on the page. But the goal of each of our research tasks is to understand the scale and size of a market, rapidly from an industry level, go down to the sectors. As an example here, where we invested into the largest private EV charging business, not just in Singapore, not just in 1 or 2 markets, but in all of Southeast Asia, is to then go and say, what are the sectors that can make money? A lot of discussion on Tesla earlier this morning, 4-wheeler EVs. There are 6 areas and sectors to invest within EV. One of those is 4-wheelers. It won't be in Southeast Asia. Those markets, far too large. Even if VinFast, the first opening round, hundreds and hundreds of $1 million. It won't be for us. 2-wheelers, very interesting. We've invested into one of the largest in Southeast Asia. And one of the most interesting ones is EV charging. To give you a quick anecdote here, across all of Southeast Asia by 2035, almost every single country has made a commitment to ban the sales of new ICE vehicles, internal combustion engine vehicles. In Singapore, it's by the end of this decade. Combined with the fact that there are typically restrictions for how long you can drive a car on the road, by 2040, you've got a good chance that almost every car, if not every other car, will be an EV vehicle on the road in Southeast Asia. So this is a big theme. Now the question is, right here, what is the right business model to adopt in doing this? Again, the data is out there. We look at all the precedent models in more developed markets. It's one of the privileges of being in Southeast Asia, where we don't need to crystal ball in isolation. We have the rest of the world to look at. And you can see that there are several business models that are applied around the world. Disproportionately, the best ones are in this model that we call the end-to-end model, where you build your own infrastructure, AC, DC chargers, you take a yield off that. If the utilization rates are above 12 to 15%, you're breaking even and making amazing IRR on your equity. We then size the market. And the most important part here, of course, is to see who else is out there. Again, being outbound, we met almost 20 players, almost every single private player out there, before we understood that there was one who was never answering our calls, who had never met another investor, who was profitable, access to debt, didn't need any capital. That was a Business Charge Plus. We showed enough value with this research, with our compelling team, value creation activities, such that they chose only us to be the investor in their Series A. They'll raise another round at the end of this year. If any of you like this kind of space, come and chat to us. We're happy to introduce you to the founders. All right. Very briefly, how much time do I have, by the way? 1 minute. I'll be very quick. This data allows us to do so many more things than just figure out, here's a theme, here's a company. It allows us to also predict when shifts occur. Right, left-hand side here is on the big industries out of China. So this is based on the data set I said earlier. E-commerce comes first. Fintech next to pay for those goods. Logistics to move those goods around. Most of you may have a heuristic, a gut feel that this is where it is. You probably haven't seen this data before. On the right, we can break that out and understand within each individual sector, what are the themes that work. In short, this insight, which was that e-commerce in tier 1 cities in China, the moment 2017 hit, and you had a certain amount of adoption of e-commerce in the major cities, it moved. It shifted to being social e-commerce in tier 2 and tier 3 cities. By knowing that, we identified first, this thematic, we canvassed the market, we identified one player in Indonesia. Today, by a factor of 10, roughly about $500 million valuation today. We entered at a $40 million valuation about 3.5 years ago. Subsequently, 1 year from that, it became a $300 million valuation round led by New Enterprise Associates from the US. At that point, when we identified it, the founder himself didn't realize what he was sitting on. He didn't realize that he had the best unit economics in the market. All right, let me jump ahead. So in terms of the team and our approach, that's a little bit about us. In terms of the style in which we invest, let me just share, we've now made 23 what we call core investments in the region, covering e-commerce, logistics, healthcare, education, and the like. Because of our 40 sprints, we know exactly where we're going next. And as you can see for some of the purple tags here, if you like, the holy grail of ventures to find companies that are positioned in one company returns the entire fund. We've done this a few times, generated exits of some of these. Happy to chat about that as well. And maybe to end off, left-hand side, a little bit of benchmarking. We are audited by KPMG, so we always provide this to groups like Preqin, Cambridge, to make sure that we're always keeping track of our peer set. Thankfully, we're always happy to be in the top quartile, and for our most recent Fund 2, and as I mentioned, we're on to our third flagship fund now. In Fund 2, it looks like we're one of the top 3 funds in Asia, including China and India. We work closely with the government, and maybe I'll end on this. Hopefully today, if there's nothing else that it's that I've piqued your interest in looking at Southeast Asia as a market, that I've piqued your interest in a way that venture is done, can be done maybe, the way that we do it, that's very different from the way that the market does so. Our investors include the Norwegian sovereign DFI, Khazanah, which is our sovereign fund of Malaysia, FMO, the Dutch Development Bank of Japan, and many, many others, including fund of funds. I myself, again, as I said at the beginning, came from here, Australia. I love this market. I want to see it doing more with Southeast Asia. I always am struck with how many of the largest institutions have a very insular view of the world. But as I'm told by Steve, I think the audience today, hopefully, and from the show of hands earlier, I can tell there's a level of engagement. So my name is Charles, as I mentioned. My partner is Vignesh. Our email address is super easy, tnbaura.com. Take that now, take a photo, contact us, grab us after this. We would love to have a chat. So thank you very much, everyone.
Thank you, Charles. Next, we have Creek Partners, who serve as a strategic bridge to the vast opportunities within India's rapidly evolving market. Please welcome their general partner, Akshay Chakrapani.
Hello. Everyone can hear me? Okay, great. All right. I think Creek Partners is a logical next presentation to Charles' really exciting overview of the Southeast Asian markets, because we focus on the Indian VC market. So good morning, everyone. I'm Akshay Chakrapani. I'm a GP at Creek Partners. And I'm very excited to talk to you about an extraordinary opportunity, connecting Australian wealth with Indian innovation. We believe in building bridges, in fostering growth, and in creating a future where Australian investors are actively participating in India's growth journey. Creek Partners is not just another investment firm, and let me explain what I mean by that. It's two Indian immigrants who came to Australia, had successful careers, got married, had children, became proud Aussie citizens. And so we've lived in the shoes of both worlds, and that unique perspective is at the heart of what we do. I've known my partner, Chirag, for about 6 years. We've got children of the same age, shared values, and one of our many discussions we were discussing, how do you create a situation where our professional outcomes are more closely tied to our personal values and ambitions? Because we understand the cultural landscape in India quite intimately, and the dynamism that is required for an entrepreneur to succeed. We also understand the Australian regulatory environment deeply. So on the one hand, you have a country with a lot of promise and potential requiring investment, and on the other hand, you have Australia, a country with a substantial capital base seeking high-quality investments. And I'm paraphrasing the great Warren Buffett when I say this. He said, understanding the local culture is crucial for success when investing in foreign markets. We are that understanding. India is more than just a number, and you're all sophisticated investors, so I'll be very brief. It's the 5th largest economy in the world, on track to surpass Japan very shortly, grew at 6.3% last year with aspirations to grow between 8 and 10%. The gross national income per capita in India is $2,500, and it's expected to touch $6,500 by 2030. India's rank in ease of doing business is 63. And we mentioned that to someone yesterday and they had a laugh. But that's a remarkable feat when you know that just 3 years prior, India was ranked 130. 1.5 billion people. I think everyone is aware of that fact. But what is the nuance in that data point that we would like for you to take away? That there are 960 million people in the working age bracket. So that demographic dividend is really fueling India's growth. But you need something to occupy that many people, provide employment. You also need a platform to bring to life the aspirations of the entrepreneurial Indian. And so, cue the Indian VC ecosystem. It's the 3rd largest VC ecosystem in the world, and the 2nd fastest growing. VC ecosystem in the world. Any serious investor needs to take note. Let's look at some innovation that's happening. Let's add a bit of color to this presentation. Exhibit 1, this is a company, Blue Jay Aero. So they have developed a hydrogen electric propulsion system for vertical takeoff and landing aircrafts. Their primary focus is regional travel, regional delivery of cargo, and they do all of this with 0 emissions because their engines are all hydrogen electric based. Exhibit 2, Space Tech. This is really exciting. The first rocket that you see is Agnikul. They're providing customized launch solutions for nano and micro satellites for insertion into low Earth orbit. Their competitor, Skyro, that's the blue rocket right at the very end, they cheekily submit on their website that launching satellites should be as easy as booking an Uber. And the satellite right next to that is Pixel. Pixel provides hyperspectral imagery solutions, so use cases like mineral prospecting, illegal mining, pest control, vegetation, energy, climate, a vast array of use cases. Exhibit 3, FinTech. Okay, before I get to the lady with the tomatoes, I'd like to talk about the UPI, or the Unified Payments Interface. And I know a lot of you have probably heard of it, just for the benefit of those who haven't. UPI is India's answer to Visa, MasterCard, Amex. So it's a payments network, effectively, but just with lower fees. In 2024, the UPI handled $2.9 trillion worth of transactions, and the transaction volume clipped 140 trillion. That's really, really amazing, just given the fact that the UPI was launched only 7 years ago. So coming back to that lady, you come out of your house, you rock up to her store, buy some tomatoes, and you scan the QR code that's stuck behind the weighing scale, which ironically is not digital, and you're on your way. So you don't even need a point of sale machine that allows her to transact seamlessly. And what's more marvelous about the UPI is that it has provided for financial inclusion. Because now she has access to banking channels, microcredit, insurance products, what have you. And this is what we hear when we speak to a lot of the venture capital firms that we interact with in India. They often say, you build for India, you solve for the world. And this is, I think, an example of what they're trying to get at, is you build world-class solution at a fraction of the cost and make it accessible for all. Look, in the interest of time, we haven't touched upon the raft of AI companies that are proliferating across India. We haven't spoken about the not-so-glamorous but equally promising vertical SaaS companies, marketplaces, consumer, material science, deep tech. There's so much more. And if you're still with me, you're probably wondering, yeah, mate, that all looks nice. So how do you know which VC firm? And that is where we come in. Because we spent the last couple of years researching and monitoring and tracking the VC firms. And at last count, there are 150 domestic VC firms in India and a further 40 to 50 international VC firms that are operating there. So how do you know? How do you know which VC firm is adept at identifying those early disruptors? How do you know which VC firm is adding value to the companies across their journey? Crucially, how do you know which VC firms have a deliberate strategy around liquidity for their LPs? So what is our vision? Our vision is for Australian wealth to own meaningful stakes in some of the most valuable companies to emerge from India tomorrow. How are we going to do that? Thanks. How are we going to do that? We're going to do that by securing co-investment rights in the VC firms that we partner with, that we invest into. Because in the fullness of time, the best companies is where we will want to participate directly and own those meaningful stakes. And remember, these companies are the likeliest to IPO in the shortest time frame, right? They're in the best of health. And so what I'd like to say is that come talk to us. Let's create a future where everyone benefits. We'd love to share what we've learned, what we're observing along the way, and share what we've learned. So thank you. India's time is now. We're very excited about this opportunity, and Creek Partners is here to guide you.
Thank you, Akshay. Now let's hear from Neopharma Technologies. Please welcome Sean Melville, the Executive Director, to discuss their innovative solutions in the pharmaceutical industry. Welcome to the stage.
Hello all, my name's Marcus Lestrange and I'm the Chairman and Founder of Neopharma Technologies. With me on stage is Sean Melville, who's an Executive Director and Co-Founder of Neopharma. There's a lot of info in our slide presentation behind me and we don't expect you to absorb it all, but we'll provide a quick summary now and welcome you to visit our booth after this to get more detail. We've heard from many great companies at this conference that are delivering AI-empowered solutions that are set to change many industries over the next few years. Neopharma is set to revolutionise the drugs of abuse testing industry with a truly disruptive solution that has no real competitors. Neopharma Technologies is an Australian public unlisted company formed in 2017 with wholly owned subsidiaries in Malaysia and the US. We've developed an industry-leading solution for the rapid diagnostics industry with an initial focus on the $6 billion US drug testing industry. We're the first company to integrate drug testing with impairment testing technology, and we provide this all via a phone app. This becomes very important with the legalisation of marijuana or THC, particularly in the US over the last decade. We've raised over $9 million Aussie to date and have over 200 valued shareholders. We've completed the R&D phase of the company's growth and have just entered into our commercialisation phase with a clearly defined path to a dual ASX NASDAQ listing. 6 months ago, we appointed Nina French as our US-based CEO. She's one of the preeminent industry leaders in drug testing in the US with over 30 years of experience. Nina was part of the team that helped write the original drug testing legislation under the Reagan administration. The US has the largest drug testing market, which accounts for about 50% of the global market. When Nina saw us do a live demo at a US industry conference, she immediately understood the significance of how our tech would revolutionise the industry far beyond what even we had originally intended. In the preceding 8 months, Nina's helped us to map out the complex industry workflows and work closely with our software development team to incorporate these into our NeoVault platform. I'll now play a short video from Nina, who could not be here today in person.
Hi, I'm Nina French, CEO of Neopharma USA. I spent 30 years in the drug and alcohol testing industry, leading innovation and helping organizations build safer workplaces. But today, we face a myriad of challenges: legalized THC, increased drug and alcohol use, mental health concerns, and a need to figure out impairment in the workplace. That's why I was so excited to have the opportunity to join Neopharma. Our AI-powered Neopharma Reader, integrated with Druid's cognitive impairment app, is the first and only solution that combines rapid drug screening with real-time cognitive impairment detection. So it's a game changer for employment, for law enforcement, and for healthcare. Unlike outdated methods, our technology, it's fast, it's objective, and it's scientifically validated. It gives businesses the real-time insights they need, and it reduces risks, it improves safety, and it supports employees. It helps employers retain those employees that they've invested so much in while they contain costs, while they increase safety. It really is a true innovation, and it's one that we've been looking for over the past decade. The future of drug testing is going to change, and Neopharma is really leading the way. Now's the time to invest in technology that's redefining workplace safety. I could not be happier and more excited for the journey in front of us, and I look forward to working with many of you as we redefine what workplace drug testing will look like for all employers.
Thank you to Nina for that. So the drugs of abuse industry workflows are currently predominantly paper-based, and our phone app and IT platform essentially digitise these workflows. In the US alone, there's about 250 million drug tests done annually, with about 52 million of these being done by laboratories that have a 4 to 7 day turnaround on test results, and the rest being rapid tests in the field that take the testers up to half an hour to perform the test and compile the subsequent test report. Our solution produces an AI-generated test report within minutes, saving time and money. Individual test kits are paired with NeoVolt platform via a unique QR code printed onto each test kit. Neopharma's growth strategy includes partnering with the largest manufacturers of drug test kits globally that already have sales in the millions of test kits annually. Neopharma's main revenue stream comes from charging up to $2 US for a drug test report and up to $10 US for an impairment test report originating from each individual QR code, with a rebate from this going back to the manufacturer to encourage them to partner with us. This business model creates a new revenue stream for our partner manufacturers, whilst we benefit from accessing their significant global sales networks. Our NeoVolt platform also connects different groups within the industry. If we look at it like a wagon wheel, with all of the spokes being the different industry players, NeoVolt is the hub in the middle, connecting all of these groups and workflows. We also charge a fee for these connections, of which many didn't exist previously, or if they did, they were inefficient at best. This slide demonstrates the expected growth in the rapid diagnostics market, which is expected to grow to be a $134 billion US industry by the end of this decade. Our company's mission statement is to become the global default testing platform within this industry. As mentioned earlier, we've now entered into our commercialisation phase recently towards the end of this last year. We've secured a supply agreement worth about $250,000 annually with an Australian-based company, Nucleus Network. They perform clinical trials for new experimental drugs, but they need to test their patients to make sure they're drug-free before they start the trials. We've signed a memorandum of understanding with a leading US distributor to NeoVolt enable 5 million of their test kits. This is our first major project. This project will deliver about 7.5 million US or circa 12 million Aussie annually. We've developed a weighted pipeline of revenue in the US of 85 million US across 33 companies for 2025. Our current fundraise is to grow our IT and implementation teams to ensure that we can scale successfully and deliver this pipeline revenue. I'll just flick to this slide. You've now met all the team in this slide except for Gajendra Raj, our CTO. He's a very clever chap who used to work for Interpol decrypting terrorist communications before we headhunted him. With high-level encryption being his specialty, he built our NeoVolt platform to be compliant with the highest level of cybersecurity certifications of HIPAA, GDPR, SOC 2 Type 2 and ISO 27001, which gives our clients comfort given the sensitive health test data that we deal with. I'll now pass the stage to Sean, who will talk about the investment value proposition. Thanks.
Thank you, Marcus. Ladies and gentlemen, thank you for your time and interest in Neopharma Technologies. We are shaping the future of a multi-billion-dollar industry with no direct competitor in sight. Our clear pathway to a dual NASDAQ and ASX listing presents a rare and time-sensitive opportunity. I ask you this: why would you want to be a stakeholder in this company? To date, we have only accepted investment from those who share our vision and have helped build Neopharma. We believe in rewarding shareholders with strong financial returns and healthy dividends. As our CEO and Chairman have articulated, we are poised to lead this industry, operating with transparency, efficiency, and a shareholder-first mindset. Marcus and I are also directors of Raptor Global Corporation, have a vested interest in Neopharma's success. with Raptors holding 20% and our respective network representing another 40%. Our interests are fully aligned with our shareholders. We run a lean operation with our development team based in India while recruiting the best talent from top companies like Google. We remain focused on innovation and execution at the highest level. Our appointed distributors and manufacturer have personally invested their own funds and network into Neopharma, strengthening their alignment with ours. Our 30-cent capital raise seeks to secure 2 million Australian dollars, accelerating global expansion and dual listing. This is your chance to be part of an industry-defining company, already at commercialisation stage and ready to scale. We invite you to visit our booth and request our information memorandum. It would be our privilege to have you join us on this exciting journey. Thank you, and we look forward to welcoming you to join our already 200 valued shareholders. Thank you.
Thank you, Marcus and Sean. Up next, we have ChatESG. They are making ESG accessible to all businesses with its AI-driven platform. Please welcome to the stage their founder and CEO, Geoff Gourley.
Morning, everyone. ChatESG. It's something I'm really passionate about. I've been working on it for the last 3 or 4 years, and particularly when ChatGPT came on board, I got pretty excited. And it is about democratising access to ESG for all the SMEs that are out there. We want to make it simple, fast and accessible. What we've discovered working hands-on with a lot of businesses, from ASX listed all the way down to smaller businesses, is that they all shared these similar types of challenges. What we wanted to do was come up with a way where they were not paying $4,000 a day for top-tier consultants to help them through this journey, but they could access something for $50 a month. They could adopt different models where they could do it themselves, they could do it with us, or they could have us do it for them. We've been using this tool for all of our engagements behind the scenes, but disclosed to our clients. We've worked with around 30 businesses over the last 12 months in a consulting-led approach. There's a lot of different aspects to ChatESG. These are some of the key ones around the ESG aspect. Why and how is it different? What we saw of some failings of ChatGPT is it doesn't capture the business context, it's not capturing the detailed business data. And so what we did was we added those layers and we saw rapid improvement in the outputs because they had the context. We added a layer of our own ESG library, very specific material again, and we also added a RAG, which is a retrieval augmented generation. Again, it's a lot of information, ESG very specific, and so you get far better tailored results, tailored for that specific business within its sector, what it might need to do for compliance, regulations, what types of strategies are going to work best for it, developing roadmaps, action plans, policies and alike in immediate time. We've had fantastic traction to date. We spent 3 years in research and development with a couple of consulting companies. In January 2024, we established ESG&I and ChatESG. So ESG&I is the consulting-led practice where we're using that tool internally for ourselves. The tool is also suitable for other consultants to use, and that is one of our go-to-markets, is making this available to consultants. We entered into a partnership with the Australian Institute of Management. Within 6 months, that delivered us 150 business customers through our ESG 2-day program, and so it's been a fantastic qualifying lead generator. We were a participant in Australia's AI Sprint with Google and Saiiv, and then we launched our community of practice. So we currently have a wait list of 13,000 businesses for ChatESG, and we are working with Tessara Technology on developing our MVP, which we're working on right at the moment, and that will be a public-facing product that will be coming out very soon. In 2024, I was a finalist in the AI Consultant of the Year Awards as well, and I just see this big convergence between AI and ESG making life easy for business. On our roadmap, we've done significant pre-work. We're sitting here in February at the moment and looking to a May launch, and then looking to scale internationally fairly rapidly. We've identified the key market drivers. There was a new bill passed last year, which is the Mandatory Climate Disclosure Bill, or the Australian Sustainability Reporting Standards. That's going to waterfall down from the large, over $500 million a year revenue companies, all the way down to SMEs within the next 3 years. So if you think back to compliance and the introduction of OH&S 20 years ago, the introduction of ESG is going to touch every single business within the next 3 years. What we're already seeing is the large clients are pushing that down right through their supply chain, and that's creating a lot of work for us, which is fantastic. But these companies don't have the resources, the expertise and the budget to respond to these demands. Companies like Costco, a lot in the FMCG space, a lot in the construction sector, in the financial sector as well. The compound annual growth rates for both are significant, and when you're putting those two together, we're going to be far outpacing any traditional consulting style businesses, and ESG is a key focus area. Huge markets. This is also a targeted market, so it's not just every SME, it's SMEs in the early adopter market. 41 million SMEs, and part of our really refined target is over 2 million SMEs. Our business model, pretty simple. SaaS, pay less than $50 a month instead of paying 50 or 100 grand for a full ESG suite. My experience over 30 years, multiple times founder, multiple times exits, particularly in the sustainability space. And in January last year, we sold pay apps to Autodesk for over $600 million. A lot in construction, design, and then in consulting, specifically ESG consulting. Our leadership team, so my partner here, Tully Smith, ex-Telstra, former GM of the American Chamber of Commerce, former CEO of the Australia-India Chamber of Commerce. Some of my experience there, I was also a board director of the UN in Australia, and recognised in the top 100 global social entrepreneurs. Why now? For us, we're really first to market in this space. We have a range of AI agents that we've developed, so think of that as your consulting team, from a partner to a subject matter expert to a business analyst. These AI agents can apply and be used in any type of work that you want to do. So you're using a partner for your strategy and strategic vision, and you're using a business analyst for your data, your research and your analysis. That gets us really tailored, high quality outcomes, and almost error-free compared to just trying to do it yourself through a ChatGPT. So hyper-tailored, very flexible subscription model. It's all about accessibility to the SME market. And again, 3 key models: do it yourself, do it with me, or do it for me. So we have a land and expand model where the technology brings in great revenue, but we also have the premium high value revenue that clients can also access. We've got a pretty key scaling plan, and already, you know, with 13,000 on the wait list, we think we can hit 100,000 businesses fairly quickly before the end of the year, and then look to scale internationally quite quickly. We are exhibiting today, so please come out to the exhibition hall. We've got a lot more information there. We're currently doing a pre-seed raise of 600K. We've raised 120 already. We've been completely bootstrapped up to this point, and we think the next raise might be when we launch into the US around the end of the year. So, yeah, as Steve said earlier, great opportunity to get in on AI, specifically in that targeted niche of ESG. Thank you very much. Please come out and see us.
Thank you, Jeff. Next, we have Rapid Response Revival, known for its groundbreaking work to introducing portable, user-friendly medical devices aimed at improving emergency response outcomes, especially in cardiac arrest situations. Let's welcome their Head of Investor Relations, Damian Shrubsole.
Thank you very much. Thanks for joining us today, and I hope the rest of your day continues to go well. As Jeff just said, we're also presenting next door, so come and see us at some stage after this presentation. I'll just play this quick video.
When it happened, we happened to be in bed. I was studying for an exam for my MBA. I looked over and Sarah was making clucking sounds, chicken sounds. That was her trying to breathe. You get that realization and the horror of that. You want someone to save you. I was on my own. Everything that I went through is imbued in the product. She was asystole or flatline for 40 minutes. The CPR bought her some time. When the paramedics told me that I had saved Sarah, imagine if I just stood there and had done nothing. Most people die after sudden cardiac arrest. They die because they're too far away from the tools needed to save their life. We can't do anything about the unpredictability of sudden cardiac arrest, but we can be prepared. When Sarah almost died, I was a customer for a device that didn't exist. So we invented it.
So sudden cardiac arrest is a significant global health problem, and it's very, very time sensitive. You literally have 10 minutes to provide assistance to a person who is having a cardiac arrest. Not only do people lose friends and family and other loved ones, but there is an enormous economic cost for sudden cardiac arrest that we all bear. The location of most sudden cardiac arrests is surprising to most people because they will see defibrillators in public spaces like this hotel. I challenge anybody to find it. Happens in your home, where up to 80% of these events are occurring. We know that if people receive CPR and defibrillation in the first 3 to 5 minutes, survival rates go from what is currently 5% to over 50%. So we can solve this problem by filling this survival gap. And as in that video, it was mentioned that our founder started this business because he had a personal experience with sudden cardiac arrest. And in Australia, unfortunately, with the 30,000 deaths that there are a year, we estimate at least 10 people know those people. So there's 300,000 people affected by this directly every year. So we've developed a personal solution to fill the gap. It breaks those barriers and fills the survival gap with a smarter, lighter and more affordable solution. It does this by bringing the technology into the 21st century. Cell aid is 20% of the weight and over 50% of the cost of a traditional AED. We lower the maintenance cost for customers. We remove the reliance on their own personal maintenance and following dates and expiries by doing that all remotely with IoT. And in the event of a device being used, we also collect the data, which is very helpful for people who survive, because that can be used in the ongoing treatment, but it's also very helpful for those who don't survive, because people may receive answers for that information. The company can also use it to continue to develop and increase the sensitivity of our device to arrhythmias. Oh, you didn't see that. Sorry, I forgot to press the button. So there is a very large obtainable market for this kind of product because effectively cardiac arrest affects so many people around the world. We do see a lot of inbound interest in developing countries, those that do not have the type of infrastructure that developed countries have already established. So having a more portable device closer to the potential outcomes of cardiac arrest is very exciting for them. The IoT connectivity that we have in the device means that it can be integrated to an emergency services system. So when somebody receives an emergency call for an ambulance, there is the opportunity to direct them to a defibrillator, or have a first responder who is provided with a defibrillator reach that site before an ambulance does. And we had an incident last September where a first responder reached a 30-year-old mother of 3 who had a cardiac arrest in public. Within 2 minutes, she was defibrillated by our device. She survived. The ambulance took over 30 minutes to arrive. So if we can get the tools and the skills there before the emergency services arrive, we have much higher survivability. So we have developed our device and our business model as device as a service. So you buy the important tool, and then with the IoT and the communication software for maintenance, we create an environment where people pay an ongoing management fee and replacement fee to have peace of mind that the device is ready for them when they need it. We are the first AED manufacturer to directly sell to customers, so we have substantiated a direct-to-consumer purchase channel. Over 50% of our customers are direct to the company. We still use traditional channels with intermediaries who have specific sector specialities, like training organisations who are teaching the use of AEDs and first aid, or medical product suppliers. The early adopters within our devices customer set are obviously including those who are medically trained, first responder networks, our French partner, who will be delivering our first 1,000 devices to them in a language other than English this in March, has a first responder network of over 700,000 people who are giving their time to the community to help them. Now we are able to give them the tool that makes that even better. People with personal history of cardiac arrest issues, or know somebody in their circle of friends, and first aid training students. CellAid's proven there is a market for personal AEDs when the value proposition and technology is right. We've validated our DAS model. We've validated the direct-to-consumer model. And we've partnered with resellers and training organisations, corporates and AED customer bases to expand their use. Our customer profile aligns with the largest market opportunities and sets. And to date, in the personal AED space, which we are the leader and only provider, we are the #1 selling AED, and we have provided Australians, New Zealanders, the English, the Irish, over 25,000 devices to date in the last 2 years of supply. So why now? We have a team that's capable of the execution, that's taken the CellAid from idea to commercial within 5 years. And if anybody's familiar with the complex medical device space, we would consider that to be very, very rapid. We have built a sales platform and relationships to commercialise our business to scale. We have real-world and clinical evidence of the safety and effectiveness of our device. We have been judicious at protecting our IP. Everything that's been developed in the device has been by the company and is owned by the company. We've attained regulatory clearances across multiple jurisdictions. We've established manufacturing and designed it as a factory-in-the-box setup, so we can engage contract manufacturing anywhere in the world with our own IP-protected manufacturing processes. We're seeing legislative support gains, and we're poised to deliver a business in the near term that will add value to the community and to our shareholders. So we have a key team of people across the board who have helped develop this product. We're very proud of what we've issued or delivered to the marketplace, and our goal is to save lives. Our target is for 100,000 by 2030. We're bringing a game-changing technology to the world's homes. Join us and visit our stand to discuss investment opportunities. And as I said, if you're looking for an AED in this building, everybody's got one of these in their pockets. Now you can have one of these. Thank you very much. I'll see you all later.
Thank you, Damien. Next, we have synergenMet, an innovative company in the environmental technology sector. Let's welcome their Managing Director and CEO, Christopher Dunks.
Good morning, everybody. I feel very privileged to be here today to present to you all and to talk about Synergen. Synergen we formed in 2007 as a company undertaking research into very innovative clean technology programs, which I'll go through today. We've been a research organisation up until about 4 or 5 years ago when we've converted ourselves into a commercial entity. We're an unlisted public company. We have over 100 shareholders, so we're in continuous disclosure, and we're looking at an end-of-year NASDAQ IPO. So we'll get into the detail. So Synergen, we're experts in the application of high-temperature plasma technology, and we're using this to solve quite a few large thematics that have emerged over the last few years. PFAS, I'd like a raise of hands if everyone's heard of PFAS. It's a firefighting foam molecule that's causing major issues around the world. We've developed technology to deal with PFAS. We're splitting methane to make hydrogen and graphite, and the graphite becomes a synthetic graphite that's amenable for battery anodes and supercapacitors. And we're also smelting very high-grade critical minerals ore. So PFAS. What's PFAS? For those that aren't aware, a PFAS molecule is essentially a hydrocarbon molecule with a fluorine atom bonded to a carbon atom. And the issue with PFAS is that that fluorine bonded to the carbon is very, very strong. And PFAS has been around now since the late 1950s into the 1960s. And over the last 15, 20 years, it's become general knowledge that it's causing major medical issues in populations and in animals. That was known in the 1960s, but it was covered up, and it's become quite scandalous. And if you follow the news, you'll see all the lawsuits and the billions of dollars that are being thrown at it to try and fix it. It's the issue is that fluorine carbon bond. And when we started looking at this PFAS issue, we realised that we operate plasma. So high temperature plasma operates at 3,000 to 5,000 degrees Celsius as in a normal operating temperature environment. And that fluorine carbon bond requires 1400 degrees C to bust apart. Incineration is about 900 to 1000 degrees Celsius. So really we concluded that the only way to deal with this is actually using plasma. So we went about developing our technology. We were funded by the Department of Defence and Air Services through an Australian Research Council grant, and we came up with 2 applications. And those 2 applications really are focused on water. The first one is for removing the PFAS molecule from water using foam fractionation. So you're bubbling, creating micro bubbles in the water, and those bubbles pick out the PFAS molecules down to very, very low sizes. And then that creates a concentrate, and it also creates a clean effluent stream. And that clean effluent stream then can be treated by wastewater treatment. We've been approved by the EPA in Queensland to operate, and so we're one of only 2 approvals, I believe, in Queensland signed off by the Department of Environment for creating a clean stream at a very, very low concentration of PFAS. And then what happens to the concentrate? Well, the concentrate would then go into our plasma system where we drip feed that into a very high temperature environment where we bust apart and we atomise that PFAS molecule, and then we reform that as hydrogen fluoride, and we scrub it to make sodium fluoride. This is one of our operations. It's on a composting facility in Queensland. That's our foam fractionation system that does about 100,000 litres a day, which is about standard for landfill leachate or for these types of facilities. And we're treating that dam in the bottom there. And this site was out of action for 5 years while the owner was in court with the Department of Environment, and then we came along and helped them out, and now we're providing them a clean stream and a concentrate that we can deal with off-site. This is a standalone. Our approach to AI is really around industrial automation and machine learning. So this stands alone, operates by itself, doesn't require any personnel. It's off-site monitored, and it can run 24/7. It's a containerised product, and to scale, you just add more containers. Well, that's a 20-foot container. We can build 40-foot as well. So we've got a lot of proof of concept. We've got multiple sites where we are operating. We have 2 US Department of Defense contracts for the destruction of PFAS, one from soil and one from destroying the firefighting foam called AFFF. And we'll be operating in South Carolina in August, September this year. It's an extraordinarily large market. Like every landfill that's been operating around the world since the 1960s has some level of PFAS in their leachate. And same with wastewater treatment plants. So the market is enormous. It's just about how each country is going to deal with it. The US is huge, and Europe is also going that way. We're also going through the process of splitting methane to make hydrogen and graphite. And this is where we introduce methane into our plasma system. And that plasma is very, very high temperature. The activation energy splits apart the CH4, and we end up with gaseous hydrogen and solid carbon. We're in this hydrogen business, but we're not really playing in the same way that the electrolyzer hydrogen market is. We're not looking at extremely large shipping offshore hydrogen. We're looking at co-locating with our customer and separating out that methane so they can use hydrogen as an energy source, or in the case of coal mines where they might have methane which they've captured, which we can separate and turn into hydrogen and graphite. There's a lot of opportunity here, but it's niche applications site-by-site basis, but we're excited for where this is going in the next 10 years. Economically it works because you've got 2 revenue streams, and it's the cost of the return on capital is excellent, and it's really, we're going through a piloting process over the next 12 months. We've also started working with a partner company in Minnesota called Phoenix Solutions Co. to smelt very high-grade platinum group metals that are in a very complex format that can only be processed using smelting. And so we've started doing some small-scale smelting, which works economically because you've got very, very high-grade materials. From an investment perspective, we're heading to a NASDAQ listing towards the end of this year. We'll be coming out with a pre-IPO cap raising in the next 1 to 2 months. We are looking for equity investment, and we will come out onto the platform with those details when it starts. If you're interested to have a conversation with me, I'll be next door all day. I'm more than happy to chat. Our capital structure, we've got over 100 shareholders. It's our pricing. Our management team and founders still own about 28% of the company. Happy to talk about where we're going. These are our comparative companies. We're in these multiple different spaces using this base technology. 374Water is a PFAS-specific destruction tech out of the US. Hazer is in Western Australia doing hydrogen production by splitting methane, but they're using an iron catalyst. They're doing really well. They're listed on the ASX. Novonix, most people would know because of their graphite production capability and how they've developed in that market over the last few years. And then Monolith is probably the world leader in methane splitting to make hydrogen, and they make carbon black, or a clean carbon black. So thank you very much.
Thank you, Christopher. Now we have a presentation from our sponsor, Invest Hong Kong. Welcome, Max Lowe, Head of Investment Promotion.
Hi, good morning everyone. I'm Max from Invest Hong Kong. So in a nutshell, Invest Hong Kong is a government department from the HK's SAR government with the responsibility as well as the missions of helping the overseas companies to thrive in the Hong Kong market. So basically during this presentation, I'm trying to give you a picture about the latest development of the different sort of business situation in Hong Kong and how Hong Kong can be relevant for different startup companies, scale-ups, as well as different investors. So the presentations will cover like the advantages as well as opportunities in Hong Kong, as well as the key priority sectors. I think for the second part, it can be most relevant for the investors who are looking for different sort of like investment opportunities. And currently in Hong Kong, sustainability, healthcare are definitely the key sectors that the government has been pouring a lot of different sort of like subsidy resources as well as different support to help the industry to grow. And then which in turn means that there will be plenty of investment opportunities for investors. And then how Invest Hong Kong can help will be very relevant for different sort of like startups as well as companies which are looking for example, say fundraising, listing their shares, as well as setting up their businesses in Hong Kong. So I've got a lot of slides, so probably I'll just like flip through and then like focus on the very important sectors. One of the key highlights is that like Hong Kong is definitely a very international business communities with companies from all over the world. And then I'm aware that like quite a lot of the companies are actually thinking about like listing their shares potentially in the US NASDAQ market. And then definitely like the stock exchange of Hong Kong is one of a very good avenue for the companies to consider as well. That is because of the concentration of both international investors as well as Chinese investors in the Hong Kong markets. We've got all sorts of different like investment companies, investment banks, as well as underwriters of the shares in the Hong Kong market. And then through those underwriters, you'll be able to have access to the cornerstone investors in both mainland China market as well as in the international market. That will actually help you to further broaden your investor base when you're choosing to list your shares in Hong Kong. And in addition to the underwriters for the more like mature companies who are looking for IPO opportunities, we also have different sort of like VCs and as well as like say PEs in the Hong Kong market. And then they'll also be very relevant for the scaled-ups who are looking for fundraising opportunities to further scale up their business operation and to help the business international expansion. And then especially for those companies who are like trying to like make a profit or to like enhance their distribution in Hong Kong, the tax system in Hong Kong is definitely very valuable as well as like very favorable for those startups, because for the first 2 million Hong Kong dollars of profits, we are only taxed at 8.25%. And then if you have an operating profit which is about the 2 million Hong Kong dollars, they will be taxed at 16.5% on the operating profit, and which is comparably very like favorable compared with the other developed economies. And in addition, we also have a very vibrant startup ecosystem in the Hong Kong market. For example, you can actually see that we have more than 4,000 startups in Hong Kong in the year of 2024, which means that like there's definitely plenty of opportunities for the startups to further like thrive as well as to grow in the Hong Kong market. And for the startup ecosystem, it is also very important for you guys to get connected with different sort of like potential partners. And then that's also like a very good ecosystem for you to like kind of like reach out to the market and then speak with relevant people. And then I would also like to highlight here that like when you are conquering the Hong Kong market, it is not just the Hong Kong market. We're also serving as a gateway to the Greater Bay Area, which is the southern part of mainland China, consisting of 9 different cities in mainland China, as well as Hong Kong and Macau. And in terms of the economy scale of the Greater Bay Area, we have more than 86 million population, as well as a land area of 56,000 kilometers squares, and a GDP of $2 trillion, which is equivalent to 11% of the GDP of mainland China. So in a nutshell, like for companies, if you're trying to conquer mainland China like as a whole, it can be slightly challenging because like in different provinces and in different cities, they have their own specific like kind of regulations from the municipal government, as well as different sort of like culture, as well as business cultures when like closing deals. So the southern part of mainland China is definitely a very good area for you to start. And then why Hong Kong is a very relevant part for you to start your business expansion in the southern part of mainland China is that like we've got different sort of like talents in the Hong Kong market. For example, say accountants, as well as lawyers, as well as investors who are very well connected with the mainland China's ecosystem, and they can give you some sort of like guidances about like how to set up your business in Hong Kong and how to structure your business, as well as like how to protect your intellectual property when you're doing the sales in mainland China market. And we do have a lot of like legal consultants in the Hong Kong markets providing you with different sort of like experts as well as advisors in terms of corporate structure as well as like business expansion. And in addition, we also have two very strong startups ecosystems in Hong Kong, including Science Park as well as Cyberport. And then they also have different sort of like programs helping startups which are already established in Hong Kong to conquer the opportunities in the Greater Bay Area. For example, say they organize different sort of like trade shows as well as exhibitions and seminars. And then those are actually like free for the startups to participate in those programs so that they can get a better chance to meet with potential business partners as well as investors in the Greater Bay Area. And then another reason why a lot of the companies are actually choosing Hong Kong as a base to set up their operation before they enter into the mainland China market as well as the other Southeast Asian market is that like for the legal system in Hong Kong, it is still very much based in the common law legal system, which is in line with the international legal practices. So you can actually have your contract being drafted in the under the common law contractual legal system, and you can have all those sorts of like business appreciation or mediation being conducted by the common law legal system, which a lot of the startups find it a lot more easier to navigate in terms of like closing deals and forming legal contracts. And in terms of priority sectors, that is very much in line with the previous company presentation during these sections as well. For example, say innovation and technology, which includes sustainability as well as healthcare, is definitely a focus sector of Hong Kong. Thus, the government has been deploying a lot of resources in terms of like providing funding to those companies, providing investment matching supports. And also new energy is another area that we're focusing on for developing. That includes, for example, say energy storage, the development of the electronic vehicles, as well as in the carbon reduction area. And healthcare is another key area that Hong Kong is developing very rapidly as well. And the relevance for the healthcare company is that like when, for example, say if you are conducting some sort of like distribution initiative for your healthcare devices, if it is adopted by the public hospitals in Hong Kong, it can very easily get the recognitions from the relevant public hospitals in the Greater Bay Area, and you can further expand your distribution network in the southern part of mainland China through establishment in Hong Kong. And then we also got different sort of like visa schemes to help you to further set your roots in the Hong Kong market, as well as to help you to conduct your business in Hong Kong. And then in terms of how Invest Hong Kong can be of assistance in your international expansion in the Hong Kong, Greater China, as well as in the Southeast Asia countries, like at your planning stage, we provide you with different sort of like guidances on the market updates in Hong Kong, relevant government policies, supports available from the government, as well as like different sort of like services providers like lawyers and accountants on your business setup procedures. And during your business setup procedures, we also provide practical advices on how to get your bank account sorted. And also like during your launch spaces, we also provide you with support on marketing as well as different sort of like networking events and industry connection opportunities. And we also have overseas office in 32 different countries. So I'll actually be next room for the rest of the day. So definitely keen to have a conversation with each and every one of you on how I can be of support for you guys in terms of like exploring the opportunities in Hong Kong as well as in the wider Asia market. And this is just a very brief overview on different sort of like government support which is available for the companies which are like that covers different sort of like development stages of the company, which includes like research and development, sales and distribution, as well as employment of talents. So hopefully that gives a brief idea about like what is available in Hong Kong, and then definitely look forward to stay in touch with every one of you. Thank you.
Thank you, Max. Before we continue with other panel discussions and presentations, let's have a small break of 15 minutes and see you soon.
So ladies and gentlemen, just while everyone's sort of coming back in, just want to do a quick 2-minute talk. I always get asked a question on how do we curate opportunities and sponsors and partners for this type of event. So I'll just keep it really simple just to help sort of answer that question. Basically, when we're having conversations, and this is every company that you're going to speak to at the conference, every exhibitor, etc., part of the things we're looking for is we're looking for companies that have teams which have been there, done that experience, right? So have they built and exited a business previously, or been involved in that process of the companies which they work with, or do they have experience in sort of companies which are, sort of at a global scale, etc. So on the team perspective, that been there, done that experience is super important. The second part is, are they in an area which is in high growth? So, for us at the moment, you notice that there's a lot of high yield opportunities because right now this is an environment where investors want access to yield. So as a company, we try and provide that by providing access to high quality innovation companies and also high quality high yield companies as well. And then the third part is when on the innovation side, we're looking for, effectively who has previously backed the company, who has put money into them. Sometimes the founders, if they haven't raised capital previously, the question we want to ask is how much have they invested of their own money into the businesses? And often it can be, 6 and 7 figures that they've invested into the business themselves. And the reason for that is because they have made their own money previously from their own their own ventures. They've backed their own business to the tune of 7 figures. One of them recently was like they've put in $5 million of their own money into this venture, and now they've got it to the point where they're happy with that sort of foundation, and now they want to scale. And then the next one is effectively who are their customers and what sort of traction. So if it's a B2C business, what sort of traction metrics can we look at, from a growth perspective? A perfect example of that. And if it's B2B. We're looking at how, do they have blue chip customers for their space in that area? And a perfect example of that is Directo. If you've spoken to Gavin, that's a perfect example of a company with blue chip customers, high growth metrics from a revenue standpoint, and in an area which is, high growth. So, that's just an example of some of the elements. Likewise, the presentation with the entertainment project this morning, where they've got licensing deals with the likes of Hasbro, etc. We do our best to curate it so that it's all, that aligns with those different aspects. So I hope that sort of gives some perspective on that. Now, we've got from a next presentation, so I'm going to do a quick introduction. One of the people that I've been fortunate enough to work with his companies going all the way back to 2012 is Mr. Greg Paramor in his company Folkestone. I watched Folkestone go from, basically a 20 to 30 mil small cap, right up to then being sold to Charter Hall. Greg Paramor is an absolute Australian property legend. We are super grateful to have him involved in this event. One of the key things about him is that they obviously do a lot of work with family offices and, and ultra sort of high net worths around Australia. The reality is there's probably very few, he's probably in that sort of select handful of people, maybe even at the top, in this country that's across all different aspects of what's happening in property. And he's obviously an incredibly well-connected guy. So to get his time today to give insights on what he's seeing in the Australian property market is something I'm super grateful for. So on that note, I'm going to give you an introduction. Please welcome to the stage Mr. Greg Paramor.
Hang on, what do I do?
Nothing yet.
Ah, there we go.
It'll show up on the screen, and then just the right arrow.
Thank you. Thanks, Steve. Good morning, everyone. Bit of an overstatement there, Steve, but we'll do our best. It's always good to talk about my pet subject, which is real estate, and something I've been in for the last half a century or thereabouts. So. And it still keeps on going, which is terrific. I think one of the interesting things about property, which gets a lot of attention, a lot of column inches in papers and a lot of stuff on socials these days and everything else, who's bought what and who's paid what for their house and everything else. It's such a fundamental industry, which is why I think I like it, because I'm a pretty average bloke and I got my feet on the ground. I'm not very smart, so I sort of staggered into real estate about 50 odd years ago and just really loved it because it's such a basic thing. We all need real estate. We're sitting here in a room that's got an economic return. We go home to a house, it's got a roof on, it's got an economic return. We're in factories, we're in shopping centres, we're in hotels like this one, and everything has a yield attached to it, a return, it has a life expectancy, it depreciates, it needs to be redone, and it's what we all have to use. And we're very lucky to be in a country like Australia because we're not confronted with horrible things that happen in other parts of the world where there's massive sovereign risk, there's risks to life as well, as we know, tragically at this time. And we live in a country that's got very good laws, great ability to own. It doesn't exist in a lot of places in the world where you can actually own something like real estate and keep it and trade it and do all sorts of things. So I'm just going to give you a quick run through. I've only got a few minutes, I understand. The thematics, and incidentally, I'm on the board of Charter Hall, which bought my last business, and I'm the chair of the investment committee. So a lot of this comes from, it's our house view as well as Left Field Capital, which is my own private debt business that we put together 5 odd years ago, and that's something we attract capital from people like yourselves to invest alongside us. So it's a dual thing. So the thematics. The outlook has shifted dramatically in the last few years. If we go back to 2008 and 9, when the GFC hit, we've seen interest rates come off basically down to zero. Real estate is heavily correlated to the bond rate, and when interest rates are high, then we lose value. When interest rates are very low, we saw this phenomenon right over the last 10, 15 years, where we've had a steady increment in value caused by capitalisation rates, yields coming down to lows that I've never witnessed in my life and most people haven't. So prime yields for industrial, for instance, that used to be in the 8s got down to 3 and a bit, 3.5%. Commercial office buildings that were in the mid-5s to 6% range for literally decades got down to about 4, sometimes a little less. Retail, which has always been at the top of the list in terms of performance, suffered from a number of issues over the last decade, and particularly around COVID, which spooked a lot of things, and the change to e-tailing as well as retailing. But we've seen with the end of the interest rate cycle and the interest rate stabilising and now starting to come back a little bit, we're starting to see the bottoming out of the commercial real estate cycle, which probably bottomed out or was in the last 6 months. And that's been good, so that we've shifted from pessimistic to the more favourable as global central banks have started cutting rates. We remain a safe haven for those people in the world for the reasons I've just mentioned. Sovereign wealth funds like Australia and the Asia-Pac regions, we're number 1 in terms of where they want to put their money. Japan's number 2. There's abundance of capital for both equity, that's property ownership, as well as the debt side. All institutions have an excess of capital waiting on the sidelines for the right deployment into real estate investments. That's from around the world. A couple of little exceptions. They're very skittish about the Victoria at the moment with Melbourne because of the issues with the government there and the taxes that they're burdening property owners with. There is pretty much a chronic undersupply of all forms of real estate investment, including residential, across Australia at this time. Why is that so? Well, we just stopped building things. And with the situation with COVID in particular, which caused a lot of factors to cause a lack of ability to build, we find ourselves with rapid rapid growth in population that we're well short on just about every metric. The transaction activity is getting stronger. A couple of years ago, at the height of what I'll call the real estate recession, particularly in the commercial space, there weren't any transactions, so it's very hard to judge what the value of an asset is if nobody's actually putting offers on the table or accepting offers on the table. But we've now seen transactions starting to kick in, both at the prime end of the market and right through across the board. Artificial intelligence, as a sideline, is a really interesting addition to the real estate markets in a lot of ways. We're all using it now. Even I got onto ChatGPT the other day and pressed a few buttons. My wife actually sent me a nice poem for an anniversary that I'd forgotten just recently, and I thought, my God, that's an amazing. Kerry's not bad at writing, but this was phenomenal. And I found one of my sons had been home from Europe, and he taught her how to do ChatGPT. So I got this rather nice little thing. But the interesting thing with all this is the need for storage of information, and data centres, just as a side, have been in the public eye just recently with a recent float, which probably didn't go as well as they would have liked, and there's a couple of reasons for that. But data centre growth, you might have seen Goodman going heavily into that, and just the other day raising another $4 billion to support their push into this for their industrial land. It won't be huge in Australia, it's already quite large, but it just is huge in the US and Europe and other parts of the world. The need for storage, and interesting enough, the need for power for those storage. There's a data centre just out here at Mascot, which is owned by a large US REIT that specialises in data centres. It uses the equivalent of 220,000 households of power use per day. And that's just one lot of centres, and there's myriads of those now popping up all around the country and indeed the world. So we talk about energy crises, we talk about converting to renewables, and yet the need for power is just on a curve that's very, very steep. The preference on the institutional market for what the survey, which is done every year, this is 24, so pretty current, on where the institutions are looking to invest, and I guess we as individuals tend to follow that either by investing through a lot of institutions and or our own investment, follow, I guess, where the market's going. Residential's number one by far. It's a little different in Australia. We've got a thing called build to rent, you might have been observing, which is, in my opinion, a very small part of the market. It has a very small need in this country. We're totally different to the US and the Europe, the way we house people and the structures around those. You have multifamily being what BTR is called in the US, and that's been around for 50 years. It's mainly to house workers. Big factories get established. They want to hire 10,000 people. They want to house them somewhere. The municipalities compete for those workers and those plants, et cetera, et cetera. So it's a very efficient system over there. Whereas here it's very expensive to build. It's vertical as opposed to horizontal. But nevertheless, institutions are very focused on the residential, and there's a myriad of different things, from build to rent, student accommodation, multifamily of all sorts, boarding houses, NDIS, etc., a range of things. INL, which is industrial and logistics, is next on the list, and then life sciences, data centres and healthcare, and student housing. Conference I went to a couple of years ago in Europe, EDS beds, sheds, and EDS beds, sheds, and meds. So you had medical, student accommodation, sheds being industrial and logistics. That's all that people were talking about. They didn't want to talk about retail. That was that was never going to recover. They were never going to talk about office. That had gone. Everyone's working from home. And they certainly weren't talking about hotels. Just a couple of insights. The office market has recovered significantly here in usage. So we went through COVID. We all worked remotely. We all worked from home. And in most cases, and you'll pick this up in the press, people are returning to work. Why are they returning to work? It's very hard to run a business with people working remotely unless they're specific types of businesses. IT people tend to do it better than most. Why? They've got the technology and that's what they do. They communicate through a machine. But most businesses require an interaction between the leaders of the business and the people working in those businesses and the training of those people and the interaction with the clients, etc., etc. So with the exception of Victoria, all states are pretty much now, I'd say 80 to 90% return to the office, and you'll see more and more companies insisting. First of all, it was 3 days a week, and now it's sort of 5 days a week. We expect you to be at the office. That's what we pay you to do. We want you to be there. We want you to interact with people. Productivity started to plunge a couple of years ago because of that. The public sector is the one that doesn't like going back to work. I have a reason for that. They don't work anyway, so why bother? I reckon if we just sent the paychecks home to them, we'd save a lot on public transport. We wouldn't lose any productivity because I'm not kidding. They do not do a hell of a lot, most of them. And they just employ more, they put more and more on the payroll. You saw in Queensland, I think it was another 50,000 workers just put on, with Pallas actually saying, well, it's better than paying them a dole, they may as well turn up here. And that was a statement she made. So all that is coming about. And the interesting thing in the office market, there's been a move really to upscale yourself in terms of what the tenant requires and what their people require in accommodation. End-of-trip facilities, bathrooms, where to store your bikes, all those sorts of things, breakout areas, a different way of working, if you will, and that's always been the case, that it does evolve. We've moved from a very tight, up to about 8 square metres per person. It's now up to probably about 12, so people are needing more space. They want more area to be around. COVID taught us that we shouldn't be too up close and personal. And they're insisting that the quality of the buildings, the energy, all the ESG components are there. ESG, as I mentioned, remains core. They're insisting on that, and technologically integrated buildings are absolutely in demand. The secondary market, which, if you look at the graphs, you've got a take-up in prime and A-grade space, and B and C-grade space is falling away. That space will be recycled over the next decade. Most of those buildings won't be torn down. The embedded carbon in these buildings is huge. It's not regulated yet in Australia, but it is in other parts of the world. We actually can't tear buildings down because of the actual carbon that you're putting back into the atmosphere effectively. So that so you're going to repurpose these buildings. Most of it won't be for residential because office buildings and resi aren't normally compatible. There will be some, but they will be repurposed. They will set another level of accommodation, and that will occur over the next decade. And some of the buying in that area is not too bad. Industrial and logistics, which I mentioned, structural drivers of demand has been huge. There's a whole bunch of factors around that, from technological advances, the big warehousing now of all the Amazons of this world, Coles, Woolworths, Audi, you name it. The people that are using large space areas are requiring very sophisticated equipment in their warehousing. There's very few people working in these buildings. It's all automated. So somebody's in a control room, machines are running around. It's quite amazing to see. And that bifurcation is once again to that high-end new standards is gathering momentum. Interesting enough, the yields on industrial just a few years ago got down to net yields of 3.4, 3.5%, coming from a high, which I mentioned earlier, of 10 years ago, about 8%, and it was down around 5, 6, and that meant the values went up dramatically. Where office values have fallen 30%, industrial hasn't fallen that by that extent. It's only been a few percent because we've had huge rent growth, because there's a huge shortage of the suitable accommodation. We have the lowest vacancy and highest rental growth globally in this sector, and there's insufficient zoned land in this area. Once again, the biggest issues we've got in this country in terms of being able to develop enough housing, enough industrial, enough, not so much office, but retail, is the lack of zoned land in the right areas. And believe it or not, this still exists today in a land of 7 million square kilometres. You'd think they'd be able to get some organised land available, but believe me, it's in short supply. Retail, shopping centres, both super regionals, which have suffered quite a lot in the last decade, the Westfields of this world, which is run by Scentre Group, Vicinity, the super regionals have suffered where they used to have yields of around 5%, they blew out to 6.5%, 7%. A lot of vacancy occurring in those buildings as people moved more as treating them like showrooms where you might have gone and looked there but you order online. So what has really, and where we've played a lot, is in the convenience retail. That's going to your local supermarket. You might have 1, 2 or 3 or 4 trips a week, or some cases more, because you just go buy what you want today and move on. And that has been a very steady performer over this time. The yields were in the 6 to 7% range. They're still in the 6 to 7% range. There's a lot of demand for space. There's a lack of zone space and there's a lack of development at the moment for a couple of reasons. Coles and Woolies in particular have got very gun shy because of the attack from the ACCC in particular, and they've been diverted, their attention's been diverted elsewhere. And the cost of construction has been very high, which has caused a slowdown in availability of product. Population growth, which we keep on hearing has to slow down. I don't think it'll slow down much, and I don't think it'll slow down for a very long period. We've always been a big net intake of people from the rest of the world the last few hundred years, and I can't see that slowing down. It's a moment in time. It's been caused, I guess, by COVID and then the great influx of people coming back. Because of a shortage of housing, there's been a clamour that we've got to stop immigration. That's not going to solve the problem at all. We have a huge problem with suitably qualified labour, which is causing massive strains in just about every industry that I'm aware of. So that means that people need retailing. And yes, you do some online. It's about 13-14% of sales are online. It could even grow to 20%, may even go a bit higher in time, but you'll still see a need for convenience retail in all its forms, including normal shopping centres, normally anchored by Coles, Woolies, Aldi, etc., and more further convenience with service stations and the like. The living sector, that's residential in all its forms. The federal government has said we want to build 1.2 million homes over the next 5 years. That's absolutely impossible to do, incidentally. We don't have the labour, we don't have the skills there to do that, we don't have the infrastructure to do it. And at the moment, with the amount of infrastructure on government purse, that's our money going in infrastructure, about $700 billion around Australia at the moment, there's a chronic shortage of skilled labour who are being soaked up by that in particular because they're getting higher wages, and they're taking advantage of that. But there's very low vacancy. Once again, particularly in this state, it's interesting. The Feds say we're going to throw all this money at this problem, and we're going to get this all out the door. The biggest issue is they don't control planning. The local government controls planning and the state has an overlay, and until that gets sorted out and the three areas of government start working together, we will not solve that problem. It's been around for a hell of a long time. I've been hearing about shortages of accommodation in various parts of Australia all my working life. It'll never be properly solved, but these days with the planning problems we have and the delays in getting things approved, to get a development approval for a stock standard house in most councils in New South Wales, in Sydney in particular, takes over a year. And this house is going on a 450 square metre block, or a bit larger or a bit smaller. It's bog standard, it's what everyone's got, and yet they will delay you by up to a year. That's at least another 5 to 7% in cost that you're going to wear because of that. If you've got a complying development certificate, that means it sort of fits into a box and you can get a certifier to sign off. That used to be 4 to 6 weeks. It's now about 6 months. So once again, you just simple things. Just add on another 3 to 5% on your cost, because these things go up in cost every year a bit higher than inflation. That's the way it's worked. So we've got a chronic problem there. The opportunities are, of course, if you can put your hands on land, if you can put your hands on good, well-located residential, you're probably going to do pretty well, particularly in a town like Sydney, where over my journey it's gone up in growth about 6 to 8% per annum. That's changed a little bit now because a lot of apartments are probably a little less than that, but once again, where it's located, what it offers, we'll either keep it at the higher level, which is up towards the 8, or the lower level, which is down around 4. So, in conclusion, we are a safe haven for the rest of the world. That means that the institutional market loves us. That means that these major assets that we see as soon as we walk under George Street are well bid for. Charter Hall just sold a building that I'm a tenant of, actually at 333 George Street, just before Christmas, at a yield of about 5.5%, $400 million. That went to a German fund that has been investing in Australia for the last 30 or 40 years. The real estate fundamentals are very sound indeed, not without issues. Debt is hard to get, bank debt's even harder to get. Building costs are going up, all those things, all those winds blowing against you, but the fundamentals are good. We don't have an oversupplied market. What that means is in time this all gets sorted out and there will be sound returns coming out of real estate. They're not boom conditions, I hope certainly not, I hate booms, but they're very steady conditions that are going to give us a good underlying runway to get good sound returns from your property, be it equity or debt. As I mentioned, left field, we specialise in the small end of the market, up to $20 million. We like that because it's not great big towers with huge risk. We back land, we back construction, we back residential, industrial, childcare centres, and any good commercial activity that we think we're happy to have our money invested in and our investors alongside us. So that's about it. I'll leave it there. Do we have time for questions? I'm not sure, Steve. If there is, I might as well. Are there any questions? Take that as a no. Thank you very much.
Thank you very much, Greg. Next, we have Evan Thornley, the CEO of LongView. He will be sharing how smart data is changing property investment. Welcome to the stage, Evan.
Thank you very much. It's an honour to follow a doyen of our industry, Greg. Thank you. There's a lot of really sexy, interesting tech, venture, crypto and other things that you'll hear about today. I come from that world. I put the first Australian tech company on NASDAQ 20 years ago. The first tech unicorn, took it to 14 billion in market cap, which was real money in those days. And then the challenge is to preserve your wealth. And that's why I got interested in property. I want to take you through something which I think hits the heart of the missing middle of most of your portfolios. If you want to put 2% of your portfolio into crypto, knock yourself out, or 10% into venture and PE, you'll have some cash, you'll have some fixed income. But I think for most of us what we're trying to do is compound our money in the low to mid-teens, quadruple our money every 10 years with a minimum of risk. And property potentially provides that opportunity. And residential property is one of the stablest asset classes to enable you to do that. So what I'll take you through today is how we can allow you to use the stability and growth of residential property to deliver mid-teens returns with what I think you will acknowledge is a lower risk stack than the alternatives for that missing middle of your portfolio. I'm not saying you shouldn't invest in equities or private credit or other things. They're all worthy and I have money in those too. But for meat and potatoes, mid-teens returns with low risk, A portfolio of $2 million family homes across Sydney, Melbourne and Brisbane is about as low risk stack as you can get. You sit there and watch grass grow while these things double in value every 10 years. So let me take you through that. LongView, the business I've been building with my partner Anthony Cohen for the last 10 years, we do nothing but residential property. We don't build it. We focus on the existing homes. Every property market in the world is a trade-off between capital growth and rental yield. The capital growth is largely in the land, the rental yield is largely in the building. Australia is the best capital growth market in the world, Australian resi, and as a consequence, very low yield. So if you want to make money in Australian resi, in family homes, in that biggest asset class in the country, you need to learn how to harvest capital growth. And so the missing middle in the property investment market in this country is the ability to invest in existing family homes. There's every layer of the capital stack available for you in new home construction, whether that's equity in the big home builders through to, prime, mezz debt, everything else in between. That's 3% of the $11 trillion in resi. New home development. That's essentially a manufacturing business where you hope to sell things for more than it costs to make them, and if you do that well, you make good money. If you don't, things can end badly. Huge risk stack in there, construction risk, financing risk, market risk, weather risk, the CFMEU, and God knows what else. What you don't have investment grade opportunities for right now is quality family homes on well-located land. The only way you can do that is what almost everyone in this room does, which is own one and live in it, which is one of the better investments you're going to make, risk adjusted and tax adjusted, or sometimes being a landlord. Now at LongView, we're probably the top ranked rental property manager in the world, in the nation, I won't say the world. We've won 11 state and national awards helping 4,000 landlords rent out their rental properties for the last 10 years. And as a consequence, we know that that's a lousy way to invest your money in quality family homes. You've got land tax, you've got vacancy, you've got maintenance, you've got lack of diversification, you've got all those things. So no one knows better than LongView the challenges of being a landlord. We do a better job of looking after landlords than anyone else, but for the last 4 years we've been taking that knowledge and my skills from, and Anthony's skills from, McKinsey and Silicon Valley and saying, how can we make this work better? How can we give you access to the $8 trillion that is equity in Australia's family homes and turn it into an investment grade asset class and deliver mid-teens returns with remarkably low risk? Just to kind of qualify that for you. Let's be clear. The capital growth, just the capital growth, not the underlying value, not any rental yield, nothing, just the capital growth in Australia's family homes and Australian residential property last year, this year and most other years, as Greg outlined, is the same size as the entire federal government budget. That's 4 times the size of all the earnings of every company on the ASX combined. And yet there is no investment grade fund to give you exposure to capital growth in family homes. You've got to do it all one by one, like my 4,000 landlords. So that's what the LongView Home Equity Fund is doing. Giving you exposure to a diversified portfolio of quality family homes to deliver mid-teens returns at low risk. Let me explain a bit about how we do that. We've got a data science team. This is where the Silicon Valley side comes in. We've analysed every sale price of every individual property in Australia for the last 50 years to figure out where the capital growth is and where it isn't. All boats do not rise. Greg mentioned quite correctly, new build apartments, for example, just catastrophically hopeless capital growth and actually pretty low yields by global standards too. You'd be better off in the Sun Belt of the US. Okay, simple reality. 1/6 of all the residential properties in this country generate half the capital growth. I'm not saying there aren't others where you can make money, I'm just saying let's fish where the fish are. And I'll tell you where the fish are because you all live in them. The quality family homes of Sydney, Melbourne and Brisbane, what we call Rodwells. Robust, older dwellings on well-located land. Okay, land appreciates, buildings depreciate. This is not complicated. So if you can invest in those quality homes in good locations where the land value underneath the home is the guts of what you're buying, that's what's going to grow in value. And it's grown in value for over 100 years. Why? because of our unique demographic structure and the unique economy, as Greg outlined, that we've built around it. We have the second highest population growth rate in the world. And we concentrate that population growth almost entirely in just 3 urban centres, Melbourne, Sydney and Brisbane. And what that means, as Mark Twain would say, they ain't making any more land. If you stick an MCG and a half worth of people in Melbourne every year, 160,000 people, then funnily enough, the value of well-located suburban land keeps going up because they've got to live someplace. Same in Sydney and increasingly the same in Brisbane. So those Rodwells, I've trademarked that by the way, those Rodwells of Sydney, Melbourne and Brisbane, that's a massive investable universe for us. That's about 1.7 million homes. There's no shortage of assets we want to invest in. And if we invest in these, they're remarkably stable. You know, peak to trough, Australian resi prices have never dropped more than 12%, and that was over a leisurely 2-year period and picked it up in the third. And that is since the one and only actual housing crash this country's ever had, contrary to popular mythology, and that was in 1893. So it's been a while, okay? This is a long, steady climb. It's a long, steady climb when interest rates are up and interest rates are down. It's a long, steady climb with or without negative gearing, with or without Chinese money, with or without all the other things that people think impact house prices, because while all those things have some impact, the dominant impact by between 2 and 3 orders of magnitude is the impact of population pressure on the land underneath the homes. So, the LongView Home Equity Fund invests in quality family homes. We've currently got 64 in the portfolio, so that's roughly $100 million worth of property, so the average is a little under $2 million. These are not fancy, they're not full of gag-in-our kitchens, they're just quality family homes in good locations, the sort of homes that many of you live in. 78% of the value of these homes is the dirt underneath the home. Okay? I'm not getting up at 3 in the morning to see what happened in New York, right? I'm not worried about weather risk, finance risk, construction risk, market risk. I'm sitting here watching grass grow while these babies double in value every 10 years or better, okay? So that's my risk stack. Okay, well that's amazing. Normally for that risk stack you'd expect mid to high single digit returns, so why am I claiming 14%? Let me explain our mechanism. This is where it gets interesting. This is where we try and bring a bit of Silicon Valley and McKinsey innovation to a centuries-old asset class. We're not buying these homes and renting them out. We're co-investing with the people that already own them. We're co-investing with homeowners in their family homes. So precisely because we've had such phenomenal capital growth, a huge number of Australians have got serious wealth, but all of it's under their backside in their home and inaccessible to them. And so for many of those people, and our clients are midlife, 45 to 59 typically, they'd like to get hold of a bit of that money to do something else with it, to invest in their business. Typically is the biggest cohort we have. People who want to put more money into their small business because they reckon they could get a better return growing their business. People who want to be the banker mum and dad for their kids. People who will be staying for another 6 or 7 years till they downsize and they'd just like to give the place a bit of a zhuzh, put a couple of $100 into a little renovation. People, sadly, and this is a huge need set, I'm sad about, but it's actually, I'm proud of what we do. A lot of folks going through divorce, you get there, the marital asset pool is too concentrated in equity in the existing family home. If one partner's hoping to stay in the home, often with the kids, they can't afford to buy out the other partner. That's bad for everybody. Now, if they can get access to some of that equity, as some of our clients have done, they can buy out the other person, they can get on with their lives, they can stay in their home. Okay, so that's why people take our equity. We're not a bank lender. This is not interest. I don't have 47 armies of bank lawyers finding 15 different ways to throw people out of their home or tell them what to do. This is their home. We just want to participate in their investment in their own home and give them access to some of that capital that they can use for a better purpose, while they give us the privilege of riding alongside them. And there's 2 elements to that that allows us to deliver mid-teens returns, despite the fact that we have no debt. We have none of those other risks. And that is this mechanism. So the first thing, which should be obvious to you, but for any of you refugees like me from the People's Republic of Victoria, it will be even more obvious. If 78% of my value here is land, then that 78% is going to get massacred by land tax, right? If I bought these homes, even if I bought these lovely $2 million family homes. But these are the client's principal place of residence. And while we have a second mortgage security that guarantees our contract, we're not on title. We don't interfere with their ownership. We don't interfere with their principal place of residence exemption, and we ain't paying no land tax. So just right off the bat, compared to being a direct owner or landlord of any of these properties, you're 265 bips better off per annum by investing through shared equity than buying the exact same assets as a landlord, let alone you're not paying maintenance, you're not paying rates, you're not paying insurance, you're not paying any of that stuff. The client was paying that anyway, it's no loss to them, right? So that's a pretty good start. The second start is, okay, we are friendly money. We don't have an army of banking lawyers chasing people down and telling them what to do, making sure the bank takes no risk and the client takes all the risk. We're sitting alongside the client. What do they do for us in return? They willingly give up a disproportionate share of something they don't yet have, which is their future capital growth, money they don't yet have. So a typical deal is we'll write an equity cheque to the client for 10% of the value of their home, and they will give us a 1/3 share of future capital growth. So those of you who can do math can understand that that's a 3.3x multiple for us. So if the underlying asset is doing 7 or 8, or sometimes better, annual capital growth, we've got a 3.3x multiplier against that. So that's what I call leverage without debt. Normally, to get that much leverage on your equity, you'd have to borrow 75% of the value of that home and be paying the bank and have the risk and cost of the debt. I've got no debt. I've got leverage without debt, 3.3x times on high growth assets. So we have leverage without debt, we have land without land tax. So when I say we can meet your needs for the missing middle of your portfolio for mid-teens compounding returns on a risk stack that's watching grass grow, that's how we do it. You cannot do this yourself. I honestly don't believe that you will buy better assets than we can buy with our data science team, with our 20-year qualified buyers advisors who've typically bought 1,000 homes in every one of these locations, who scrub every single asset before it gets to our investment committee. But even if you could buy the same quality of assets, even if you had enough money to buy this volume and a diversified portfolio across Sydney, Melbourne and Brisbane, as we have, you'd still make 400 basis points less return on those exact same assets if you were the landlord than if you were an equity co-investor with the homeowner. So that's how we do it. Most people get the math on that pretty quick, and they have just one question for me. Okay, you don't control the exit, so what's the cash flow for me? It's a very sensible question. Let me take you through that. There's a one-word answer to that, which is portfolio. If it was just one home, you'd have a whole lot of what I call tenure risk, right? Maybe they'll stay 2 years, maybe they'll stay 50. But once you've got a portfolio of hundreds of homes, and you can see this in the US. The US has got a huge home equity investment sector that's grown in the last 10 years. You've got 3 or 4 big players and 7 or 8 smaller ones. They've got 10,000 plus homes. Right, they've been delivering 17 to 19% returns to their investors. And frankly, there's a lot less good capital growth in the US than there is in this great nation for the reasons I outlined. They're securitizing the back ends of the book. So this all works. This is a closed-ended fund. The reason we've done that is not to keep your cash from you, but to get it back to you quicker. Because there's 2 ways you get your money back. Either the client sells their home, and many of these clients will be selling their home in a few years, or they buy out our contract, and particularly as interest rates go down, house prices go up, that's good for us. The cost of buying us out goes down, so that's good for the client. So like in the US, where the home equity funds, 50% of them get their money back from clients buying out the contract, 50% come from people selling the home. And because we're with midlife homeowners who are going to be downsizing anyway, both of those things drive cash flow. So we don't recycle capital for 2 years, but after that, every time a contract is realised, either through sale or buyout, that's packaged up every quarter and returned to investors. So that actually creates much stronger cash flows than you would have as a direct investor. It's a self-liquidating portfolio. The churn of contract buyouts and home sales actually ends up generating, we think initially 15+% money on money returns and then growing. At the end of the closed-ended period, whatever's left in the portfolio, which in the US has typically only been 5 to 10%, we're assuming here it'll be higher, but we want to be conservative, that tail of the fund then gets rolled into a new fund, or securitized off the back end or debt finance, and the investors get the rest of the money out. So that's what we do. That, I think, gives you access to a meat and potatoes asset that you all understand through a unique structure with a highly diversified asset pool to meet the needs of the missing middle of your portfolio. So I know that'll raise a whole bunch of questions for you, but we think this sector is likely to grow phenomenally in this country over the next 10 years as it has in the US, and frankly this is a better market. But our team's at table 13, or grab the QR code, and we look forward to meeting those investment needs for you. Thanks very much.
Thank you, Evan. I'm going to try really hard to say it correctly. Now let's welcome Matthew Jafarzadeh from CosmoInnovations. They offer safe and painless beauty solutions using advanced LED light technology to refresh and renew your skin. Matthew, the stage is yours. Thanks.
Hello, everyone. Thank you for giving the opportunity. We've been listening to all different great speeches about property and the houses, and what I'm going to present is what exactly happens inside the house, inside home, which is personal care. So amongst you, I'm sure that there are a lot of people that are using their normal daily routine skincare application, or sometimes get a bit of facial here and there, a bit of laser resurfacing to improve their skin's quality. So as a senior laser practitioner and esthetician for over 25 years, I have noticed that many of us, we make a common mistake on a daily basis by applying manually skincare on our skin. First mistake that most of us do is just transmitting the germs from our hand onto our skin. A second mistake could be the absorption of the actual skincare into our hand, that about 12 to 20% of the skincare can be actually infused into our skin. So that is the total waste of the skincare. And thirdly, as we apply the skincare, we get more absorption onto our face. On the top layer of the face, as we go down, is obviously less quantity and you get less absorption. So it's a bit of a hit and miss and a lot of inconsistency in terms of the absorption of the skincare into our skin. So one of the main reasons that most people try to avoid going to clinics and salons is obviously the cost of the actual procedure, is the multiple visits to the actual salon, time, side effects, pain, cross-action with other treatments, and so forth. So we have developed a unique technology, which is the one in my hand, called SkinGate. So SkinGate is the only technology that carries skincare capsule inside. So we have a 15 ml skincare capsule that is inside the device, which is part of our IP, similar to the same concept that Nestle has developed nearly 10 years ago by developing a small, relatively low-price coffee machine, and then started to sell the capsules. So you insert the capsule and you serve your coffee. And that's the same concept, that we developed this special skincare that can be inserted into the device. So the device has several features. The first feature is a skin analysis that in 5 seconds it can detect skin's oil level, moisture level, texture level, and the quality of the skin. And by pressing a button, we get 0.25 cream coming out of the device, which is enough for one side of the face to be treated. And then we get a combination of radio frequency, iontophoresis galvanic, which is a scientific way to change the polarity of the skincare versus the skin. So the actual skin gets infused into the face by using acoustic vibration, heat, iontophoresis, and dual wavelength LED. So one LED wavelength is designed for pores reduction and collagen stimulation. And if someone suffers from acne or rosacea and redness, they can switch to a different LED light to improve their skin quality. So this virtually uses a multi-modality, and here is the actual skincare capsule that I've just... and the next stage of our development is to incorporating AI that by taking a selfie of your skin, the phone will pick up the imperfection on the skin, and then simply, if someone has, for example, acne, you just press on the phone, and then it recommends you a series of skincare that is designed for my skin, and simply you can go to e-commerce and order those capsules that can come to your door to apply those creams accordingly. So we've done a very intensive clinical trial on SkinGate, and the result has been far more surprising as opposed to other commercial technologies that are currently out there in clinics. Normally, commercial products or equipments are anywhere between $20,000 to $150,000, and patients can leave the clinic with a lot of scabbing, redness, pain, and obviously quite a big fee that they will be expecting at the door. So with our technology, this is very simple to use at home. The actual device is totally non-invasive, pain-free. You only need to use it for 5 minutes on each side of the face. Let's say for the first 10 days, you use it daily, and then twice per week, and maybe once a week afterwards. You can see some more impressive result of the SkinGate. You can see quite a remarkable improvement of the reduction of the gels on each side of the face, the lines around the eyes, and the firmness of the skin, nasolabial fold, and overall improvement of the skin texture. So we can see here that there is quite a bit of improvement in terms of the skin quality enhancement that we've achieved. You can see a minimum 20 to 50, 60% in texture, quality, hydration, and longevity. The hydration of the skin, it can last between 2 to 3 days because it really pushes the skincare deep enough into the skin that doesn't let the moisture to get vaporized and wasted. So in terms of the competition in the market, we are quite in a very good position as opposed to other products that are currently in the market, such as Perfecto Zero Gravity, which is purely just a skin care device with LED, and that's sold online for over $8,000. Then we have a L'Oreal device that mixes a series of cream or makeup, and simply it just projects a few drops of the makeup that is used or cream for the user, so there is no modality to actually transmit the product into the skin. The next one is No Face Trinity. So No Face is a very big competitor, and they've been around for nearly over 6-7 years, and their devices is sold between $700 to about $1,200 USD in the market, and that is purely radio frequency for transmission of the active ingredients into the skin and lifting. And finally, we have Miss Arrivo, which is quite expensive in terms of the price. So after we evaluated the device, we are now doing a second revision of the device, which is one device with multiple applicators. So now we are going to have a skin scrubber for cleansing and exfoliation. Then we have, this is the default, the second one to the right is a default device that comes to the market, and then different heads can be purchased. $870 USD is what we're thinking in terms of the retail price, and then $150 per head. So at the third one, we have scrubber for cleansing and getting rid of the debris. And the last one, we have a device for hair loss, which infuses the hair serum into the skull, as well as a special wavelength for hair restoration and coloring of the hair. So the hair color capsule can be infused into the device and can help with those who want to dye their hair, and the root of the hair can easily be colored. So from $35 billion market, now we are targeting $160 billion market. So in terms of the market reach, is quite a significant market. We're looking at over $65 billion, and we are here to raise 2.6 million to finish the sales and marketing and distribution of the current technology, as well as finishing the second version, which is the Pro version that I've just shown you, along with 3 FDA submissions for acne, hair loss, and wrinkle reduction. And you may have wondered that why am I wearing 2 watches? And this actually is not a watch. It's a different device based on the skin gate that we are going to develop soon. This is called skin gate infuse, which is designed for transdermal drug delivery. So soon we will be able to have metformin, HRT, medicinal cannabis into the actual watch, that by using iontophoresis galvanic, acoustic vibration, ultrasonic, can push the actual drug into the thin skin and your blood can carry it around. So we actually presented this at the APEC Met Innovator in Singapore, and we won the international award for this, which is going to be the next step of our growth journey. Once we go commercially successfully, then perhaps we can start working on this watch. If you'd like to find out more about this amazing multi-billion-dollar venture, please come and meet me at my booth number 23. I will be very happy to help you with your questions. Thank you. Thank you.
Thank you, Matthew. Next, we have CleverCow. They provide verified Australian carbon credits from sustainable farming, helping reduce greenhouse gases while supporting eco-friendly food production. Please welcome Mark Pert, the CEO and founder of CleverCow.
Good morning, everyone. Mark Peart's my name. I'm the CEO and founder of CleverCow, and I'm also the CEO and founder of DIT AgTech. So DIT AgTech has been a customer of Steve's here for many years. We've raised over $7 million from this audiences over the last few years, and CleverCow is a subsidiary company of DIT to solve a problem which is in agriculture, and that is the monetisation of regenerative farming. What CleverCow does is, it's actually the shop front. It's where consumers can buy verified carbon credits produced by sustainable farming through our network of farmers in small fractions on a subscription model. And these particular consumers are buying our credits now because they're environmentally conscious. They want to offset their own emissions footprint, but more importantly, they want to participate and empower our farming communities to continue to grow sustainable food while at the same time adopting sustainable farming practices. So our platform is up and running now. We only purchase carbon credits that have been produced under verified standards, the Vera Gold Standard or the Clean Energy Regulator. All of the credits are also then fractionalised, and using blockchain and tokenisation, we then break these credits down and sell them to consumers in small parcels for only 80 cents a day, but at the same time they're only buying like 80 kilos a month. As you all know, agriculture has a large emissions footprint, and the biggest problem with agriculture is methane from livestock. Now, livestock are very important in our society to produce protein, as you know. But at the same time, it's a problem that needs solving to reduce methane. And at DIT, we actually have the technology now that we've deployed where we're administering methane-reducing additives into the drinking water. And CleverCow then buys these methane credits, fractionalise them, and tokenise them, and we sell them to consumers. Where the farmer may only get $30 a tonne for a carbon credit, CleverCow pays them $100 a tonne, and we sell them to a consumer for between $250 and $300 a tonne, and we capture an arbitrage during that. The reason why we're not getting a lot of sustainable farming adoption is because there's no money to undertake these practices, whereas CleverCow now will enable our farmers to be able to monetise and make some money from it. So how it works. So the DIT ecosystem is there. Most of the methane credits that we produce come from our water dosing technology, where we have a approved Vera project over our platform. So it's as simple as this. A cow or sheep drinks out of the trough. They consume some of these methane additives like the seaweeds, essential oils, Bovaer. DIT's agnostic to those. We produce a carbon credit. and these carbon credits are then sold into CleverCow. This is the platform that's working right now. Over 500,000 head of cattle are on our platform at DIT now. And this is the raw reality of ag tech working in the bush. Cattle drinking the water that's got agalin in it, which is an approved methane reduction additive. It's an essential oil. At this point in time, agalin is the only additive in the world that's approved to reduce carbon or reduce methane and to enable a farmer to produce a carbon credit. This is the platform. This is the tech at play at DIT. The animals are consuming the water, and in the back end here, our software is calculating the emissions reduction per head and producing data sets so they can be audited so that the credits can be issued to the farmer. As you can see here, this particular platform, in the lifetime of this dossier here, has produced 467 tonnes of CO2 credits for that farmer. CleverCow is a really simple way for everyone to participate in climate change, while at the same time it allows consumers to invest back into our healthy food systems. This is the platform. We're selling carbon credits now at CleverCow. We've built the platform. We're onboarding subscribers every day. It's as simple as clicking in, putting your credit card in, and you can start to participate and do something with climate change yourself. So you're probably wondering, how big is the market for this? If you're passionate about being purposeful in your life like I am, and you do the research, there's a very good report there with Deloitte that has just come out. They're forecasting that this industry will be a $100 billion industry by 2030. So already now we are seeing consumers all around the world wanting to participate in climate change and offset their own unavoidable emissions by buying fractions of carbon credits. We're raising up to $1 million in this round in CleverCow. As I said, CleverCow is a subsidiary of DIT. We've set it up specifically as a private company so that people can get in early. It's a seed round. The money will be used to help us to expand our marketing. The tech's built, the product's there. We're starting to create revenue in CleverCow, but this will allow us to market our platform globally around the world. And more importantly, get more consumers so that we can invest back into our farmers to adopt more sustainable farming practices to reduce carbon emissions and actually to absorb carbon from the atmosphere. Thanks very much for that, and if anyone would like to come and see us, we're at table number 3. I'd enjoy talking to you. Thank you.
Thank you, Mark. Now let's welcome Frank Yao, the Managing Director and Founder of Innofocus Photonics Technology. They specialize in intelligent laser nanofabrication equipment and holographic imaging systems, providing advanced solutions for both academia and industry. Welcome, Frank.
Good morning, everyone. My name is Frank Yao. I'm the Managing Director and founder of Innofocus Photonics Technology. So before I start with this presentation, let me introduce where we started from. We are a deep tech company established in Melbourne from early 2018. We started from design and manufacture laser 3D nanofabrication equipment for the scientific research markets. We've sold many sets of our equipment to the universities, labs, and research institutes globally, Australia, US, China, Singapore. We're selling it to France and Germany as well. So our leading technology in such kind of equipment has enabled us to be the world leader in the scientific research market in the nanofabrication. In the past several years, we also encountered with many many more fabrication requirements from the industries like the semiconductor industry, new energy, or material industry regarding how we can extend our capabilities of nanofabrication in the lab to the fab, meaning mass production, high yield, high precision, and cost effectiveness. So we have built a 1,000 square meter nano manufacturing plant. We call it NMP in the north of Melbourne. You're welcome to visit us in Melbourne. And that NMP, with its open labs facility, has helped the industries and the research institutes to collaborate together to develop more photonic optical devices, which are crucial to the future any kind of industry sectors. And today, my topic is our committed focus, quantum photonic chip. My pitch topic today is Australian-made quantum photonic chip enabled by nano manufacturing plant. If you look at the IT industry in the past decades of years, higher speed, lower power consumption, and a high bandwidth is always the requirement for the human being. However, if you look at the AI, all the computation power increasements especially in the past 3 years, there's a limit of the semiconductor business because it generates a lot of heat. The speed has a limit. So people are saying that Moore's law in the next 5 years will come to a limit because at the end of the day, it will be limited by the size of atom. What is the next? If we are building the ChatGPT, the DeepSeek, and all the AI, people need huge, much more computation power, higher speed, bandwidth, and lower power consumption, and without generating any heat. Photonics is definitely the answer. So that's why across the semiconductor industry, people are working towards what is beyond CMOS? Okay, the technology disruption. And also with the laser 3D manufacturing capability that we have, we can design and build nanostructured devices in a 3D shape with arbitrary 3D design. That increase the density, power, the capacity tremendously. Think about the 2D converts to 3D. CMOS, the semiconductor, is a 2D structure. Well, photonics is a 3D. So it's by its physical nature, it's disrupted the density of the transistors. And if we look at today's quantum computer, it's huge, it's massive. It needs chilling system, air condition. It has to be deployed in a very, very good condition environment, clean room, etc. But, miniaturizing is definitely the past. Think about that. We will definitely have not only the device, the computer in the cloud, but also with the wearable and, portable devices. So photonic chip is like this small. Okay, we scientists have already reached some prototyping, but, in terms of, scaling it into a commercialization era, a lot of benefits of the miniaturized devices is the need. So we say miniaturization is definitely the needs and the past. So the problem summary is actually how we can have some manufacturing capability to produce high precision, high resolution, high performance, and high yield manufacturing machine that can do this. Because every civilization of the human being is aligned with either find some new materials like silicon, or we have some new manufacturing capability. Like today, we're building the semiconductor. So what is the next? And Europe and US, China are all, really targeting at what is the next semiconductor. The answer is photonic. That's why Innofocus has developed the world's leading intelligent laser nanoprint 3D system with all these good features. Just give you an example, this is a hair strand, and we've built some nanostructure on top of a hair strand. So the resolution is about 100 nanometer, which is, one of the thousands of humans' hair strand thickness. And we didn't stop there. We have built a 1,000 square meter nano manufacturing plant in Melbourne in 2023. We've been engaging a lot of customers, scientists, and government investors in developing more and more capabilities. So recently, we are building or designing our industry-level manufacturing machine. We call it Nano Factory, not Nano Lab anymore. And we got market traction from Intel, NVIDIA, X-Space, etc., etc. This is definitely the path to go. We are a proudly Australian-made company, Australian-owned company. We got multiple awards because of our contribution to photonics industry. And recently, we are the Australian Innovation Competition winner, Australian Technology Competition finalist, and we recently got the Innovation Awards for Excellence winner last year. And this is our innovation path. Our DNA is keep innovating and stay focused. And this is the prototype of our quantum photonic chip we have already built. We are currently improving our QPC design, simulation, nano manufacturing, and testing characterization capabilities. So the market, the addressable market for QPC industry is at least 65 billion by 2030. And our addressed market in the fabrication testing is at least 25 billion. We believe we don't have many competitors at the moment, only one in Germany at the moment. So we believe if we have a 5% market potential, then that will be over 1 billion in 2030. Okay, so we are a profitable and sustainable company. In the last year, we got more than 3 million sales, and we got more about 1 million net profit before tax. And we are currently fundraising for 3.5 million Australian dollars to expand our facilities, human resource, marketing capability, and R&D. Using this capital, I believe we can increase our research equipment sales, improve our industry-level manufacturing machine launch to the market, and also encourage the team to develop the QPC prototype much faster. And with the fundraising we have, we are targeting at 200 year-on-year revenue growth in the next 3 years. And by our financial projection with our financial advisor and the legal firms, we believe in 3 years' time we'll have at least 4 million profit before tax. And we're currently working on a fundraising strategy on the listing of to ASX. And we welcome all investors to join this journey with us on either the first round of fundraising or the pre-IPO fundraising. So by that, I have taken this fantastic prototype of QPC photonic chip with me, quantum photonic chip. Come to our stand at number 5 to visit us, and I will demonstrate the real capabilities that we have. Before I go, just a 30 seconds video on how we design and fabricate this QPC. Yeah, this is the way we have the design and simulation capabilities. Yeah, this is the inside the fabrication machine that we have. We're currently introducing this lab capability to the industry level fabrication. These are all the structures. You see the dazzling rainbow color is because of nanostructure. And this quantum photonic chip can be used in many industries. I think the first application would be security. This is our nano manufacturing plant and open labs in North Melbourne, and you're welcome to join us with this journey. I'm so excited to work with all of you. Thank you.
Thank you, Frank. Now let's move on to our panel discussion, Private Equity Investment Trends in 2025. Please welcome our esteemed panelists, Lel Smith, Managing Director at the Stock Network, John Shin, Managing Director at Pallas Capital, Pete Seligman, ETA Investor, Nick Kelly, Portfolio Manager at Wilson Asset Management, and Martin Tang, Partner at Genesis Alternative Ventures.
Hello, everyone. I'm so thrilled to be here today. This is the last session before lunchtime, and we are going to have you hungry not just for food, but for investing opportunities. We have so much to cover. It is, of course, the exponential era private equity investment trends that we'll be covering. And I would like to introduce you to our panellists here, John Shin, Pete Seligman, Nick Kelly, and Martin Tang. We're going to be covering so many things just to get you hungry for what we'll be discussing here. The Australian context and opportunities and challenges of private equity. We'll also touch on growth equity, succession planning, software tech, and access for different investor types. But to get straight to it, we will go for a broader overview. I'm going to ask Nick Kelly first, given his overview of alternative. Nick, from your perspective at Wilson Asset Management, how would you characterise the current state of the private equity market in Australia? Also, what are the most significant trends you're observing and how are they impacting investment strategies?
Yeah, thanks, Lel. So for those of you who are not aware, so I manage the Wilson's Alternative List Investment Company within Wilson Asset Management. So it is a list investment company that invests across all elements of private markets, so across private equity, real estate, infrastructure, agriculture and water, and finally private debt. And importantly, it's accessible to everyone in the market, from retail investors through to wholesale and institutional. So in terms of the trends in the market that we're seeing, so expecting this year to see an increase in deal flow in the private equity space. I feel like a bit of a broken record on that one, but we do think deal flow will tick up this year. It does feel like there's quite a bit of fatigue from people sitting on the sidelines, so I think we will see a tick up in deal flow. We think that deal flow will be focused on the mid-market and particularly in growth equity. I think the larger cap deals will be difficult to get away unless we see further easing from the RBA, although given the rhetoric last week, I'm not holding my breath that there'll be more of that anytime soon. And finally, this theme that we've seen around private companies staying private for longer, we think that will continue. There was a report some of you may have seen yesterday from ASIC on the intersection of public and private markets. Talked about this trend of a lack of listings being more cyclical. I don't think that's the case. I do think it's a bit more structural. For those that are not aware, there's about half as many listed companies in the US as there were 30 years ago, right? So it was about 8,000 30 years ago. There's 4,000 today. So I think we'll continue to see that trend around private companies staying private for longer, but transacting through trade sales, other private equity firms buying out businesses, and adjacent businesses buying businesses too.
Thank you. I can also certainly vouch for what you're saying because I'm the managing director of the Stock Network and also a member of the IPO network, and IPOs are at record lows, not just in Australia but overseas. So everyone is looking at alternative options, and perhaps on that international perspective, Martin, it would be great if you could give us your experience of Southeast Asia and how does the Australian PE market compare to other regions? Also, if there are unique opportunities or challenges here, particularly in terms of deal flow, valuations and exit strategies. What differences are you seeing?
Thanks, Lel. That's quite a mouthful. I'm Martin, co-founder and partner of Genesis Alternative Ventures. We are a private credit fund headquartered in Singapore. We specialize in providing venture debt as well as growth debt to startups, Series B onwards, to mid-market companies. The Australian market is very interesting. I was educated here. It's a sophisticated market. There is governance. There's rule of law. These are all very important for us as investors. And there's the spending power. Australians are rich. There's a lot of buying power here. And compared to Southeast Asia, there's reasonable scale as well. So I've been so impressed and always been very, very surprised at the kind of deals that I've seen in Australia. Never mind the Canvas, Atlassians of the world, but there's this other bunch of hidden gems that I'm working very hard to uncover and hopefully work with my partners on the panel here to uncover these gems. In terms of valuation, you know, there will always be companies that are overvalued, right valued, undervalued. It really depends on who you're talking to. If you're a buyer, it's always too expensive. If you're a seller, it's never enough. So I guess at some point, there has to be a meeting of minds, and if there is the willingness to do a deal, things will get done.
Excellent. Nothing like different perspectives, and it's incredible to have yours, including Asia. Moving on to another perspective now from the SME sector. John, you're focused on Australian SMEs. Can you outline what makes this segment attractive for private equity investment, and also what the specific hurdles are that you encounter in investing in this space, perhaps with consideration to things like succession planning and growth capital needs?
Yeah, thanks. Look, I think that SME sector in Australia is a very large sector. I think we all can see, maybe in this room, a lot of baby boomer owners of those businesses. I think I've seen stats of, $3 to $4 trillion of value in that mid-market in Australia. And they're often businesses that are too small to list on the stock exchange or to deal with a large private equity firm. The challenges, though, are often they're run by the founder and, the person that created the wealth, the person that drove the team to create all the success is also the person who's going to be retiring and selling. So a lot of what we do in private equity is we align ourselves with great people, people on the board, people on the management team, people as shareholders, and we make sure that we align ourselves with those people. And really, that's half the challenge of private equity. It's funny, we can't choose our son-in-laws or daughter-in-laws. We get told who that's going to be. But with private equity, you can choose. So you can choose a fund, and the fund manager will put together a portfolio, and hopefully that fund manager has a lot of skill in how they assemble that portfolio. Or you can do it. And most of you are in this room because you've created wealth in some way. I would say to you, use the skills that you've built over the time to be able to make really good choices. Make good choices about who you're backing as the private equity manager. Make good choices about who the CEO is. Make good choices about the industry that you're going to be in. And if you can do that, you'll get a lot of the tailwinds of buying these businesses that are hopefully growing.
Thank you, John. You mentioned that boom in baby boomer businesses that are coming to market, people looking to buy, and moving on to that entrepreneurship through acquisition. This is a question for Pete. You've got a unique perspective because you have both acquired businesses and are now investing in others that are doing the same. Can you outline what the key success factors are for this, and also how it differs from the traditional approaches to private equity?
Sure, thanks. Yeah, I was waiting for it because I was kind of the last one left to fall there. So yeah, entrepreneurship through acquisition, ETA, it's an acronym that not a lot of people have heard. The biggest difference to private equity is exactly the issue that we heard about just then, with the fact that the businesses that we're targeting to acquire are owned and operated by the retiring owner. And so there's that succession play that doesn't exist. When we invest in ETA, we're investing in the entrepreneur first and the acquisition second. So what we're doing is we're picking effectively another way to speak about it, and we've got some in the room, so I don't want to refer to them too much as jockeys, but it's like picking the jockey before the horse rather than the other way around. And then we back that person through their search process to then identify a good acquisition for them to buy. Then it means that post-acquisition, you've kind of solved that succession play along with the capital. So I think that's the predominant difference, and that allows for, we were talking about numbers just before. The Australian Business Growth Fund just issued a report which covers a range that's slightly bigger than what we'd probably focus on, but it estimated that for small businesses with revenue between 2 million and 100 million that are headquartered in Australia and privately owned, there's currently about 165,000 of those in Australia at the moment. So that's a large pool of businesses that are of a material size. Now, all the statistics we get from surveys say that, and I won't give exact numbers, but a large majority of those owners don't have a succession plan, and a large majority of those people, if asked, would sell. And so over the next, say, 5 to 10 years, we're going to have to see something happen with well over 100,000 businesses with revenue of 2 to 100. And private equity's got a part to play in that, but there's a level at which they can't go below because it just doesn't make sense for the model, and that's where ETA comes into play.
I'm going to ask you a question now which may be at the back or front of people's minds that are here, given that there may be a number of business owners or people that are looking to buy an asset. How long do you think someone should give themselves to prepare ahead of giving up their asset for sale?
So if you're a business owner, how long will it take you to prepare for sale?
Yes.
So obviously it depends on the maturity of your business, but I would allow years. So I was on a panel a couple of weeks ago with someone that spends a lot of time with family office and a lot of time thinking about succession of the operating businesses owned by those family offices. Her recommendation is 8 years, at least 8 years in prep for that full succession of the founder owner. But you need, not only do you need to establish an operating rhythm that allows you to provide consistent results, but then you need those consistent results to come through. The biggest issue that we often find is that we'll come across a potential acquisition, and a lot of the work that needs to be done in order to shape that for sale is actually done in partner with the buyer. Which is okay, and that'll happen on a lot of cases, but I'd say at least 3 years would be the runway if you're looking at exiting.
And by contrast, what do you usually see from people? Is it 3 to 8 years?
No, like usually 0. Oftentimes it'll be that they haven't even thought about it. They don't know what their succession plan is. They're trying to work out how they can exit. Then finally it gets to the point where they actually really need to exit. And unfortunately for a lot of these owners, it's usually something like a health scare on their own part,
yes,
or a loved one. And that then gets really difficult because then you're forced into that situation. So unfortunately, a lot of them get accelerated beyond the rate that they should be exiting.
Yes, and I suppose therein lies the opportunity for the suitors or yourselves. I'm going to head back in the same order that we came and to ask John a question for yourself. You've got experience across various asset classes. How does your background in real estate and venture capital inform your approach to private equity investing in SMEs? And also, you advise Stephen Lowy at LFG. Are there specific sectors or themes within private equity that are particularly attractive to family offices and high net worth individuals right now?
That's a good question. Look, one of the frameworks that we have is to look for growth tailwind assets. And the reason why we look for that as a family office investor is one of the things that you have that others don't in the listed markets is duration. So if you can find an asset or a subsector that you think is growing, that will hopefully grow despite lots of other macro events. Maybe you'll get the time estimation wrong, but you're pretty sure that the thing you're betting on will grow. Well, that's a huge advantage. And you've heard a lot of adages of put it in the bottom drawer and let it compound. Compounding and diversification are the two sort of magic things of finance. But if you can find an asset and let it compound and let it grow, well, that's a really great place to be. And so I think there's some really skilled investors that can buy really well. There's some really skilled investors that can buy distress and turn it around. There's lots of different things, but I think one of the keys that we really always focus on is their long-term growth. The other would be people. I think the first part of my career, I was always focused on the transaction. What are the numbers? What does the spreadsheet say? I think in my last decade, I would spend much more time around the people around the deal. So we've vetted many, many deals and walked away because the people were not the right people. In finance, there's some amazing salespeople, amazing. Beware the great salesman. But always do as much work as you can around every single person around the deal. Because if you can find an industry with a tailwind and really great people, and then probably one more thing is the right deal structure, that you're paying the fair price for the returns that you're seeking, then hopefully you can hold it for 10 years and let it compound wealth.
It's so true. I love what you say about salespeople. I have interviewed hundreds of CEOs, and I always note that the strength of a sales pitch is not aligned to the strength of a share price. And moving on to listed equities, Nick, that is clearly what Wilson Asset Management are known for. What motivated the expansion, though, to alternative assets, and how do you see private equity fitting into a broader portfolio strategy for different types of investors? You also mentioned giving everyone access to alternative investment managers. Can you elaborate on this democratisation of private equity and how Wilson Asset Management is approaching this?
Yeah, sure. Thanks, Elle. So Jeff being Jeff, was pretty opportunistic in his approach to effectively taking on this fund almost 5 years ago. But more than anything, I think Jeff, like many of us, have seen this trend towards alternatives, and the fact that retail investors, relative to sort of wholesale and institutional investors for that matter, haven't been able to access alternatives in the same way. Just looking at the allocations of the average mum and dad investor to alternatives, it's much, much lower relative to institutional investors, and so there was a real opportunity there to grow, to invest into a space that was growing, but also to your point around this idea, and we hear this term a bit, this sort of democratisation of private equity, which is really just giving everyone access to an asset class and strategies that they were once unable to access because it was the domain of the institutional investors. And so that's what we've been able to do with WMA, and it's really exciting that we're able to invest with best-in-breed investment partners and give retail investors, mums and dads, access to those investment partners that they frankly just can't access otherwise.
Yes, I've interviewed one of your colleagues, Dania Zanova, and I'll never forget, she told me once that her son, who's younger, asked her, "What do you do?" And she was driving on a road, and she said, "I buy things like this road, and you can do that too one day." And I thought it was just the best, simplest explanation of how we can diversify our portfolios. Martin, if I can ask you, you pioneered venture debt in Southeast Asia. While venture debt isn't strictly private equity, as there are lessons learned from that experience that apply to the current PE environment, particularly in terms of structuring deals or managing risk, and also given the rise of software and technology from a venture debt perspective, are there valuation metrics changing on how to value software businesses?
Again, a mouthful. So I'll take that first. So venture debt, private debt, all belong to the alternative asset class. So similar to private equity, we are always buying the people, business models, whatever, they come, they go, but we're very, very focused on people first. Then we look at what the financials, the numbers tell us. I think that's very, very key. It's challenging because in private markets, there's little to no regulation on what needs to be disclosed. So we spend a lot of time on due diligence, in-person due diligence, third-party due diligence. We do informal checks, and the informal checks are always very interesting. And these days, I call it open source intelligence as well. Go check their Instagram, go check their Facebook. How are they spending their weekends? How are they spending their time? What are they buying? Or are they saying silly stuff on X? These are all very, very crucial, critical data points. Switching gears to valuation metrics, I'd say after the last 2-3 years of the so-called funding winter that we saw in the private markets, valuation multiples have come off somewhat. There's still a lot of founders that are drunk, hungover, still expecting 10 times sales multiples. Those guys will continue pitching, but there are the sensible folks who say, look, if we don't raise, it's the end of the road for us. Let us take some pain on valuation. Let's recap the company, but rebuild something that's more sustainable, that will give our investors a good return at some point in time.
Yes, and I just love hearing professional investors warn people about social media, because I think so many people think that their business and personal is separate until it comes to assessing an investment, and it's all open for assessment online. Now, as we move into the last part of this, I would love to hear everyone's opportunities and red flags when it comes to private equity. Let's go to the red flags first before we head to the blue sky. And perhaps Martin, starting with yourself, looking ahead, what do you think is a red flag in this sector that we should be aware of?
Well, I think the one big red flag that's been talked about a lot would be the level of disclosure, especially in private markets in general. And that will continue. There will be blow-ups, there will be frauds. So I think the posture for any potential investor would be, what's the worst case, what's the downside for me if things don't go according to the prospectus?
Yes. How about yourself?
Yeah, I think somewhat adjacent to private equity, but will have a direct impact, is I'm pretty concerned about the amount of capital that's been invested into the private credit market. I know there's a panel coming later on that, but the ramifications of increased defaults. We've been through a fairly benign default cycle. I think defaults will rise. I think there's some lending practices that have gone on that are going to come under stress, and we'll definitely see those groups who are skilled and those who aren't as they work through some of those loans. And the flip side of that, on the opportunity side, which I know you wanted to come back to, is I think there's potentially a role there for distressed credit. So I think that could be an interesting space.
Pete, what red flags are you waving this year?
I think I'm involved in, I guess what you could say is a relatively nascent asset class. And I think the red flag for me is just watching that market or that community build over the next few years. So, you know, if there are a few transactions that have been done, there's more transactions that will come. I think the deal flow comment is a good one this calendar year. But we've just got this massive volume of, as I was saying before, potential deals to be done over the next 5 and 10. It's just matching those spinning plates up at the right rate, because there's lots of actors that need to be involved in that process, and to the extent that those aren't balanced, then that just creates some volatility. So it's just getting, you know, vendors, equity, debt, entrepreneurs, like getting that running at the same speed is the hardest part.
Yes. And John, warnings or red flags for yourself?
Look, I think private equity, everyone has to understand, is an illiquid asset class. So I think if you're not investing with a 10-year horizon, even if it says 7 years, but normally there's all different things that they can do to extend the investment horizon. So if you don't have the capital that you can comfortably say, I'm going to invest in this and I'm going to invest in it for 10 years, it's probably not the outright asset class for you. You can find it in other ways, like other vehicles, but private equity in its essence is buying private businesses. So you need to know that that's illiquid. Maybe you'll get distributions, maybe not, but it's an illiquid asset class.
That's a very important warning. And how about on the flip side, opportunities or areas of this sector that are exciting you in the year ahead?
Look, I think there's a lot of reasons to be very optimistic. You know, I think we're now starting to see businesses that are going to use the benefits of technology to drive productivity and reduce expense. You know, AI is a buzz term. There's lots of venture capital around it, but we're now starting to see it actually go into businesses and drive, hopefully, increased revenue or cost. And I think this succession of baby boomers driving to the next generation of management. The key thing is finding great people and then aligning them to the outcomes, like investor outcomes. And if we can do that and unlock it in really interesting businesses, I think there's a great opportunity to create a lot of wealth.
Pete, opportunities in your eyes for the year ahead?
Yeah, I think for the year ahead, but also for this next kind of 5 or 10 year period, it's similar to the comment just then. I think that there, on the risk side, there's a risk that there are hundreds of thousands of businesses that just shut their doors because they don't have any other option. The awesome opportunity is if we can connect the capital and the entrepreneur and those businesses together in the right way, we can actually get that part of that critical part of our national economy to continue on and then go to the next stage. So I'm really excited by looking for the opportunity to get those connections to happen so that those entrepreneurs have an opportunity to have a crack at the next phase of those businesses.
And Nick, you earlier referenced an opportunity. Can you expand on that, or any other pathways that excite you in the year ahead?
Yeah, sure. So I think, as I said, the distress piece I think will be an opportunity. Tends to be more a cyclical asset class, especially in Australia, given the size of this market. The US is a bit different. You can have a sort of consistent allocation. Probably the other piece is agreeing with these guys that succession piece. I think that's where we'll see much of the deal flow in the private equity market, and hence our focus on that mid-market growth equity space.
Excellent. And finally, Martin.
With the funding winter, with inflation, a lot of companies have learned to do a lot more with less, reduce their expenses, their burn, and AI has also helped that. So we see a lot of opportunities to deploy capital into right-sized companies that are optimizing their resources.
Wonderful. Thank you so much to our panelists and our audience for joining us with private equity investment trends, the exponential era. I hope that we've given you many, many ideas to make you very hungry for investing, and it is, of course, lunchtime, so we hope you enjoy your lunch as well. Thank you very, very much.
Thank you.
Thank you, guys. You were so awesome.
That was good.
Welcome back, everyone. I hope you had a great networking lunchtime. Our first presentation is from innovyz, a company that combines the roles of an accelerator, incubator, venture capitalist, and management consultancy. Please allow me to introduce Stuart Douglas, founding director of innovyz. Sorry, the lunch break.
Thank you very much. I'm going to be speaking really fast because I've got to get through 2 companies in 8 minutes, so I apologise. Stuart Douglas, innovyz. We're the leading commercialisation group in Australia for deep tech. So we work with all the leading universities and research institutes in finding what's the next big thing that's coming along, and then we license that, we spin it out into a company, and then we invite investors to come in and become seed investors in these technologies with us. The reason I'm here today is I've got 2 technologies that were both closed off and fully subscribed last year, but a Southeast Asian family office hasn't been able to come up with their money. And so I was having a chat to Steve last week, and he said, why don't you come and I'll squeeze you in just after lunch. Why don't you come and have a chat to the Wholesale Investors group and give them a chance to participate? And I said, yeah, sure. Well, first one is Energy, which I just flicked past. Energy is a supercapacitor company. It makes ultracapacitors, supercapacitors, and they're very much like batteries. And this is the world's first graphene-based ultracapacitor. Basically what it means is we can squeeze a lot more energy into the same size can. Our first product, which is launching next month, has got between 60 and 75% more energy than anything else on the market. Our Generation 3 product, and that's basically what a supercapacitor looks like. It looks like a battery. Inside it has an electrode film, and that's coated in our factory in Melbourne with our graphene slurry. So we're launching our Gen 2 product next month, and then our Gen 3 product, we're ahead of schedule. Rather than early 2025, in October, we achieved these results: 90 to 120% more energy density than any other supercapacitor, ultracapacitor in the market space. So we're really excited about this company, really excited about where we're going. It's a big market. It's growing very, very fast. It's growing faster than the battery market, around 20% CAGRs year on year. We're ready to go. We've got manufacturers in Korea. We're onboarding 2 more manufacturers in Taiwan and Japan now. We have our third-party logistics all ready to go, and they're our distribution partners, and they are who's who of electronics distribution in Europe, America, and Southeast Asia. I won't say too much of the team because of the time, but Ben Spencer and John, both and myself, all experienced ASX directors. I'll draw your attention quickly to Brendan Andrews, Global Sales Director. He was previous Global Sales Director at Maxwell, who sold out to Tesla. They were the world's leading ultra-capacitor company at the time, and now he's leading our team. This is probably the lowest pre-money valuation you'll see, about $9.5 million. We're raising $1 million. If you're interested, come and see me. I'm in the back right-hand corner of the auditorium in here. The desk there, it's the only desk with no advertising or no product because I didn't have any time to put anything together. So, but if I'm not there because I've got a board meeting straight after this that I'm chairing, I'll be away for an hour, but then I'll be back there. But there is a registration paper there. You can put your name down and I'll contact you. TQ transistors is the next. This is a new invention in quantum transistors, so topological quantum transistors. You might have heard the term recently, topological. Microsoft just came out with a huge announcement around topological materials for quantum computing. That's in supercapacitors, not in this area of semiconductors. A lot of eyes are now coming to us just in the last week because we're dealing in these new quantum materials called topological quantum field effect transistors. I know it's a mouthful. So what's the problem? Well, the problem is the world's running out of energy to run our computers. Now, that might sound a bit drastic, But the reality is we're going to fall off a cliff in about 10 to 15 years. We won't have enough energy just to run our computers, let alone our lights, our mining companies, or everything else. The reason that is because we've relied on a thing called Moore's Law since the 70s. And what that Moore's Law says is basically every 2 years we're going to jam double the amount of transistors onto a chip, and that way we're going to have the same amount of energy going in, but we're going to get double the computing power. And that's what's happened for 40, 50 years. But it broke at around about 2005 because the transistors were getting so small that they were dissipating their energy. They weren't as effective and as efficient. And that's why in the last 20 years your phone's been getting really hot, right? It's because it's losing its energy. And they can't withhold all that energy in the transistor. So the other problem is that's okay. The other problem is we've had to make them so small now. The current generation of transistor is 3 nanometers big. So your human hair is 100,000 nanometers wide. These are 3 nanometers wide, and this is an operational switch, an on-off. So a transistor in the world, what it does for us is it goes on and off, and it creates a 0 and a 1. And those 0 and 1s make up all of our software, all of our coding language. It makes those 0s and 1s. On my phone here, I've got 14 billion transistors in this phone. And it's just, and this is an old phone, it's 2 years old, it's a 14. So we can't get any smaller. We've reached the physical limits. These 3 nanometer transistors are being printed onto 10 atoms. A silicon atom is 0.3 of a nanometer. So they're printing an operational switch on 10 atoms. We can't go any smaller. So therefore, from now on, every 2 years, world compute power is going to double, and it's going to eat up all our energy. Next year, it's 10% of the world's energy will be on compute power. 2 years after that, it's going to be 20. 2 years after that, it's going to be 40. 2 years after that, 80. After that, we're dead. And I know it sounds dramatic, but that's the reality of where we are in the world at the moment, which is why so many billions, tens of billions is going into quantum computing at the moment to try and solve this problem. So we have developed a solution. We've invented what's called a topological quantum field effect transistor, and it uses a completely new material. This material doesn't work like traditional physics materials, and it enables us to go below what's called the Boltzmann tyranny. In other words, where we can operate at a very, very low energy, somewhere between 10 and 100 times less energy, and it's dissipationless. In other words, it loses no energy. It's 100% efficient. So it won't get hot, therefore it won't need to be cooled, and as you know, our data centers all need to be cooled. This is a solution for that. So we've got some of the smartest people in the world, and I literally mean that, on this. Professor Michael Ferrer, he is the world's expert on topological quantum materials. Tom Rapp is not our advisor anymore, he's our GM in Silicon Valley. He has taken a microelectronics company before, built it up, sold the IP for $1.5 billion to Qualcomm, then went in and ran that for 4 years, sorry. So he's been there and done this before. Wayne Johnson is literally the world's expert on semiconductor materials. He ran all R&D and all commerce for IQE, which is the world's largest supplier of semiconductor materials. So we've built the A-team. They're all convinced of this technology. This year is where we're building our prototype. We will be doing another raise next year with both of these companies. I'm expecting that both of these companies will be doing raises at 3 to 5x what they are today. So if you're interested, please come and see me. One parting thought regarding TQ transistors. These are the top 10 most successful inventions ever to come out of Australia. And they're their annual revenues that come from those technologies. I'm sure you've heard of all of them. If you take all of them, you add them together and triple it, that's how big the semiconductor market is, and this technology has the ability to completely transform that industry. So thanks for your time today. Sorry I had to speak fast. Look forward to seeing you. Cheers.
Thank you, Stuart. Next, we have Pallas Capital. Please welcome their partner of distribution, Paul Van Zulin.
Good afternoon, everyone. It's great to be here, and thanks very much for your time. Over the course of this presentation, I'd like to give you an overview of the Pallas Group, our journey over the past 9 years to where we are today, where we sit in this ever-growing private debt asset class, as well as a summary of our various opportunities for investors. So the Pallas Group was established in 2016 and has two distinct parts to the business. Pallas Capital, which is the non-bank lending and investment side of the business, and Fortis, which is one of Australia's most respected property development managers with a strong focus on the luxury residential apartments and boutique commercial office buildings on the city fringes of Sydney, Melbourne and Brisbane. The strategic relationship between Pallas Capital and Fortis provides many significant benefits, particularly when analysing loan applications. Being able to leverage off the internal expertise of a development manager who's familiar with the same areas that we lend to just provides another level of comfort for our origination and credit risk teams. So this slide tells a great story of Pallas Capital's growth over the past 9 years to our position today as one of the fastest growing non-bank lending and investment managers. So as you can see from this slide, we recently surpassed 7 billion in total investments managed since our inception in 2016. In that time, we've repaid 4.3 billion of that 7 billion back to investors, and we currently have 2.7 billion open and performing investments across 335 transactions. So additionally, we've paid 435 million of interest and returns to our investors. However, as impressive as all that is, the most important number you'll see on that slide is in the top right-hand corner, and that's the zero loss of capital or any impairments to interest payments for any of our investors. So when you consider there's been almost 1,000 loans written in this time, that zero loss of capital is significant, and it speaks to the high level of due diligence undertaken by our credit risk team. So when it comes to the composition of our loan book of over 2.2 billion, the average size of the loans we originate is $8 million, with an average term to maturity of 8 months. With regards to the loan types, the majority of our loans are construction loans and pre-development, and are predominantly located in the inner city suburbs of New South Wales and Victoria. So although in recent years we have significantly increased our lending capacity in New Zealand, which now makes up 14% of our total loan book. So looking at the commercial real estate debt market in general, the rapid rise in non-bank lenders reflects the structural advantages these lenders have over the traditional Big Four. Faster turnarounds and more flexible loan terms are the key reasons for borrowers shifting to non-bank lenders, and we expect this trend to continue. So in the US and Europe, non-bank lenders represent 62 and 53% of the commercial real estate debt market, whereas in Australia we're only sitting at 16%, so there's still significant growth to come in Australia in this CRE debt market. Additionally, as you can see on the right-hand side of this slide, the commercial real estate debt market is expected to increase from 484 billion as at June 2024 to 635 billion by 2028, with non-bank lenders forecast to more than double their market share from 74 billion to 152 billion over that same period. So when it comes to what Pallas investment opportunities Pallas Capital can offer, we can offer investors both diversified pool funds that invest into a portfolio of first and second mortgages, or alternatively, investors can invest in specific loans as a single asset investment opportunity. So just taking a look, as you can see here, when looking at diversified pooled funds, we have 5 funds available to investors. Working from left to right, the first of those is our most liquid fund. That's the Pallas Short-Term Fund. That has a 3-month redemption notice period, so access to your funds after 3 months. The loans that sit within that fund are all first mortgages, but have a shorter tenor of approximately 8 months, and your investors are receiving a return of 4.75 plus BBSW or 9%. You'll notice with all of our funds that there's a fixed component with a floating bank bill swap rate attributed to it as well. Moving along, the warehouse trust number 4, that is our non-construction facility. So for those investors that don't want to have exposure to construction loans, this is the fund for them. Again, first mortgages, in this case it's a 6-month redemption notice period. and there's 5% first loss capital protection. So that means if there's any impairments to a particular loan, Pallas Capital's got 5% of their own money in that fund, and that they're the first port of call if there's an issue there. The Pallas Warehouse Trust number 3, that's our flagship fund. It's our original and largest fund. It's a first mortgage fund as well. 12-month redemption notice period there. Again, 5% first loss capital, and investors are receiving 10.75% per annum. For those investors that are seeking higher yield, we have the high yield fund number 2 and high yield fund number 3. So the high yield fund number 2 is a portfolio of first and second mortgages. With regards to second mortgages, they're leveraged up to 75% LVR. 12-month redemption notice period there, and investors are receiving 13.25. And then finally, the Pallas High Yield Fund number 3. This is our newest fund. It's a mix of first and second mortgages, but as well as that, we have preference equity opportunities in there. So a little bit higher leverage. It's been very popular. It was only established in August of last year, when we're close to 150 million. It's almost a capacity in that fund. 12 months redemption notice period, and almost 15% per annum. Now, as I mentioned, in addition to the diversified portfolio funds, we also have single asset opportunities. So this is where you can invest in a specific loan, whether that's a first mortgage. Just move along. My clicker's stopped working. There we go. First mortgages returning, again, leveraged to 65 LVR on any of our first mortgages. Returns sit somewhere between 9 and 12%. Second mortgages up to 75% LVR, and you can expect returns around 12 to 14. And then the preference equity. So we offer preference equity on our sister company Fortis on their developments. They're very popular with investors, obviously with the higher yields, so you're getting close to 18 or up to 18.5% there. But more importantly, they're all capital guaranteed, so the sponsors provide guarantees over your investment. So there's no risk of loss of capital on those investments. So they're extremely popular. And I'll just provide you on my last, as I finish up, a typical first mortgage. This is an example of a current first mortgage opportunity that we currently have available. You can see it's based in Manly in New South Wales. This is actually a Fortis development. Very typical loan in that it's a 65% LVR, 18-month term on that one. It's paying 6.5% plus BBSW or 10.75%. So that just gives you a bit of a flavour that if you're looking for an investment, a typical first mortgage, that's the sort of investment or sort of first mortgage that you can expect to invest in. I'll leave it there. Thanks very much for your time. I'll be over at the Pallas Capital booth for the rest of the afternoon, so feel free to drop by and say hi. Thank you.
Thank you, Paul. Now let's welcome our sponsor, RockingHorse Group, to discuss innovative funding solutions for startups and emerging companies. I present to you their Head of Sales and Marketing, Cameron Story.
This one. Good afternoon, everyone. My name's Cameron Story, Head of Sales and Marketing at RockingHorse Group. This is going to be pretty short and sweet because this is a simple concept and a simple process. It's also slightly different to the other presentations you may see today in that we're not actually looking for any investment. We are in fact a financier looking to help innovative companies here. So how many of you guys have faced delays in your R&D projects or got into some general cash flow management issues, all the while knowing that eventually you will be getting your R&D tax incentive rebate, but will it come on time or will it be perhaps too late? What if I told you you could access that money right now while you're still in the thick of your R&D efforts? That's where we come in. We specialise in helping innovative companies like yours unlock the potential of your R&D tax incentive and access the funding you need quickly and easily. Imagine what you could do with that rebate money today. At RockingHorse, we've already helped hundreds of startups get access to anywhere from $50,000 up to $3 million, generally even more as we're speaking today, it's sort of $4 or $5 million we can get access to. We're here today to tell you how easy it is. So what is R&D finance? Very quickly, R&D finance allows businesses to secure loans against their eligible R&D rebates from the Australian government. Instead of waiting for up to 18 months for your rebate, we give you access to it right now, when you need it most, during the year as you're actively spending on R&D. There's no recurring interest payments through the year. You just pay the loan back at the end of the financial year with your tax return. So what are the benefits? So we believe there's plenty of them. Primarily, you're going to get far better cash flow management. Better cash flow management means you don't have to pause your research or your innovation while waiting for funding. Imagine being able to continue accelerating all your projects without delay. That's done generally through the flexibility of our funding. You can borrow just once through the year, if you like, but many clients actually come to us and draw down each quarter. As you accrue more R&D spend through the year, you have access to borrow more. Again, this allows you to smooth out a bumpy cash flow through the year. Thirdly, this is non-dilutive funding, so you get to retain control of your business for a lot longer. You don't have to give away a chunk of your business until you've hit those milestones and increased your value. Finally, getting the loan is very fast. There's no drawn-out approval process with us or complicated paperwork. In just a couple of weeks, you can access up to $3 million and keep your innovation moving. So how does it work? It's a very simple process. As I said, this is all we do, and we've fine-tuned it to make it as easy as possible. All you need to do, generally, is first confirm your eligibility with us, that you actually can get the R&D tax incentive. Then you need to provide us with very minimal documentation. It's some financial documents, some historical documents, but generally very, very easy to put together. And once approved, the cash arrives very quickly. In less than a fortnight, you can access millions of dollars or as little as $50,000. So why should you choose to work with RockingHorse? At RockingHorse, we do understand how critical it is to fund your innovation now, not later. With us, you get the money to keep moving forward without the worry and time spent hunting cash through the year. You also know the importance of being first to market. Getting access to this cash through the year allows you to accelerate commercialisation and ensure that you're ahead of the competition. Everyone here, generally companies that are here, are in the process of raising capital. It's why we're all here today. So R&D finance will help you hit milestones quicker than you would have hoped for, boosting your valuation as you head to market. We also allow you, obviously, to retain control of your business. Don't be giving up equity if you don't have to yet. We can help lengthen that runway. And like all startups or scale-ups, cash is king. $1 today is worth more than $1 tomorrow. At RockingHorse, you'll have access to that cash in under 2 weeks rather than months. So look, it's time to unlock that potential you guys have. If you're facing delays with your funding or struggling to maintain momentum, don't wait for the long road to traditional capital. Come speak to us and find out how R&D finance can help fuel your next big move. Thanks so much for listening. Enjoy the rest of the conference. And if anyone wants to find out a bit more, we have a booth next door as well, so just come up and say hi. Thanks very much.
Thank you, Cameron. Now let's hear from Tessara Therapeutics on how they use a 3-part strategy to address the complex challenge of neural drug discovery and regeneration. Please welcome their CEO and founder, Chris Papadimitri.
Good afternoon, everyone. I'm Chris, CEO of Tessara Therapeutics. We are an emerging biotechnology company, and in 2020, we started working on a platform technology that enables the development of effective therapies for millions of patients with neurological diseases. We do that by using our real brain technology to create lab-grown human mini-brains. In the $2 billion neurology drug discovery market, we are the first to offer a scalable and predictive human brain model. Already, major pharmaceutical companies use our technology to find and select the drug candidates with the highest chances of becoming an effective therapy. And 2 years ago, I was presenting in a similar Wholesale Investor conference, and I claimed that we would be in the market by now, and indeed we are. We have already earned revenue. We expect to double it this year, and we aim for profitability within the next 2 to 3 years. We are now raising $6 million to expand operations due to the growing demand and develop an artificial intelligence platform, leading to potential 20 times value inflection in the next 5 years. Neurological diseases are the leading cause of disability worldwide. 43% of people are affected, with Alzheimer's alone adding 10 million new cases every year and killing more people than prostate and breast cancer combined. And despite billions of dollars spent in research and development, the majority of neurological diseases, including Alzheimer's disease, still have no therapy. Why is that? The reason is that the existing methods that use animal models and cell models to find new therapies fail to predict how the human brain responds in these therapies. The FDA has recognized recently this problem, and they removed the requirement for preclinical animal testing, which is a move that clearly underscores the urgent need for more accurate, human-relevant testing methods to bring better therapies to market. And this is exactly the solution that we offer: a human-relevant brain microtissue that functions and responds to drugs like a human brain. So what you see in this video is not a cartoon. These are real human neurons imaged with a special microscope that communicate and they create networks. And our technology provides a window into how treatments works in the human brain. And here's a couple of examples of how companies are using our technology to find their best therapies. What you see on the screen is a healthy version of our mini brain. These tubes, these elongated structures that you might see, these are actual human neurons that create networks. So one of the simplest tests that we can do is to understand if a compound is toxic or not. So, for example, if you compare the control sample with a sample that is called rotenone, which we know it's a toxic compound, we can very clearly see if a compound falls in that category or not. And by doing this test several times for a new potential therapy, we can find at what concentrations a drug might be toxic or not. But we can also make much more complicated tests like this one. We can image all the neural network structures of a mini brain that we produce before and after a treatment with a drug candidate. And then we can create a digital version of these neural networks and quantify the effect of this potential therapy with our brain microtissue and understand what is their effect in the human brain health. Our validation studies suggest 94% accuracy in predicting safety and efficacy compared to about 30% for existing models. These numbers are based on 4 years of testing more than 100 drugs. To make these mini brains, we mix human neural stem cells with our special biomaterials to form tiny spherical scaffolds. After 3 weeks of growth, we are ready to use these mini brain structures for different tests for our clients. And using highly automated systems, we always ensure predictivity and reproducibility. In fact, these two features, predictivity and reproducibility, are the unique combination that allows our technology, the real brain technology, to outperform any other technology in the sector. This means that we can produce thousands or even millions of mini brains with consistent outcomes, providing the reliable data that our clients and drug developers need. We didn't reach at this point overnight. There has been years of academic research led to discovering a potential Alzheimer's therapy that made global news. Since founding Tessara, we have earned significant recognition from the scientific community, from the industry in Australia and internationally, but also from the press. Our technology applies to multiple markets. At the moment, we prioritize and we focus in the $2 billion neurology drug discovery market. And then we will expand to chemical safety, food testing, and defense. And in fact, we have a letter of intent with the Department of Defense for pandemic preparedness applications. At the moment, we are working on 2 revenue streams. We began generating revenue faster than expected due to the policy change driven by the FDA and other agencies around the world. And the first revenue stream is about offering direct drug discovery services to clients around the world. So this year, we are doubling last year's revenue, and we aim to continue in this pattern for the years to come. At the same time, we are developing a new product line where customers will be able to order ready-to-use mini brains for their studies and experiments. We have supply agreements in place with set pricing with companies in the US and Europe, making our technology globally available to neuroscience innovators. But everything you've seen so far is just the beginning. We are creating literally the future of neuroscience drug discovery. By producing millions of mini brains and gathering vast amounts of data from screening hundreds of potential therapies, we're developing now a new artificial intelligence system able to contextualize this information and create a truly predictive model that accelerates drug discovery. We aim to launch a first version of this platform by 2027, which will be a game changer for science, for patients, and investors. We started having revenue earlier than expected, and we're already tracking ahead of our revenue projections. And with the future addition of our AI platform, we are projecting more than $10 million in revenue in 2028 and exponential growth after that. All this is possible because we have a team of industry experts with proven ability to achieve value inflection milestones and a top-tier scientific advisory board. So if we want to summarize the benefits of our technology, we have a platform that delivers more accurate human-relevant methods for drug development that is 4 times faster than any existing method, reduces the research and development cost, and increases the return on investment for the pharmaceutical companies. And that results in faster, cheaper, and more effective therapies for millions of people worldwide. So closing, since 2020, we have raised $8 million, and we received $3 million in government grants, moving from concept to market in under 5 years. Now we are seeking $6 million to expand our services and develop our AI platform, targeting significant profitability in the next 3 years and the potential for more than 20 times value increase within 5. So we invite everyone to join us in transforming Alzheimer's and dementia treatments, helping millions to live longer, healthier lives while realizing substantial returns. So thank you very much for your attention. I would love to connect during the conference or by email with anyone who wants to learn more about Tessara. Thank you.
Thank you, Chris. Please welcome Medigrowth CEO Adam Guskic to discuss their impact in the medical cannabis industry. Adam.
Hello everyone, thanks for joining us. I'm Adam Guskic, CEO of Medigrowth. We're a data-driven medicinal cannabis company based down in Melbourne, and we're very focused on research, digital health and commercialisation, and trying to differentiate ourselves beyond a pure play medicinal cannabis company that we're leading the research with. Founded by myself and Todd McClellan. We're across the way in the hall. We'd love to connect with you when you have time to come and chat about the opportunities in our space. The opportunity is quite immense. We've got a 2-tiered system here in Australia of registered medicines and non-registered ARTG medicines, and Medigrowth is playing in both of those areas. The opportunity for a $127 billion global industry is for the unregistered medicine and cannabis industry data, but the real opportunity is beyond that and really looking at the cannabinoid pharmaceutical space and the opportunity that falls in with the remit of registered PBS supported medicines. And that's how we're looking to forge ahead. The reason we need to do that is that we, through our anecdotal evidence, we recognise that there are a lot of potential benefits for medicinal cannabis, and we recognise that patients are seeing huge improvements in many cases in quality of life. Often those patients can't afford to continue the treatment because it's not a PBS registered medicine, and it can be quite expensive for treatment continuation. Our business is really quite a simple business in a complicated industry, but we have two core pillars of our business. We have a revenue generating arm, which is distributing products across Australia currently and soon to be internationally in the unregistered medicine space. These are specific pathways through authorised prescribers and also through special access scheme. And that allows us to generate revenue, and quite a quickly growing revenue generation opportunity, 133% jump from 23 to 24. And we're really in that position running a very asset-light operation. We don't have our own cultivation facilities, we don't have huge overheads, we have a very agile team, and we feel as though we're operating in a space where we can really focus on not only the revenue generation, but most importantly the IP generation as our next step in our development of the business. We're well beyond early phase in the IP generation. We have already, in collaboration with one of our university partners, completed a phase 1 and 2 paediatric autism trial with some very significant results, and I'd welcome you to come over and have a chat to us about those in due course. We're also working on some cannabinoid bioprospecting initiatives led by the University of WA, and that's really for novel product development, and that's working beyond the generic medicines that we're working with today and looking at how we can treat specific conditions with very tailored formulations. Ultimately, we'd like to see our Medigrowth Centre of Excellence that's co-located, or the Greenfield site is co-located with Deakin University down in Warren Ponds in Victoria. We have that as a full town planning approved, ODC licensed, and a collaborative research and development site that we believe can be a conduit to government, university and research endeavours for both Medigrowth and to invite global players to come and research within this space. Obviously fully licensed across all of our activities in the medicinal cannabis space, and equally more recently, or as of last year, licensed for both psilocybin and MDMA, which have a very strong alignment to our industry, given that both of those compounds are legislated for PTSD and treatment for depression. Our products and portfolio being distributed, as I said, across nationally, across a whole host of different formats and dose formats. We're seeing very strong anecdotal evidence, and that's why we continue to push the clinical trial and observational trial opportunities to drive research into a market that we believe can be well and truly beyond the unregistered medicine space. As I said, a whole host of different dose forms. We have a telehealth connectivity where we connect patients to doctors 365 days a year, ensuring that any patients that are looking for support have the doctor with the requisite training to be talking about cannabis medicines. As of 2025, we've launched Kindred by Medigrowth, the veterinary division of Medigrowth, very strongly aligned to what we're already doing in our human space, and certainly a huge market opportunity as we look to develop CBD medicines for pets. In the US alone, a huge opportunity. 65% of pet owners have utilised CBD for their pets, and we're seeing, interestingly enough, pets being prescribed CBD for many of the same indications that humans are: anxiety, chronic inflammation conditions, and a host of age-related conditions. As pets live longer, the same sort of format can be applied to both pets and humans. Going on our growth trajectory in the revenue pillar, certainly very strong growth for an early stage company. We've had a flying start to FY25 already, well exceeding FY24, and really looking for our next stage of growth to continue on the revenue generation to support the bigger picture commercialisation of the clinical arm that we're working on. And the industry itself is growing very rapidly. So we're in not only a very dynamic company from a Medigrowth perspective, we're in a very dynamic industry, broadly speaking. Strong collaboration with a host of regulators, but importantly, a host of university connectivity, and certainly some key supporters from Deakin, Uni of WA, that leads the training centre that we're doing the cannabinoid bioprospecting with. So for us, very important to continue working on some of those pursuits. Very proud of the work that we've done collaborating with Deakin University on paediatric autism, something that we're seeing, again, anecdotally, a lot of very, very positive results, but now also some very positive clinical data that's come out of this study, 5 to 12-year-old kids that have been prescribed CBD product with significant improvements, and that's currently under peer review, but we're very much looking forward to being able to release those results. Likewise, the ARC Training Centre, incredible talent, incredible pool of PhDs working on initiatives for Medigrowth. The Centre of Excellence, so based down as part of a co-location with Deakin University, as I said, fully approved by Office of Drug Control, designed and really with a big picture view of how we can drive investment into cannabinoid research and Medigrowth as a conduit for overseas players wanting to use Australia as a key research centre. We're currently looking to raise $5 million, of which we've already had some application to. I'd welcome you to come over and have a chat. 43 cents a share for a total of 12%. In an equity round, and we're looking to really push our revenue to a $10 million revenue in the next 12 odd months. Use of funds really is a complete scale up of everything we're doing currently, and we're super excited for what 25 can bring. Right on time, Guskich. Thanks, guys.
Thank you, Adam. Now let's hear from Saiiv Monitoring Solutions. They focus on improving the detection and management of chronic diseases with affordable, AI-powered, non-invasion tools that fit into current healthcare practices. Let me introduce you CEO and Managing Director, Neil Anderson.
Yes, good afternoon everyone. My name's Neil Anderson. I'm the CEO and founder of Saiiv Monitoring Solutions, and we're focused on improving the management of chronic diseases such as cardiovascular disease, respiratory and metabolic diseases like diabetes. So our mission is to empower individuals and clinicians with clear, personalised insights to prevent and manage their chronic disease. So if you look at healthcare spending around the world, and this is just Australia, it's growing dramatically. And a key component of that is the spread and increase in the growth of chronic diseases through ageing population and growing obesity. So in the adult population in Australia, about 50% of us have at least one of these chronic diseases, so that's cardiovascular, respiratory or diabetes. And a large proportion of those actually have two or more, so they're called multi-morbidities. So if you look at the cost to the Australia, at an individual level it works out at about $1,400 per year per person, and that's no matter what age you are in Australia. As far as cost to the federal government, and hence our taxpayers' money, it is also around $1,400 for every taxpayer in Australia. So you can see it's a big problem and it's a growing problem. And what are the reasons for this? Obviously, there's individuals that have to take some ownership of their disease, but if we look at the healthcare system, it's really quite reactive and really not focusing on prevention. With fragmented care leads to issues in that you don't have uniform records through the system, and information isn't passed on from health provider to health provider. There's also inefficiencies and inconvenience through a bricks and mortar approach, and that's being overcome with some of this remote care. This leads to poor treatment for patients and late diagnosis, and of course can lead to multi-morbidities if they're just focusing on treating one chronic disease. So there's a number of companies out there trying to solve this problem. Everyone's heard of telehealth, great program, but limitations in that they only offer partial solutions. There are monitoring devices that are also quite limited, called remote patient monitoring, and that could just focus on one or two metrics such as blood pressure monitoring or ECG. There are some digital health solutions called digital therapeutics, where questionnaires are filled out by the patient, which calculates a risk score. And then there's electronic health records and patient management software that is trying to overcome the problem. Some of the current integrated solutions are also just focused on one or two diseases with just a small number of metrics. So we're offering a fully integrated solution to address this problem. It's made up of what we call smart apps that are patient-facing, downloaded by the patient with various questionnaires, which I'll allude to in a moment. We also have monitoring devices to monitor key parameters that are related to chronic disease management. And then we have a cloud database that accepts all the data and uses artificial intelligence to calculate risk scores and whether they're going up or down through specific care plans, which are delivered through a clinician portal. So it's really the integration of multiple technologies into one platform, end-to-end. So on the apps themselves, we have our own proprietary risk questionnaires, and there's also a number of established questionnaires for specific diseases that are mentioned there. We also, from those, we calculate what we call the SMART score, and that's entered into the clinician dashboard to really help the clinician decide on the best course of action for further diagnostic testing or treatment. We also can close the loop by monitoring compliance to that treatment plan from the patient to the clinician. As far as the monitoring devices, instead of just 2 or 3 devices like other companies, we have 12 CE-approved Bluetooth monitoring devices. The key point of difference for us is not only is it 12, but they're all connected to our one app. So it's just a lot of technology, one app, one cloud, one clinician portal. So all the data is very easily integrated together, which is then excellent for artificial intelligence algorithms. And you can see these 12 devices can also be used not only in virtual care and home use, but being medical devices, they can also be used in a clinical setting. We also have our own proprietary devices in development, which are called the Hemoscope and the Rib Band, and they're filling key gaps in existing Bluetooth monitoring portfolios. The first one, the Saiiv Hemoscope, is a multi-sensor design that actually has 3 key sensors on board. It has an ECG for looking at the electrical activity of the heart and simultaneously measuring the forces of contraction, if you like, the mechanical function of the heart, together with phonocardiogram or cardiac sounds as per a normal stethoscope. This is very powerful in that we're able to look at relationships between signals and within signals to make key calculations. For just a few examples, the dot using the forced cardiogram or the hemoscope using the forced cardiogram can calculate ejection fraction. Oops. Not sure, can I go backwards on this? Yeah, so sorry, it can measure ejection fraction as well as timing of the valves opening and closing, and that's really important in understanding the mechanical function of the heart, and hence what is known as myocardial performance, which is really important in heart failure patients. How is that currently done? An echocardiogram, which has to be performed by a sonographer, a specialist trained, and costs the healthcare system $500 or $600 a pop. This device can be used just like a stethoscope from a GP or cardiologist to measure some of these valve dynamics. Two of these hemoscopes used together can also measure pulse transit time, which is an indication of arterial stiffening or hardening of the arteries, which is really important in understanding vascular disease. The second device is called the rib band, and it's an electrostatic device that measures volume changes of the chest, mainly due to respiration, and of course is very important in understanding tidal volume changes for diseases such as COPD and sleep apnea, as also the amount of heart rate and respiratory rate. The heart rate can either come from an ECG, which is on board. We can also, as you can see, measure the small blips here in the signal change, which corresponds to the mechanical function of the heart. So we can actually look at the relationship between the electrical performance of the heart and how the heart responds mechanically to that electrical. So the state of the art is either a RIP belt, which is actually called respiratory inductance plasmography. Very expensive, very uncomfortable to wear. Ours is very comfortable to wear, can be worn as a wearable continuously, and has much less complex electronics and is low cost to manufacture. So all of this data feeds into a cloud for real-time data integration, leading to personalised care plans and research support. So the actual risk scores are calculated on the back of the smart app itself and all of the metrics that feed into what's called Smart Plus. And you can see for specific diseases we highlight risks. These are all, for want of a better word, used in a calculation to calculate an overall risk score for a particular disease, and that is then monitored over time to see changes via a care plan. This is an example of the Smart Care platform. You can see the clinician has access to trends for specific metrics. They can then deliver the clinician-aided treatment plan, whether that's through extra monitoring or it could be treatments for different types of medication, and that information is then sent on to the patient. We're also able to run clinical trials out of the platform, which we think is really important as far as revenue generating in the future for treatment solutions. We're also monitoring the costs of care, which is really important in a health and economics analysis for this type of platform. And the last section is compliance to a treatment regime. Where we're at in product development is the Saiiv rib band and Saiiv hemoscope is due for completion of our development. And that's the hardware this year, although we believe the software will continue through 2026 as we analyse more and more clinical evidence. The third-party monitoring Bluetooth devices, and remember there's 12 of them, we aim to launch that platform next year together with the clinician portal. There'll be then add-on features on this clinical portal through 2026 and ongoing AI development as we actually get more and more real-world data coming into the platform. As far as clinical validation, we've completed clinical trials on the rib band and the hemoscope, which were for proof of concept trials. We're currently have just started a 200-patient cardiovascular disease trial in Italy via a Euro grant that's fully funded, and that's underway and will take, we estimate, 2 years to complete. We also have funding through the New South Wales MVP grant for, if you like, evaluation of the final product of the hemoscope for later this year. And we believe that the monitoring system and the clinical trials platform will be revenue generating in 2026, and we hope will be self-funded. So use of funds for this capital raising will be for the final validation of the hemoscope and rib band through 2026 and 27. As far as IP, we have lodged 5 patents, and 3 of those are already granted. Importantly, for the rib band device, and more recently, literally in the last few weeks, we got the good news that the hemoscope device has been granted in US, China and Japan, which adds a whole lot of value to our company. As far as our team is concerned, we've got a lot of experienced medtech people in our company in all areas of medtech commercialisation, and all of these guys are founders and shareholders in the business. And they range from product development, biomedical engineering, clinical trialling, manufacturing, regulatory, etc. I should also add we have a clinical advisory committee made up of a few key cardiologists that are also shareholders in the business. We're located at Western Sydney University, out at Westmead, in the Westmead Health Precinct, with options for larger space based on need as we move forward. So in summary, we have developed an integrated platform for monitoring chronic diseases, which is made up of risk questionnaires and monitoring devices, all feeding into a cloud which uses AI calculations, displaying that new and updated risk assessment on a clinician portal. We also have our 2 proprietary devices that are filling gaps in our portfolio and satisfying the unmet need for lung and cardiac mechanical function. We've got 3 patents granted, and all of this technology feeds into a system that's suitable for a large patient population and can be applied to a number of disease multimorbidities, and is really addressing this growth in digital health, telehealth and virtual care that's really been going on in the last half a dozen years. So with a very experienced cross-functional team, an ISO compliant quality management system with a great setup, I think we're at Westmead. I think we're on track for success in the coming years. As far as rollout, we're expecting our first revenue in 2026, and that may come from on-market devices, or it could be through running clinical trials for companies with treatment technologies, whether that's medical devices or medications, with a whole lot of scope for add-on products into the platform. So our call to action is that we're raising in the order of $2.5 million, which will be used for the hardware and software and AI development and clinical validation, and the initial rollout of the Bluetooth monitors and the Smart Care platform or clinician portal. So we think this is an excellent opportunity for investors to come in at an early stage in a high growth area for next generation AI-powered health monitoring, and an opportunity to partner with a team of industry leaders backed by some of Australia's leading clinical clinicians, cardiologists. So thank you for listening, and feel free to reach out if you've got any questions. Thank you. I should add we have a stand also there, so drop by. Thank you.
Next, we have Scriptsee CEO Greg Herman.
All right, welcome everybody. My name is Greg Harmon, and I'm the guy who brought all these wonderful animation productions to screen over the last decade. For your children, your grandchildren, working closely with Marvel Animation, running an animation studio in New Zealand, closely with some of these key people on the side here, the late Stan Lee, Court Lane at the top there, and Dan Buckley. We know one or two things about making animation and making content. We produced 18 TV series. We analysed a lot of scripts, 700 plus, and we made a lot of content, a lot of footage. In 2020, as COVID spread through the world, we pivoted. We decided that there was an opportunity to shift into AI, shift into a platform for filmmaking. When I say filmmaking, I mean television, I mean filmmaking, I mean content production that's scripted. So we produced a platform called Scriptsee. Now the problem that we're solving here is currently we're disrupting a very manual process. It's expensive, it's slow, it's labor intensive, and it's very subjective. What happens is that leads to delays, budget overruns, all these sorts of inefficiencies in the production. That's high risk and sometimes low reward. The solution is an automated platform like Scriptsee. Within 1 to 5 minutes, I can take a task that took 1 to 5 weeks and turn it around. I'm faster than anybody else out there. We've got much more better planning now because of the tool. We de-risk the production because we can show insights early that matter to the filmmakers, and we can unlock the creative potential. To put that into perspective, just to help you understand this a bit more, here we've got Avatar, the feature film, and one of our core strengths is emotional analysis of the story. So any show that you watch, that you like, is because you're emotionally attached to it. If you don't have that, you won't come back, you won't watch it again. What you see here, if you're looking at this on the timeline, you've got the whole show that's predicted. You've got 8 different emotions on the vertical axis. You can see at the end of Act 2, most productions are in 3 acts, 1, 2, 3. We can see there's a whole lot of anger and duress, go and save the day. If you're looking closely to that very start of the film, it starts, actually pretty hard to see, but it starts in the blue line of sadness. That elicits an angry response at the bottom, and then very quickly James Cameron's got joy, got the audience back on side. If you want to go to another algorithm that we have, this is complexity analysis. So it costs money to have effects, for example, which is what this is showing. We can pinpoint exactly where that is before you've gone and made it. We can help, therefore, not only with the creative, we're helping the other very important team, the finance. How much is this going to cost to make? And there's always a debate between those two sides. Our market is large. It has plateaued off on the top there. The TAM is about 250 billion. The reason it's plateauing off, though, is it's getting smarter. This is the spend. We don't need to have as many people in the process. We're optimizing the process. Our SAM is based on software that we see being used in the space. Studios are shifting to AI technology. It's happening. We're part of that. If you go to IMDb, there's about 35,000 registered films and television shows per year. We see 3 times that number easily in development, so we see the market at about 100,000 films or television productions at any one time in development trying to get made. We can tap into that. We can also extend our market into publishing and games and even music in the future. You can see up on screen here, this is me running around the world, product market fit. We launched the product in October 23. So we've been out there for a while now, and the last 18 months has all been about getting traction in that market space. I get up on stage, I talk at all the key entertainment markets around the world about the platform, how it's helping, how it's changing. We had some great engagement. For example, I've got a couple of quotes on here which you can see. You know, Bill Barlow from DreamWorks, Greg, you have found a really good use case for AI. Right? That was great. He's not using it, but it was great that he said that. Just coming in just recently, this is 2 days ago. This is from BBC Studios, how we're saving their time and basically turning their process on its end overnight. They've only been testing in the product since middle of January. So where we're at right now, our roadmap, as I said, we started in 2020, In 23, we launched, I guess, an MVP. We spent the last 18 months improving that MVP, making it commercial. Now the product is as simple as you go to find our websites, you log on, you put in your credit card details, you put in your script, and happy days, you know, start analysing your story. What we need from here on is to scale. We've tested the market, we've got that fit, we need to keep growing the product. So we've got a scaling and adoption coming up right now in 2025, and then keep taking this product wider. There is a little bit of competition out there, but not much. We're leading in a lot of spaces, and no one's really doing what we're doing. We've got a platform that opens up, it looks inside the script, and it helps you make decisions. Largo next to us, they do it differently. They try, based on your actors, based on your cast, based on your writing team and your production studios, and the market itself, try and predict if you're going to be successful. We're not doing that. We're trying to give you the framework so that you can be successful, give you the tools to become successful. And the rest of the products in this list here are manual, database-driven systems, not automated. We've got two pricing strategies. Pay as you go is just like a bus pass, get 5 tokens, and clip the ticket or the token as you go. That helps people get into the product, but that's not where we make any money. So it's a SaaS model, production by production at the moment. The ongoing productions, television series are a great example of that. They go for years and years and years perhaps, and every month you're paying a fee. The high-end productions here are $2,500 per month. We haven't built that part of the platform. That's where we need your help. You can see we've got a nice, good hockey stick here, but I think the key part here to understand is that it's very low operating costs. We can process that script extremely quickly, very cost effectively. We're using Amazon AWS. Come and talk to us about that. It's high scalability, high growth. It's changing the process from a manual process to an automated process. You won't go back. Why would you go back and do it manually for 5 weeks once you taste this? We're proven. We're industry folk. You can see my credentials from working with Marvel over the years. And therefore, we've been able to bring to our team some key people. I'd like to say on the top here, Gary Morenzi is one of our key advisors. Gary was the ex-president of international television for MGM and also Paramount Pictures. As well as Lydia, IDW Entertainment, a couple of key advisors there in Hollywood that are helping us navigate through that. So the investment opportunity is that we're raising New Zealand 2.5 mil. We've got an open term sheet that we're in negotiation of right now. We need to scale. The reason you're investing in us is that this is exactly what this conference is about. Exponential error. Things that go fast in this space now. So there's a real opportunity here for 10x or more in terms of the company. I'll just leave you just one last thought from this magical guy. To make a great film, you need 3 things: the script, the script, and the script. Thank you very much. Come and see me.
Thank you, Greg. Next up, we have Chris Ventura, CEO of Harness Projects.
Hi everyone, my name is Chris Ventura. I'm the CEO of Harness Projects. We're a global education and talent company. We founded Harness Projects in 2018 to bridge the gap between education and employment. We believe in creating a world where individuals can learn by doing on real-world projects showcasing their unique abilities to employers. And at the same time, have companies hire with confidence instead of gambling on unproven talent. So our mission is twofold. For our students, we solve the classic job experience conundrum. That is, you can't get the job without experience and you can't get experience without the job. And on the employment side, we help hiring managers try before they hire, observing talent perform in real-world work environments before making that critically important hiring decision. At the core of this model is a real project learning framework that we have developed and designed over the past 7 years. This framework directly integrates company projects into the student learning experience, providing real-world experience and skill training all in a single course. See, project experiences are where we build not just our technical skills, but our behavioural skills as well. Things like critical thinking, resilience, leadership, communication, and collaboration. All the skills that make someone great to be part of your team. Now, in this example on screen, we have our UX design real project framework, where students complete 3 projects with companies like HSBC, IKEA, and The Big Issue. Each project focuses on a certain technical skill area that the student is developing, and the overall experience elevates their workplace behavioural skills. Our network of industry mentors guide these students through their projects and provide assessments on their employability across 36 technical skills and behavioural traits. So while students are learning, employers are observing. They're getting to see who is the most promising talent with hard evidence of their capabilities. Now, we do this through our employability scorecard. This is a tool that we developed to assess and highlight performance across 36 technical and behavioural skills. The benchmarks for these skills was generated with input from some of the world's leading hiring managers. And these are relationships that we have developed over the last 7 years from companies like Google, Tesla, Atlassian, and more. This provides us access to a high set of quality industry data across some of the largest employment teams in Australia and the US. See, data like this is a significant opportunity for us because it gives our companies deep insights on talent that you can't find in a traditional recruitment process. Now, I've crammed a lot into this slide, and it's because we've done a lot. Over the last 7 years, we have partnered with over 125 company partners, brands like IKEA, HSBC, Qantas, Westpac, Greenpeace, and many more. We have completed over 200 projects and expanded our programs from Australia to the US market in 2022. Our customer feedback is exceptional with over 4.7 stars on Trustpilot, which I can tell you in education is market leading. We've delivered projects in design, cybersecurity, product management, and digital marketing. This is just the beginning for us. So we've set some strong foundations for the scaling of our model. The B2C side of our business is generating strong product market fit in 2 markets with 40% year-on-year revenue growth and 65% gross margins. We're monetizing the B2B side of our model as companies pay for talent who perform on their projects. This completes a growth flywheel where one side of the model is providing engagement and value to the other and vice versa. We're further investing into technology to scale our data collection and provide hiring managers a deeper level of insight into candidate performance throughout each project. Now, how many of you have hired someone only to feel that they weren't the right fit for your role just a few months in? Hiring managers often have to make these critically important hiring decisions off a limited set of interviews, leading to bad hires and the risk of a lengthy onboarding process before someone is even productive. We've all had this experience. Our model changes this with a try before you hire approach, ensuring new talent can be chosen on a robust set of experiential data points, producing highly vetted and productive team members from day one. To ensure our company partners have access to all the deep insights that we collect on the participants in our projects, we are investing further in an employability data platform. A platform that can surface workplace behavioural skills to hiring managers and help them make really informed hiring choices. Now, we're able to do this because of all the work that we've done over the last 7 years with our real project experience framework. All the way through a participant's project, we collect data on how they show up in the project. Did they demonstrate resilience? How did they present? How did they communicate with each other? All those nuances that you can't necessarily find out in an interview process. Now, one of the larger demand areas that we're hearing from our partners and mentors is in cybersecurity. Earlier last year, we launched our cybersecurity real project experience framework, and we're now the only company in the world with a fully project-based cybersecurity course from day one all the way through to graduation. The addressable cyber talent market in the US and Australia is $5.6 billion, and this is just one of the skill areas that we're targeting. Our goal is to have coverage across all the major high-growth digital skill areas as a global workforce is going to force to pivot into new roles due to AI's disruptive effects. We occupy this really unique space between your traditional boot camps, universities, and talent provision services. Unlike boot camps that focus solely on training, we help students get real-world project experience through our curriculum. And unlike internship platforms or placement providers, we offer real-time visibility into a candidate's performance in a structured, methodical way. This makes us a really logical choice for companies who don't have the resources to invest in their own internship programs. So in 2025, we're focusing on 4 key strategic initiatives. We're continuing to grow our B2B partnerships and expand this talent as a service model across cybersecurity, design, and data science. We're developing a B2B2C marketplace platform to bring our students and our companies together under the one experience, providing transparency into a candidate's skills for the hiring managers and a pathway to employment for the career changers. We're continuing investment in our employability scorecard and conducting further mapping of all the experiential data points that we have in our model. And we're collaborating with the Digital Health Cooperative Research Centre and the University of Sydney on a data science real project framework. This last one is a really great example of some of the organic reach out that we're starting to receive from government and universities alike about our model. Our team has a proven track record of tackling tough challenges. Over the past 7 years, we've built a world-first educational model and scaled this across Australia and the US. We've taken market share from highly funded VC-backed competitors, and we've done this all as a bootstrap company. We raised a small family and friends round in 2022 as we brought on our board of advisors, and we're now really well positioned to take the next step in our growth. My co-founder, Mike O'Brien, has over 25 years of experience in academia and education. My background is in digital product management. I was former head of digital at Laureate Universities, and I bring a product and commercial lens to the work that we do. We've been really fortunate to have the guidance of some exceptional advisors, including board members as the former MD of Seek Education, the former MD of Spotify and Peloton Australia, and the former CTO of Laureate Universities. We're now seeking $2 million to fund our growth plans and realise our vision of bridging the gap between education and employment. Key roles include investments in technology, sales, business development and product. And we feel that we're incredibly well positioned to be the go-to educational and talent model in a world that is rapidly changing due to AI advancements. The next generation of career changers, it'll be critically important for them to showcase their behavioural skills, all the human skills that will make them employable in this future workforce era. So thank you. If you want to get in touch with us, we're in the exhibit hall. Love to have a chat and talk more about our model. Thanks a lot.
Thank you, Chris. Next, we have V-TOL Aerospace, the CEO, Rob Hughes.
Afternoon. V-TOL Aerospace is an AI-enabled developer AI-enabled airborne robotics. Mainly focused on the electricity technology or infrastructure sector. Our technology is patented. We develop it ourselves, we manufacture it ourselves, and in some cases, we operate it ourselves as well. Currently, we're looking to scale the business. We've got revenue coming in from our technology, but looking to raise capital to scale the business and to grow it. We have in place an experienced management team and a board, and additionally, we are a CAS licensed drone operator, as well as having our own fully owned registered training organisation through which we can develop drone operators and drone pilots. Within the electricity infrastructure sector, the problem is there's a lot of it, but it's ageing. It constantly has failures. It needs to be maintained. It's a massive asset management challenge. In addition, with the energy transition, it's expanding. Even just within Australia itself, there's 10,000 kilometres of new transmission lines required to meet what AEMO believes the future will look like. With that is coming new levels of compliance requirements, whether that's human safety, wildlife safety, environmental impacts, those sorts of things. And those traditional work methods just aren't meeting the challenge anymore. They're highly human intensive, there's safety issues, the environmental impact is quite high. They often hang people out of helicopters. They're using normal manned aircraft, so the environmental footprint is quite large. Our technology has solutions for that problem. We've got three key pieces of technology. The first we call RotorFix. It's used to attach rotor markers, so visual markers for power lines, either for aerial visibility or even ground strike visibility. They also work as bird diverters. We are the global partner to the manufacturer and to the global distributor to attach these devices, and we're the only people globally who can do it via drone. Then there's Pegasus UAV, which is a fixed-wing, long-endurance, solar-powered UAV that we're developing. It's actually in first of types in assembly currently, and flight tests will start next quarter. Its potential use is surveying of the assets running down power lines, the length of the power lines, collecting imagery, collecting data from it. And the third piece is a machine learning AI tool we call Fault Finder, which analyses all that data and can very quickly and efficiently identify faults and issues with the lines. Much of that is done manually currently. It's very costly, very expensive, and actually very inaccurate in doing so. So all that technology, we've either got it in use or it's been developed and demonstrated with customers. As I said, our focus at the moment is the energy or the electricity transmission distribution sector. There are cases for it in Australia, but there's also uses of the same technology in other sectors, be it forestry management, environmental management, emergency management, and there's even defence applications for some of it. But currently our focus is in electrical infrastructure because that's where we've got some great traction and some engagement with clients. As I said, the technology is revenue generating. RotorFix is the primary generation of that revenue currently. We have undertaken paid work with 6 different utilities in Australia. As I mentioned, we have the global agreement, and our patent technology enables us to be the only operator who can actually attach those markers via drone. There are tenders out in the Australian market currently mandating the use of the rotor marker and mandating that it has to be attached via drone. So that market is growing and existing, and we are now part of the utilities' demand and their design requirements around their infrastructure. As I mentioned before, there's 10,000 kilometres of new transmission lines being forecast. We believe the revenue opportunity just in Australia is 100 to 150 million. We've already been approached in Canada and North America where that, and even going to UK as well, that market is much, much larger. Pegasus and Fault Finder said they're both in demonstration phase. Coupled together, they do what currently takes months and months and is highly inaccurate for people to try to do that. Same issue. Possible commercial models, obviously there's a sale of technology to people, which in some cases might be the case, but I think mostly from our experience, a lot of it will be service offering, either by V-TOL ourselves or licensing third parties in other geographical locations potentially. We have the Pegasus platform is actually being supported by a government grant from the federal government, from the Emerging Aviation Technology Partnership, and that's being undertaken in collaboration with 2 other Australian companies. And the key for us with all of our technology development is actually to ensure that the development of the technology and then the production manufacture of that technology occurs here in Australia. The sovereign capability requirement around some of the key infrastructure and the use cases is essential for our country and for other similar countries globally. We have recently applied for a Made in Queensland grant. We are Queensland based. Part of our capital raise we're looking to do is to raise capital to establish a production level facility for our technology. A few logos there of people we've worked with, customers. You'll see a number of the large infrastructure companies in Australia. Sakam is the global distributor of the rotor marker. Balmoral Engineering is the manufacturer of the rotor marker, a Sydney-based company. LIS Energy and Halo Cell are our partners with the Pegasus platform. So very much an Australian centric technology development, and at the moment the market is very much in Australia for us, but we've done work in New Zealand and we're getting approaches out of North America. I won't go through the details, but they're the sort of the board and the key management people, all with experience in this sector, with growing businesses, with driving and raising capital. So the projections for the business, as I said, we are generating revenue currently. We believe within 3 years we'll be generating 20 million revenue per year. EBITDA positive within that 3-year period. As far as ongoing CapEx, once we get particularly the scale, the Rotofix part of the technology suite, that will generate enough revenue to continue to sustain organically that business. We may need to look at future capital for investing around technology expansion, either adding to the capability or expanding the use cases across other sectors. But for the time being, this initial investment will help drive the organic growth of the business. So we're looking to raise $2.5 million effectively to scale up the capacity of the business, to accelerate some of the technology development, and to establish an Australian drone manufacturing capability to support the capability. As I said, we have applied for a Made in Queensland grant, which is about $1 million, which will also complement the capital raise we're trying to do. Thank you.
Thank you, Rob. Now it's time for our second panel discussion, the private credit investment trends in 2025. Please welcome our panelists. Chris Broad, Director at Left Field Capital Partners. Yossi Kramer, Co-Head of Capital Partnerships and Director Funds Management at Salter Brothers. Christian Brem, CEO from FC Capital. Nicole Kidd, Managing Director at Schroders RF. And Harley Dalton, Managing Director at Alter Capital.
Thank you. So to kick things off, I'll just set a little bit of the scene, and then I'm going to ask the panel members to introduce themselves. They say a week in politics is a long time. Well, I think in private credit at the moment, you could say a day is. There's almost something happening every day in this space. So we want to talk a little bit about what's going on in 2025 compared to last year. Secondarily, we've recently had our first cash rate reduction since some very big changes in the middle of 2022. And thirdly, if you're a keen observer of the financial newspapers, yesterday's Fin Review says ASIC zooms in on private capital funds. So let's just touch a little bit about what that actually means. So first of all, just immediately to my left, would you like to introduce yourself and where you're from? Thank you.
Sure, thanks a lot, Chris. Yossi Kramer from Salter Brothers. We're a Melbourne-based alternative investment manager. We've got just shy of $5 billion under management, 5 offices around the world, Melbourne, Sydney, Brisbane, Singapore and Japan. We've got multiple products. We're direct real estate and property. We've got credit, both corporate credit and real estate credit. And we've also got an equities business which looks at technology investing and a listed small caps fund.
Great, thank you.
My name is Christian Brem. I'm the CEO of FC Capital. We're a Sydney-based credit manager. We got just shy of $1 billion of assets under management, mainly focused on corporate credit, asset-backed opportunities, and private securitization vehicles. We do not do property. Probably have done property once in the last 2 years. Our main focus is the Australian New Zealand market. Our capital is mainly offshore, and we just launched our first Australian vehicle, essentially.
Hi everyone, my name is Nicole Kidd. I'm from Schroders RF. We are a mid-market commercial real estate debt lender. And Schroders RF is a joint venture between Schroders, the large global British asset manager, about a 1.4 trillion Aussie equivalent AUM, and the Roberts family, which has its DNA in real estate. So former family who established Multiplex, and the former CEO of Multiplex's family office.
Hi, my name's Harley Dalton. I'm the General Manager of Altor Capital. Altor is a boutique alternate asset management business based out of Brisbane. Have 10 staff on the team. I've got a corporate credit fund with no exposure to property. We're going to talk a little bit about that, Chris, in a moment, about how we're all different across the table here, and look forward to sharing some insights around the credit markets.
All right, thank you very much all. Yossi, we might just kick off with you first of all. You've got a wealth of experience across this space. Can you maybe just unpack a little bit about why was last year such a boom year, and is 2025 going to be the same, or are we going to have a different trajectory?
Yeah, it's really interesting. There's been a lot of press about how much private capital has actually grown and private credit's really grown over the past year. But really, if you actually look back, it's actually grown even more previous years. So last year was a bit more of a consolidation year. The current market, if you want to look at private credit, is probably about 205 billion or 180 billion, depending which report you want to read. And it's really experiencing about 7% to 9% growth per annum. But when we put that in perspective and what we've seen globally, where you've got about $1.7 trillion US as far as the kind of growth which you're seeing in other markets, globally, I think Australia's got a long way to go, and this is really just the start of that whole shift to private credit. I think the other thing is that which is really driving it is we've got to look at both supply and demand. It's why is it occurring and what's the demand side. On the supply side, there's lots of opportunity in private credit, and that's driven by APRA and driven by the bank's reluctance to provide credit to keep the economy driving, and that's really an important element. And on the demand side, we're seeing lots of both institutional and private wealth investors looking at this as an alternative asset class, as really as an alternative to fixed income and a way for them to grow. So by having both the supply and demand, we believe we're going to continue to see that growth.
So are the banks the best competitors you could wish for?
Absolutely, and we want them to continue to swim in the lanes that they want to swim in.
Very good. Harley, there's some big numbers in all this. We talk about the billions. If we just then look down at your business and your niche, as an asset manager, your role is really to, as I like to say, you're one golf club in the bag, right? You do that shot really well. So what do you do really well in your space?
Thanks for that question. I'll just to Yossi's point there too. In Australia, we think about credit as this new asset class, but in the US, this is a very normal conversation, and it's a very normal part of most people's portfolio. So it does appear that it's very on point in the last couple of years. But I think if you fast forward 5 or 6 or 10 years, we'll look back and most portfolios in Australia will have a credit position. In our tour, I'm at the coalface, so we run an active management in providing sort of a $5 to $15 million solutions into growing businesses in Australia. And by active, I mean we will get inside those businesses to create value. I will pay back out to my investors a 10% distribution, and then I'll be looking to actually add extra alpha to that return in the form of taking an equity position or a warrant position or some sort of exposure where I say, I'm going to come in as a private equity player, I'm going to actually add value to your business, but I want to get rewarded for that, and that goes back into our unit trust to the benefit of shareholders. So, what is private credit? We have stepped into a space probably across the table here where the Australian banks have pulled out. And if I won't ask people to raise hands, but if you were a business owner in this room and you went to go and ask the bank for a credit position, it's very bloody difficult in this country now. The banks are not open for business, and this is a solution that has to come in and provide growth capital for these businesses.
So really for your clients, this is an alternative to the traditional bank model, effectively?
100%. The banks aren't open for business and they need a solution, and we want to come in and help those businesses grow, and we'll actively do that. So by active, I'm saying we will sit on boards, we will take observer rights. I don't want any surprises in my portfolio. I want to be ahead of any problems, and I want to be able to help those businesses.
Great. Christian, you can give us a bit of an international flavour.
Yeah.
Some comments already about sort of the private credit market in Australia is still relatively nascent.
Mm-hmm.
What does that mean for the growth we're still going to see as we're playing, in some ways, globally playing catch-up? Yeah. Are we going to see more products here in 25 that we haven't seen in 24 simply because we're just going through this growth journey? How do you see Australia comparing to the rest of the world?
I think there are two parts to it in Australia. One is the property side, and one is then the corporate credit side. And I think on the real estate side, and it goes to construction lending, goes to permanent real estate lending, we are fairly advanced in terms of what we do here and the players we have. We have players which are taking $200 million tickets, $40 million tickets, all the way down to two. So we have a very well diversified universe, and investors can access that. Where we have probably an underdeveloped market is on the corporate side, and that's basically, which is growing at the moment. And the players in that space are, I would say, compared to the US and in Europe, there are not many of size where you can invest into, because you need to have a team there, like a very well-established team, a pipeline, you need to risk assess. So if you compare this to the US and in Europe and you speak to investors who are fairly active, let's say a Japanese pension fund, right? Then they go like, well, I got in the US like 30, 40 players which are north of 60 billion. I can pick. What's happening in Australia? That doesn't exist here. That doesn't mean that our market is not well developed, but our market at the moment holds an opportunity to develop that, to invest into it. But also what we as Australian fund managers need to do is develop the market, because we need to explain what private credit is. So I would say there is a bit of an arbitrage, a bit of a premium you can probably charge at the moment, which will probably go away over the next couple of years. But if you compare the Australian lending segment and you combine real estate and corporate, we are so far behind Europe and the US. I'm not sure what data we can use. I would say it's 15 to 25% of the lending here is done on the private side. In the US, it's probably 90. In Europe, it's 65. Here, we may end up in a European situation at 65 because our banks are fairly strong. So I think there's a good opportunity here to focus on both segments and focus a portfolio which is balanced or focuses on corporate and real estate at the same time.
Yeah. So 10, 15 years ago, when you were explaining to people about investing in private credit for property, you were really having to go through a whole chapter and verse on what that actually meant. And now what you're saying is that's almost sort of baked in, but we're now perhaps talking about the next evolution, just briefly, next evolution of the products under that private credit banner.
It is sort of baked in. I think the products will be products which are fairly well structured, simple structured, where we see an educational pieces on the borrower side. Yeah. Not so much on the real estate side, more on the corporate side. Yeah. Often people don't know private credit exists.
Yes.
And then you have to give them a bit of a background in terms of how do you transact, what is your expectation, who are you, and the question we get. So
to a certain extent, you're still going to have to educate the market. That's
100%.
That's the short answer. Yeah, great. Nicole, I just referred at the beginning about we're on ASIC's radar. We've talked a lot about the growth and the acceleration of the product. Are there some breaks here? Are we going to see more scrutiny in this space? Do you think ASIC's lens on this is justified, given the size of this space compared to the rest of sort of public markets? And what do you think is likely to come down the pipes? And I won't hold you to your crystal ball gazing.
No, I mean, it's a really, really good question, and not the one that's on our list, by the way, Chris. That's all right.
Well, keeping it interesting.
Yeah, that's okay. So, look, there's been a lot of chatter in the press about private credit, particularly about the opacity of private credit. But as investors are looking for new and interesting things to diversify their portfolios, for all of the reasons that my co-panellists have spoken about, private credit really does offer an interesting thought bubble for investors to consider. Returns are attractive. There is more risk, understanding what that risk is, but also it's a very broad church, right? What we all do sitting on this panel, some parts of it may be similar, some parts of it could be vastly different. So if you are becoming a more active investor, and we've got lots and lots of wholesale and self-managed superannuation fund investors in this country looking for ways to take more control over their investment decisions, private credit does offer that because, as Harley mentioned, the banks have really changed the way that they do business in this country. And private credit funds have stepped in to assist corporate Australia and to assist the real estate developers and borrowers in this country to keep getting stuff done. So I welcome the opportunity to talk more about the space and to sort of dispel some of the myths that you see. There's a lot of chatter from competitor funds that aren't focused on this space about why it's bad, but I welcome the scrutiny. I think talking about the data behind what it is we do, none of us are sitting here saying we're not willing to talk about what it is we invest in, and I think the focus from the regulator is is broadly welcomed by the private credit market.
If you're already doing the right thing, regulation 100%. Is actually a tailwind, right? It's a good thing.
Yeah.
So I think, you know, probably all of us actually welcome a call for transparency so that investors are really clear about what they're getting and what the underlying assets are. If you think back to the GFC, one of the things that happened afterwards is they interviewed people and said, did you understand what you're investing in? And it became very clear that people had no idea, particularly the government in Iceland, apparently. But
if you read the report...
So that's one of the challenges. If you're investing, you want to know that you can actually have some look-through, right? I think that's important.
For those of you that have needed some bedtime reading last night and you decided to read through the 66 pages of ASIC's review, which is available publicly, they're talking about the fact that the private credit space is not systemically significant at this point in time. All of the, you know, the regulatory environment is set up to be successful for private credit. I don't know, Yossi, if you have a view.
Yossi, did you want to just add something?
Yeah, I'd actually go a step further than that. The reason why private credit began existing in Australia and exists today is because that's where the banks are not playing. And it's not because the banks don't want to lend there, it's because the regulator has got stricter capital constraints because the banks are so significantly important for our economy, the 5 banks that we really have. And so what we're lending to is we're not actually even creating super innovative products. I'm not trying to say that we're being special out there. We're actually doing what the banks had been doing previously, and we're just getting paid a lot more than what the banks were even charging previously. So we're not reinventing the wheel here. And so therefore, when you have commentators come from the US and talk about the risks which are involved, the US is a very different market. There's a lot more leverage in it. There's a lot more risks. A lot of the funds there are very heavily levered. Ours are very basic products and very simple. They're effectively bank-like products which are offered by non-bank lenders.
Yossi, you touched on risk there, and I think I'm just going to open it up. I'll kick off with you, Christian. As a leader in this business, when you look at risk for your business, what are the things that keep you awake at night? Is it deal flow, access to capital, regulation, economic conditions, the planning environment, market? Which are the ones that you think are prevailing in this year ahead, and for investors in this space, what are the ones that you think they need to be most thoughtful of?
For us at FC, I think, you know, deal flow is fine. Our pipeline has doubled since the last 12 months. What really keeps us awake is human resources, finding the right people, retaining the right people, finding good juniors, training them up, essentially in our business, and then transacting and risk management in the sense that how do I construct my portfolio, what are the industries I want to tap into, what are the industries I don't want to play into. So that's for us the biggest day-to-day conversation. Is this a business I want to take a position in? I want to fund, even with senior secured. Is this a business which will survive, you know, and is this a business which can grow? We have seen turnaround opportunities where the business and the industry itself is a dying industry. Nothing has changed. The balance sheet was cleaned up. Yes, they're profitable. Do I want to lend to them? Probably not. I'll probably get more headaches. So it's more portfolio composition, the human resource element. I think from us, capital-wise, and what we see at the moment, there's a lot of demand for Australian credit. There's an immense demand from international investors at the moment, to a point where, you know, some people deploy in Australia probably with less of a risk management approach at the moment from the international scale, not Australian players. So that's our main focus on and the main risk elements we are seeing for our business at the moment in our market.
Yeah. So really plenty of opportunity, but it's about how much constraint there is in your business to be able to execute this from a Labor point of view. Please write to your local MP when you're discussing immigration. Harley, what about you? You're in a slightly different space in terms of looking at businesses to invest in, and therefore there's some much wider economic factors that come into play. How are you seeing the current climate?
In our industry and our, you know, my business, it's coming down to credit risk and your assessment of credit risk. So what keeps me awake at night is an economic shock, which you obviously can't predict. But we haven't seen a recession in this country for 25 years. And so understanding.
Is that because the government just keeps employing more public servants?
Yes, we just
at
keep
the
on
moment,
pumping a little bit,
right?
having that safety net there, and that safety net just keeps going and going. But eventually that will stop. So credit risk, and then how do you mitigate against credit risk? And for us, that's around backing good quality businesses with tailwinds. And a lot of it, as we would all know in this room, you're backing, at the end of the day, you're backing people. And you're backing people to execute on a plan, and we would just want to make sure that we are across that business and don't get any shocks, which is why I want to be sleeves rolled up in the business, not waiting for someone to come in and go, I've got a problem. We want to find out if there's a problem before we get to that problem. So.
And at any point in time, when you look at the sort of the number of transactions you're reviewing and the ones that actually drop out the bottom, sometimes your funnel sort of looks like that, and sometimes your funnel looks like that. What does your funnel look like at the moment, Harley, in terms of opportunities and conversion?
It's probably a little bit narrow at the moment. We have got opportunities, and one of the growth areas, I'm not sure if anyone heard Pete Sellerman talk before, but in this country there is this, that everyone's talking about intergenerational wealth transfer. It is real. 2 out of the last 3 deals we did were management buyouts. And that is people who can't find the other side of the transaction, and it ends up being internal. So the funnel is big in that area. We don't suffer from a lack of deal flow. It's actually how fast we can tick something through, and you want speed in crossing businesses out.
Okay.
Thank you.
Nicole, what's your read on the risk environment for the next 12 months for the type of offering you have?
Well, I mean, the biggest challenge that we have in our portfolio at the moment is, getting the deals to fall through the bottom. And they're not falling through the bottom because we're not competitive or not winning them. They're not falling through the bottom as quickly as we'd like because of a lot of sort of risks around, approvals of development applications and issues with process and planning in various different states. And there's no homogenous planning system within each state in Australia. So we find a lot of borrowers are almost paralysed by delays or additional things that need to happen post the bushfires. You now need the RFS to sign off on your planning, and they're not incentivised to push things through so quickly. So we have a great housing shortage in this country. We have no shortage of borrowers wanting money to get their developments off the ground. We have a real issue with planning approvals that is paralysing some parts of our market in getting developments and product out.
And would you say that's on both the way in and the way out, i.e. to get the thing going, but also at the end?
No, mostly on the way in, yeah.
Mostly on the way in, yeah. Okay, yeah. I mean, one thing we've observed is that once you get to practical completion, if you're doing something in the property space, to go through the paper chase of getting the thing actually repaid at the end of the day. Yossi, I don't know whether you've got any comments on this, but you're almost out of the build, but you're into the paper chase.
Yeah.
What happens?
Yeah, and you've got risks as well with the construction side is can you get the power connected? And, that can take, you've got in your model, you've got that for 1 month, and it ends up being 3 or 6 months to get all of those trades in and to get your money back. And when we look, and that's really the key, is the first risk that we look at any transaction is, we consider this like fixed income. We've got a very low tolerance for risk, so we've got a very narrow area which we like to lend in both on the corporate and on the real estate side. And that's because, we look at the risk and we say, we just want to get our money back. We're looking at this like fixed income there.
Plus your interest, Yossi.
Sorry?
Plus your interest.
Plus the interest, yeah, of course, but we want to get our money back is what we want to get, and that's the key risk. And what are the risks around that? And that's where we work from backwards then, is saying, okay, what could prevent us from getting our money back? Is it delays, and what kind of delays is that? Is it the people? Are the people really motivated on the corporate side to get those businesses working, to get the turnovers required that they have for those businesses? For the construction side, is that the right motivation? Have they got the right partners there? Have they got the right pre-sales? It's really looking at all of those risks to make sure that we can get to that final point where we're repaid and where we've made our money and we can return our money to investors. And that's the way we look at it. And I think that what we're seeing a lot out there is that there's an abundance of transactions, and therefore we can really be picky in this market, and I'm sure you're seeing that as well, Chris. I've never seen so many deals on the real estate side and on the corporate side in 30 years that I've been doing this now. Haven't seen that many deals that we can actually go start sifting through, and we can be really selective on who we want to lend to.
Yeah. So there is a lot of sifting through at the moment to get to the gems. Nicole, just for your business under that wider Schroders umbrella, if you look at investment classes, ultimately there's really only 5, right? You've either got cash, equities, property, fixed income / interest bearing, and alternates. We might put crypto or gold or whatever in there. How has your business effectively been plugged into that wider platform?
Well, private assets is one of the fastest growing investment areas globally, and Schroders, being a very global business, sort of 38 countries we operate in, are very interested in building a private assets platform. Real estate is a part of the market, whether it's equity or debt. People understand real estate. Like if I said the words the Great Australian Dream, like everybody in this room would know what that means, right? We all have the dream of owning our own home. Like people understand real estate. They have either had a home loan, aspire to have a home loan, or know someone that's had one. And so from a real estate perspective, we find that it is a part of the alternatives market that people can easily understand. And so when we talk about the education, in the spectrum of education of what is an alternatives investment, it is one of the more easily understood parts of alternatives investment. We also have security, I think, and that gives people a lot of comfort. So we find in our business in Schroders RF, we have a lot of retail investors. Those retail investors are in their income generation portion of their life, so they're looking at our product as an alternative to traditional fixed income. A way, not replacing it, we recommend it as a satellite allocation, but it is a way to diversify your portfolio, to become more active in it. And also from a Schroders perspective, they see this as sort of an increased way to think about democratisation of private assets.
Great, okay. So I'm just going to try and recap 25 minutes in 30 seconds. So here goes. So we're hearing still plenty of opportunity. Growth rate might be flattening, but that's just a natural product of the bigger you get, the harder it is to keep going at the same growth rate. Regulation is actually generally welcome, certainly by all of us here. This is becoming a big industry and we need more people, to your point, Christian. And also, no return comes without risk. So we are all, I think, when you're looking at investment managers, we're all very, very focused on risk. And we're devoting a lot of energy to that. And hopefully that's put us in a good place. So I've just hit 0 seconds left. So can I please ask you to put your hands together and just thank all of our panellists this afternoon.
Thank you to our panelists. Now that we are caught up on time, I would like to introduce you Directo. Directo is a company transforming digital payment systems and financial transactions through advanced fintech solutions. Please welcome Gavin Apiter, the founder and the CEO.
Good afternoon, everyone. Directo is a B2B e-commerce marketplace that is radically simplifying. It's radically simplifying the supply chain between pharmacies and their suppliers. So just before I jump into a little bit of detail about the problem that we're looking to solve, I'll just give you a bit of my background, which is to say that I've had 2 successful businesses supplying into the pharmacy channel over the last 20 years. And I would say over those 20 years, there's probably not a single pharmacy in Australia that I haven't supplied some product to over those 20 years. And what that's allowed me to do is really, over those 20 years, understand how to overcome the challenges in getting product onto the shelves of a pharmacy. And the challenges are certainly overcomable, but they come at a cost. And it's really that understanding of what those challenges are and how to overcome them that has led to this business, Directo. So I'll just jump into a little bit of detail around the problem that we're solving here. And that starts with the pharmacy. So on the side of the pharmacy, pharmacies are often dealing with over 100 individual suppliers. Right? They have a large portfolio of products that they need to have on their shelves, and this can often be supplied by a list of over 100 suppliers that they have to deal with. That's a lot of complexity, and there's also a lot of pricing and promotional complexity in how those products are supplied into pharmacy. If you look at the supplier side, any decent supplier in the pharmacy space is dealing with around 3,000 individual pharmacy accounts. These are generally quite small accounts. That means that the supplier needs to go and collect money from those accounts and deal with accounts which may in some cases be sub $1,000 type accounts per month. There's a lot of pharmacies for those suppliers to have to deal with on an individual basis. We know the size of our country, and we know that the pharmacies are spread out really well around the country, and that leads to a lot of complexity and cost for suppliers to have to service these pharmacies well. The two, and as I say, there's a lot of pricing complexity in the deals that are being done between the suppliers and their pharmacy customers. So the two key things that come out of this are, number one, the cost. There's a significant cost for both the pharmacy and their suppliers to deal with the complexity around this interaction. And I would argue, even more importantly, there's a significant lost sales opportunity. So because of the friction points that exist, there's a significant amount of sales that are lost between the pharmacy and their supplier because of these challenges. So these are the difficulties I've certainly lived and breathed over the last 20 years, and these are the problems that we are aiming to solve with Directo. So as I say, it's a B2B e-commerce marketplace. Essentially what we've done is we've integrated with the pharmacy's point of sale system, and we've integrated with the supplier's ERP system to be able to connect up the data between those two parties so that there's a really seamless interaction between the pharmacy and their supplier. Essentially, we're letting the technology do the work and taking away a lot of those friction points between the pharmacy and the supplier. So I'll dig into this in a little bit more detail, and again, starting with a pharmacy, what does this look like from a pharmacy's perspective? So essentially, for the first time now, a pharmacy has this opportunity to have one supplier for everything that they need. We can become a one-stop shop for pharmacy. We are consolidating already many of the pharmacy suppliers into one account. So that means one person to call for customer service, one bill to pay at the end of the month. They're getting extended payment terms, which is helping their cash flow. They can order via a world-leading e-commerce experience, which means that they can order whenever they need to order, on a mobile device, off their computers at work, wherever they are, and whenever and wherever they are. As I say, we're integrated with the POS systems. The access to data is really important for the pharmacy to be able to see the pricing, to see the promotions, to understand what stock is available at the supplier. All of this access to data is part of what reduces the friction between the pharmacies and their supplier and facilitates for a better transaction. And of course, we list discovery. Effectively, the pharmacies now have this endless source of access to products in one supplier. On the supplier side, and just looking at the benefits for suppliers, it's really about making sure they get that order 24/7. We're seeing now a lot more orders being placed early in the morning, late at night, after hours, on weekends. When pharmacies have an opportunity to order, that's when they need to be ordering, not because it's during the day when the suppliers are available. Right? It's growing sales for suppliers is about getting more orders from your existing customers and getting more orders from new customers. And making it easy for those customers to place orders is central to making sure you're getting all the orders that you can possibly get. We're helping those suppliers increase their margin because we're significantly lowering their cost of doing business with pharmacies, significantly lowering their cost of getting those orders. They have improved cash flow. We pay them on time. They get one payment. Instead of going to have to collect, in many cases, thousands of payments, they can get one payment, and it's always on time. That's helping their cash flow. And ultimately, they are giving their customers a way to order, which is the way that the customers want to order. And that makes their customers a lot more sticky to them as a supplier. It's a huge market that we're dealing in. The pharmacy market alone in Australia is $20 billion. It has two segments. The first is what we call the wholesale segment. So this is where you have the key pharmaceutical wholesalers. There's really four main wholesalers, and that's mostly the medicine. That occupies around about 3/4 of the market, around $15 billion. There's around $5 billion that is what we call direct suppliers. So these are suppliers who choose not to use the main pharmaceutical wholesalers, but supply directly into pharmacy. This is currently our core focus area. We have significant opportunity beyond the pharmacy channel. I've listed there a number of segments that we see opportunity in. It's obviously a huge addressable market outside of pharmacy. Today, we're really focused on making sure the solution is maxed out in the pharmacy channel before we start focusing on some of these other channels, but we already have suppliers who are pulling us into some of these other verticals just because they simply need our solution. So we already have a number of health food stores, independent grocery stores and so on our platform simply because our suppliers have needed us to help them in that area. So we see a lot of opportunity outside pharmacy. For now, we're still focused on the pharmacy channel, and we'll move beyond. We deal with a lot of suppliers and pharmacies that you'll recognize, but I think probably the most important piece about our business is the traction. We've been doing this now for 5 years. We have around $40 million of annual transaction value through the business. We're dealing with over 3,500 pharmacies. That's 60% of the market have already adopted our platform. We've grown our business 100% year on year for the last 3 years. We're on track to do that for the 4th year in a row. And I think the most important piece to call out is that while we're dealing with 60% of the market, they're only directing a small portion of their spend onto our platform at present. Yet they've stated a desire to direct a significant amount more onto our platform. Those 60% of pharmacies spend around $1 billion with their direct suppliers, and they want to bring it onto the platform. This presents us with a significant growth opportunity in our current channel to grow the business around 30-fold and get to our target in the pharmacy channel of at least $1 billion of trade that we can do supported by the existing customers we have and them spending more with their suppliers on our platform. We have an experienced team. I won't go into the background, but the team's been working in this industry for over 20 years each. And we're currently doing a cap raise at the moment, which is a convertible note. We're also offering options as part of the convertible note. And interestingly, this is really to fund working capital. There's a small portion of our business where we pay our suppliers ahead of when we collect from our customers. And we're really looking to secure essentially a facility, but we're doing it via a convertible note, which is funding $2 to $3 million worth of working capital for us to continue to grow the business. So I know I'm pretty much out of time, but we have a significant first mover advantage. We're in a very large market. We have very, very significant traction. So I'm super excited about what we can deliver and look forward to having a chat with anyone who's interested to learn more. Thank you.
Thank you, Gavin. Up next, we have a presentation from our sponsor, Succession Plus. They help business owners plan for succession, exit, and long-term growth, ensuring a smooth leadership and ownership transition. Please welcome David Plant, the partner of Succession Plus.
Thank you. Right, so disagreement. Terrific. Okay, good afternoon, ladies and gentlemen. We're on the home stretch now, so hang in there. Thank you very much for staying in with us. So today, what we want to talk about with respect to Succession Plus is what's kind of our primary value proposition. So we tend to work with business owners to help them, as it says, maximise the value of their business and achieve a successful exit. Now, this is harder than some of the business owners think. So this slide, when I show it to you, I'm sure many of you are sitting there going, thanks, Captain Obvious, we appreciate that. There are only 3 areas that we need to look at, the business, the owners and the money, but the problem is that the majority of business owners that we talk to don't think about those 3 particular areas. In many cases, they're very much focused on the money and not looking at the underlying strength of the businesses. So that's been something we've been speaking with quite a few people in this conference about over the last couple of days, is the fact that many of you are looking to invest in businesses, perhaps through private equity, through taking ownership, etc., but the businesses aren't ready. So oftentimes we find that people haven't prepared sufficiently. Many times we're looking at least a 5-year, to get maximum value out of the business, we're looking at least a 5-year window to work with businesses, and I'll show you what we concentrate on there to help them build the value of their business. But unfortunately for some business owners, they don't get a choice. And as you can see there, that many of the people that come to us to get us to give them a hand with the preparation of their business for sale, it has been a catalyst. Something's happened in their life or in someone else's life in the business or family that's going to make things happen from that perspective. So many times we're having to work urgently. We're having to try and improve a business rapidly because someone's saying, it's happened now, I need to get out. So one of the things we really encourage our clients to do is to prepare early. So when we do go through the process, we have up to 21 steps that we deal with respect to businesses in helping them build their value. You'll see that there's a few stages that we deal with. So at first, we've got to understand what the clients are looking to do, what our businesses, get a bit of a fact find done there. And then we look to identify what the opportunities are and what the challenges are. We then very much, and it's one of the areas that a number of people who work on improving the value of businesses don't necessarily look at, is making sure the foundation's there. We need to protect the value. Many times it's about making sure that people are sufficiently insured, that everything's in place so that if something does go wrong, as I showed you with the previous slide, they're able to adapt to it. And we go through a process to identify these various different steps to assist businesses in improving their value. So the way that we do it, one of our big mantras is it all starts with insights, and we start with a business insights report. So what we look to do with our clients is that we try to help them understand what their business is worth, and we do it from 3 primary areas, given our experience of about 15 years in this space. The first one is that we look at the first one that we do in terms of business growth insights report is we give them a scorecard in terms of 6 different areas of their business so they can understand where they're strong and where they're not. We don't just work on financials. That's too basic with respect to people who want to exit a business. We need to make sure that they're addressing the various different areas. So I'll just touch on that. So we actually look at giving them a scorecard, and one of the things that's of interest, if you are, as I said, many people that we're talking to are businesses who are looking to sell, but if you're someone that is looking to acquire a business or part thereof, one of the things that this process does really well is because we're looking at it from the interests. We've learnt a lot from from lenders with whom we deal. We've learnt a lot from business brokers and business buyers as to what they're looking for, and we've learnt a lot by benchmarking our specific areas in different industries. So we're able to give people a good understanding of their value from that perspective. And I had a comment yesterday from one of the guys who is in private equity, and he said, if I could have this process, because it's largely a reverse due diligence, we're showing business owners what they need to do to get a business prepared and ready for an effective sale. He said, if I could go in and know that this had been done, I would have purchased a lot more businesses. So one of the things I would encourage you to do if you're in that particular area is if you come across a business that is a bit of a mess, get them to have a chat to us, and we can help them to improve the value of the business and to address some of the areas that you would be looking for in terms of being interested in a purchase of the business. Your challenge there is going to be the timing, because we're going to make it really good. So you've got to make sure you get in before the value gets too high to make sure that you're still getting good value in terms of your purchase. So when we do value the various businesses over a range of factors that I just showed you a moment ago, we give the clients a current value, and then we show them what we believe is a potential for increase in the value of their business. And that's with a number of the factors that we talk about in our 21 steps. When we address those, often a number of them very quickly, we can help increase the value of a business just by looking at their non-financials, such as their governance, the environment. So we're looking at factors like that. So as you can see there, and this, one of the things that we do when we speak to these clients and we set them up on our capitalised program is that they're actually able to track this live in terms of what the current value is and what it should be able to move up to, and we work through that process with them. Okay, let's just, okay. So one of the things that we do need, we also have some business owners that want to hang on, don't ever want to leave the business, but one of the comments that we make to them is one way or another, you're going to exit the business, and maybe in a box, but you know, at some stage you've got to think about it. We try and get people into that headspace of thinking about how to position their business in the best possible way to get the best outcome. So one of the things that we do when often when we're just engaging at our first stage with clients, a business insights report is a reasonably complex process, but we usually get it through in about 4 to 6 weeks, depending on people getting the information to us. But we do offer an opportunity for people to have a look at the value of their business based on a more limited data set, but still pretty accurate in terms of the value that they can look at in their business. So if you are interested, or you have anyone that you think might be interested, if you just use that QR code there, it'll take you through to a free tool that takes about 10 minutes to fill out. We'll prepare a business valuation. We call it the business value gap, and from that perspective, your clients or yourselves can have a bit of a look at what we think the value is, and based on some of the questions you've got, what we think the potential value can be. So it's a really useful tool, particularly if you're partnering with a business that you want to get their heads around, because we've often got to start and give them an idea of where their actual value is in terms of the business. So this is a great opportunity to do it. So that's the last thing I wanted to mention. We did speak about employee share ownership plans yesterday, so we do both of those, and this is our entry into, this is the document on which we do our valuation, which is tax compliant, etc., and where we talk about all of the value of the equity in terms of any shareholders coming into the business. So that's it from me. That's our business insights report, and I've brought you back 2 more minutes. Enjoy your drinks tonight. Thank you.
Thank you, David. Now let's welcome Matt Barrie, CEO of Freelancer.com, for a keynote speech. As a pioneer in online freelancing and crowdsourcing, Matt has revolutionized the gig economy, connecting millions of professionals with businesses worldwide. The stage is yours.
Thank you. My name is Matt Barrie. I'm the Chief Executive of Freelancer Limited. The slide's going to come up. Here we go. What we're doing at Freelancer is quite special. We're building the Amazon of services. So we're broadly in the fields of labour, payments and freight. We have 3 businesses in the one listed headco, and we do about a little bit under $1 billion of turnover a year of cash to the bank accounts. Freelancer, you've probably heard of. We're the largest cloud workforce in the world. There are 80 million people all around the world in that marketplace doing jobs from $10 to $10 million US in any job you can possibly think of, and I'll show you some examples in a second. We also own Escrow.com as the world's largest online escrow company. So this is a payments business like PayPal, but it's for large value and expensive items. So for example, when Facebook rebranded to Meta, we sold the Meta.com and all the trademarks, and we sold Grok.com to Elon a few weeks ago. We do boats, cars, airplanes, jewelry, gemstones, diamonds, M&A of businesses. We sell oil wells. We sell protect commodities down railway lines. We do a whole bunch of crazy things. And LoadShift is actually an Australian-only business. The rest of the other 2 are global, and that's the largest heavy haulage freight company in Australia, or freight marketplace in Australia. We connect with carriers and shippers, mainly in mining, industrial, construction freight, and that's operating on the Freelancer platform and the Freelancer code base, but it's running as a separate business, and it's got pretty much every carrier in the country on it in terms of heavy haulage. I'll show you in a second. So we're basically, at Freelancer, we're your partner in the world of work, and we are solving effectively a $1 trillion problem. 5 billion people on the planet need a better job, and you and I running businesses or in our everyday lives or large enterprises need people to get things done. And what we do is we turn your dreams into reality. So whatever your idea is to start a business or to transform a business, or if you're a large enterprise and you need labour, we provide it, and we turn those dreams into reality. In this case, this guy had a few sketches of a card game. During COVID, he wanted to produce this as a product, and he built it and the whole product design and so forth on Freelancer. We also design products and services of the future. This is an example of an AR, VR sort of headset and what the Apple headset might look like before Apple came out with the product. And what we do at the same time is we transform people's lives. So we provide opportunity and income to people all around the world who use that to feed their families and put food on the table. One of the big waves that's happening right now is in terms of AI, and that's really turbocharged our marketplace. If you're an average copywriter today, you're an exceptional copywriter using Claude and GPT. If you're an average designer before or illustrator using, today you're now an exceptional illustrator using things like Midjourney and Stable Diffusion. That's about to happen in programming. It's about to happen in research and every single white collar job you can think of. So all the freelancers are now turbo powered, and not just are we the widest range at the lowest cost, but we're now the widest range at the lowest cost and the highest skills, which is pretty transformational. The other thing is that the businesses generally have gone through 2 waves of major transformation due to the internet, and they're about to go through a 3rd wave. So those of you that are old enough to remember 1994 and 1995, 94 was the year gigs had email addresses, 95 was the year that your grandmother had an email address. Every business went online, and in order to do that, they needed to build a website. And so websites became a huge category, whether it's a one-man band, a small agency, large agency, or Deloitte building it for you. We aggregate all of those in our platform. And today, that's about 30% of our jobs. When smartphones came out, people needed apps. It wasn't as big as websites because people figured out ultimately how to make websites work on a small device. But that's about 16% of our jobs. And today, AI development is the next big thing. I guarantee you in 2 years from now, every business in the world will have AI answering the phones, taking orders, putting bookings in the calendar and so forth. This is our real marketplace. This is geolocated users, 80 million users around the world. The white dots are where they're located. The pink are where the jobs are being posted. The blue are where jobs are being performed. You can see there as you zoom in, we literally have people everywhere there's electricity in this internet. We are by far, by about triple, the world's largest cloud workforce online. And we're in 33 languages, 38 currencies. We're ranked #1 on Trustpilot out of all the major platforms. It's free to sign up, free to post a job, free to sign up as a freelancer and bid on the job. If you award the job and they accept it, we charge 3% to the client, 10% to the freelancer. There's different ways of getting work done. This is a project. You post your brief and a budget. We've got AI helping you write the brief if you're not quite sure how to fill it out properly. On average, 51 people will bid on the job and you'll get bids in within minutes. The other way of doing it is contests, where you post a prize and people compete for the prize. And it's across all the different types of work. And I'll show you some examples in a second, but it goes from $10 jobs to $10 million jobs. This was an example of a £250 job to UX design. There's 289 people competing there, supplying UX designs. Nowhere in the world at all will you find a liquid labour environment as contests on freelancers. Pretty insane. On average now you get 528 entries, no matter what the job type is. So try it for yourself. You'll be blown away. Get some business cards done or graphics or whatever, or something else, but it's crazy. This is an example of a product design. You can get the products designed and manufactured on Freelancer. Over the weekend, I ripped one of my shirts. It's a very expensive shirt. It now costs $1,600. I thought, bugger paying for a new one. I actually found a designer in Indonesia. I posted the shirt to them. They're making a pattern and they do small-scale manufacturing. They're sending me back for under $50. So it's going to be pretty crazy. And if I go into volume manufacturing, if I break a lot of shirts, I'll get it even cheaper. You can do a home design, architecture. That's an example of a mechanical engineer on the site. There's 80 million profiles. We built a custom version of the marketplace for Deloitte. There's 72,000 US consultants on that for Deloitte. We solve problems for US government. We've been working US government for 10 years. NASA, National Institute of Health, CDC, NIST, you name it. We crowdsource solutions from the crowd we have for solving complex and high-end problems. This is an example of computational fluid dynamics for river sedimentation and river hydraulics. We sped up their model by 60x. It went from 3 days to 1 hour using all the freelancers around the world. This is the biggest thing we've got running right now on the platform. It's $6 million US. It's for gene editing in the central nervous system of humans. It's a very high-end client, being the NIH. It's very high-end value, $6 million US. And the freelancers are high-end. We've awarded half the prize money. It's a 5-year challenge, and the winners are places like Harvard, Columbia, research institutes in Switzerland, etc. Hobbyists, PhDs, people all around the world competing, and that's the genius here. We actually tap into the world's genius to solve problems at the high end. So it's not your traditional logos and websites. We do everything. This is refueling in low gravity environments for NASA. We did that in the last 12 months. We actually have something being announced shortly at South by Southwest. We're helping the Artemis space moon mission. When the astronauts land on the moon, they're going to be in craters where the sky will be obscured by the crater walls, and we're helping them navigate. We won about $18 million worth of work last year from the US government under that program. For generative AI, we do the back-end RLHF safety training and fine-tuning for some of the largest foundational models in the world. For one particular model that you'll know about, I'm not going to mention the name, we supplied 130,000 freelancers last year to target language specializations in certain locations. The big thing this year is language specializations in locations with skill sets. So we're supplying freelancers who have a biology grad degree or a master's degree in history or English literature to a certain level and so forth to do the next stage of foundational model training for many of the large foundational models. And because we uniquely have the people around the world with the skill sets in the location with the dialects to do so. For a large technology company, and many of you probably have their products in your house, but I won't mention the name, we built a global surge capability and white spot capability for laptop printer and server repairs. We built and did the whole turnkey delivery of 1,000 field service engineers across 49 cities, repairing laptops and printers and servers for this particular customer. We provide surge capability. For example, there's a monsoon season in India. Laptops get broken more often because they get wet and so forth. And in places like Australia, we do white space coverage. So in remote regional towns, we know where all the people are that know how to do electronic repairs. And so we help provide a very flexible environment for scaling up, scaling down, and getting to hard to get to areas that are not traditionally served by traditional outsourced providers. That's a bit about the team, but we also have two other businesses. So Escrow is the world's largest online escrow company. There's a lot of payment methods out there. You use Apple Pay, Google Pay, Afterpay, etc. and so forth. But you might be very surprised to know that all those payment methods are dealing with microtransactions. So the average payment size for Apple Pay is $23 US. The average transaction size for Google is $18. Venmo is about $60. Afterpay is a little bit bigger. PayPal $64. Every one of those payment methods is built on top of a debit card or a credit card. So you go into a PayPal, you put your debit card or credit card in, and PayPal works, etc. Same with Apple Pay and so forth. You might be surprised to know that in the US, of all that digital wallet volume, that is only 3% by value of card volume in the US. It's only 3%. All those payment methods you hear about every day is 3% by value of credit cards in the US. And of all the credit cards in the US, if you add that all up, including the digital wallets, that's only 8% by value of transactions in the US. Because you wouldn't buy a car with Apple Pay, you wouldn't buy a house with PayPal. And so, what we do is we play at the high end. So we basically hold the money until the transaction settles. So we do real estate, boats, cars, airplanes, you name it, jet parts. And it's a better solution for paying for things online in an untrustworthy environment. You buy a phone off Craigslist, it arrives, it's broken, not as described, or stolen. How do you get your money back from a credit card? You've got to basically file a chargeback, which can take weeks. If you're a merchant in a high-risk area in eBay, maybe they hold your money for 6 months before they refund you. And we solve that by simply holding the money until the transaction settles. There's an inspection period. That inspection period is typically 7 days, but it could be 3 days, could be what have you. And unconditionally within the inspection period, you can return the goods or services and get your money back. And that's basically how we operate. It's a bit like buying a house in Australia. You lodge the money and then you settle the documentation and then the money clears. But we do it for every asset class under the sun. You name it, we do it. It's a little bit under $1 billion of volume there. It's got a checkout system like PayPal. These are the sort of customers that we deal with. Where we have basically full US licensing in every single state, and there is no other escrow company outside of real estate and the banks that do this in the US. We're licensed in Canada, we're licensed in Australia, and we're expanding the footprint globally, but nobody has the reach. We have a monopoly on online escrow, simply because it takes 5 to 7 years to get a license in each of those jurisdictions, and we have 55 of them. And we provide very specialized services depending on where you are. So if you're selling a car, we do title transfer, we do lien holder payoff. If there's debt in the car, we split up all the payments. We deal with broker commissions. If you're buying fine art, maybe there's brokers on both sides of the transaction. We deal with splits. We do lease to purchase. This is buying and selling of businesses with Acquire. This is buying and selling of oil wells on a marketplace. This is something that's only enabled because of escrow, because you wouldn't be buying an oil well with PayPal or Afterpay or what have you. We sold all these domain names over the years. This has been running since 1999. So, for example, when Twitter got their name Twitter, we sold it through escrow. Recently, we did Meta.com, we've done Uber.com, Snapchat.com, etc. all these guys bought their domain names through us because we're very, very well known in the tech industry for high-value transactions. And we're going to Shopify. So the big thing this year is we're going to Shopify. It's the very first time that Shopify will have large value transactions. So there's 100 different payment methods in Shopify. You can pay with all these different things. But for the very first time, you're about to buy a jet or a house through Shopify, which I think is going to be fairly transformational. So we're already in beta already for that. That's going to be expanding this quarter. But you name it, it's an asset. It's large value or complicated to sell. And we do it. So we're doing things this year like regulatory fuel credits, carbon credits. We're doing agricultural machinery. We're doing heavy machinery, commodities trading. You name it, you can do it through escrow. And then we have a third business in the group, which is load shift. So we're in labour payments freight. So this is heavy haulage. We're the largest marketplace for heavy haulage freight in the country. We've done 800 million kilometres of freight, which is a lot of freight. Today, it's very possibly around 300, 400,000 kilometres, which is about the same distance as the Earth to the Moon. Now, to be clear, we do trucking freight primarily, and we don't do the Linfox stuff. So Linfox is like your point-to-point Woolworths distribution centre to Woolworths distribution centre. We do spot freight. So we move mining, industrial, construction freight. These are all our customers. I'll show you pictures. It's all these trucks that you see on the freeways moving weird stuff to weird locations. So it's not going between Sydney, Melbourne 5 times a day with a Linfox. That's not what we play. That's palletised freight. We don't deal with that. This is more the weird stuff to weird locations, and the bigger it is, the more likely we are to move it, right? So these are all real pictures. Now, the interesting thing about this, and the reason why we've got this business, is we took the Freelancer code base, which is a very advanced, modern marketplace for services, any type of service you can possibly think of. And we bought the biggest bulletin board in the country run by a bunch of truck drivers called LoadShift, and we merged the distribution that was already existing from LoadShift in with the core code base of Freelancer. So every innovation we get with Freelancer gets pushed into this code base and vice versa. And so we effectively created a whole new marketplace, just taking the distribution off this bulletin board that does, God knows, 200, 250 million plus of freight per year through it, and we're starting to monetize it now. So we've monetized about a quarter of the freight that's going through this business, and this year we'll get the next leg up with a bunch of innovations around calling and video calling and so forth, because the truck drivers are on the road and the phones and so forth. But we do everything in terms of the movements. So we, the biggest thing the most interesting thing we moved recently, not the biggest, but the most interesting thing we moved recently is we moved the largest boat by land ever in the Southern Hemisphere, which required a 122 trailer rig. It went through 3 states with permitting. We pulled down 5 power lines. There was a police escort and permitting, and we organised all of that in this business. As an example, these are all real loads of things that we've moved. We do things like for Newmont in Cadia, many of you probably investors in Newmont, we don't do the contracted freight, we do the spot freight. So maybe they've got to move a drill rig, or they need some machinery moved or what have you. That's the sort of stuff we do. We do Bort Longyear, Redpath Mining. We did some stuff for Sydney Metro, and we do the full service. So we do piloting permits, road closures, this, that, the other. We organise all of that. A lot of mining freight, a lot of industrial freight, a lot of construction freight. That's actually not too far away from here. That was Sydney Metro. We brought that in, and there's a fair bit of choreography that happens when you bring that stuff in, where you've got to organise the road closures and this, that, the other, and so forth. And we do a bit of international shipping. Now, this business is only Australia, but we will, probably not this year, but next year, take that global. And probably we'll start in Canada, which is a very similar environment to Australia, long distances, mining, industrial, and so forth, and then we'll open up globally. But again, it's just powered on the Freelancer platform with the existing code base, the enterprise code base, which is the same code base that we built a marketplace for Deloitte to hire consultants internally within Deloitte in the US and to the cloud. And we're like a real-time tendering platform. So if you've got your existing network of suppliers, just load them in. We'll keep the pencils sharpened because they're competing with everyone. So that's what we do. We're in labour payments freight, listed on the ASX. We're actually about to get an American depository receipt, so that's about to go live probably in the next 60 days. We've got 82 million customers around the world. They keep asking how we can buy stock from Freelancer, and we're finally going to let them do that coming up soon. So thank you for your time, and that's about the business, so thank you.
Thank you, Matt. Next up is Cannaponics, a company leading the way in sustainable medical cannabis production. They use renewable energy and advanced farming methods to grow high-quality cannabis products. Let's hear from their CFO, Willie Oi.
All right, just a bit about Cannaponics. We're a GACP grower of medicinal cannabis, and we're also a GMP, EU GMP pharmaceutical manufacturer, so we do both things. We're based in Collie, which is about 2 hours away from Perth, down south. To date, we've raised $25 million in equity and $9 million in debt. What we need to finish our facility is another $5 million in equity, and we're having a $3 million debt facility for working capital to get into production. It's an exciting time for us because 20th March, we're looking to finish our construction, and we expect our first revenues to come in November later this year. In terms of highlights, yeah, we're cutting edge in terms of what we're doing with medicinal cannabis. We own the 165 acres down in Collie. It's the ideal environment for growing cannabis, particularly outdoors. We get the most sun around in the world, number of sunny days. We've got plenty of water down there. We've got relatively low humidity, so it's ideal for outdoor grow. As well, we do have an indoor grow as well, a 1 acre state-of-the-art greenhouse facility. We have a world-leading agri-farmer team, cultivation and also with manufacturing. We're totally ESG, sustainable. We use renewable energy. We have recycled water. We are B2B focused, and that in Australia, you know, look, there are 200 brands of cannabis brands in Australia. We're not competing with those brands. Those brands are our customers. In terms of actual growers, there's probably, in terms of large growers in Australia, there's probably about half a dozen. And there will be sort of some, I mean, one or two might have a facility maybe somewhere else, maybe in Victoria. But most people would be using another GMP facility outside of their farm. We have 5 sales offtake agreements. And we're using cutting-edge cultivation, perpetual harvesting, growing methodology. That means we get daily production. We're the only producer that can produce daily production of medicinal cannabis. We're unmatched quality in terms of our extraction and our manufacturing equipment, and we also have received a $2 million match government funding. In terms of the market, it's just ticked over $1 billion as of 2024, and it's tipped to grow to another 40% in 2025, and further growing. It's the hottest medicinal cannabis market in the world at the moment, Australia. Funny enough, 80% of that medicinal cannabis that we use in Australia is imported. You know, it's imported from Canada, Colombia, Thailand. Yeah, they're low cost, but you have freight issues, you've got a very weak Aussie dollar that's getting hammered, customs duties that you could contend with, inconsistent supply, middlemen, so it is very expensive and it's not serving patients in Australia. We are highly regulated in Australia. In fact, our product, our medicinal cannabis that we do produce in Australia, with what very little there is mainly exported to Europe. So there's a huge demand for Australian-grown cannabis. As I said, we're highly regulated. Our facility down at Collie, we have both indoor and outdoor. We do a 1 acre indoor grow, completely automated. The humidity system, nutrition, fertigation, completely automated. State-of-the-art indoor growing facility. Outdoor, another 10 acre outdoor facility, but we can expand that. We have 165 acres. We have an N-wave extraction dryer, which is a microwave for drying, which dries within a couple of hours. So we can have pretty much from harvest to a finished product within 8 hours, which is unmatched by any producer. In terms of automation, we maximise automation, we minimise labour. That's the only disadvantage we have in Australia, is a high cost of labour. So, for example, we don't use a team of 12 people to do trimming. We have a Mobius trimmer that does it even better and faster. So we're heavy on capital, and therefore we need to invest in renewable energy. And obviously the second puzzle is water, which we have. So the three elements, labour, power and water. In terms of our market value replacement assets, we're currently ticking at $40 million of value there. In terms of production, our DevX 100 machine can produce something like 1 litre of ore per hour. We can do a 24-hour shift. That's $130 per bottle, 1,000 bottles per hour. So, do the maths, that's a lot of money. We're talking, we're also producing about $4.5 million per annum, well, at least $4.5 million per annum from our assets. We own the Club Hotel in Collie. That's mainly for our workers, to accommodate workers, but it also produces income for us. This is our timetable in terms of where we're heading to. It's exciting. We're getting towards production, and then we've got further milestones to complete in terms of being fully net carbon zero and having almost zero cost of power from a variable cost perspective. And then we're moving into cash flows. Very exciting. Here are the offtake agreements. These are brands already. We've got a couple of overseas ones that want to export to Europe. We've got some local distributors. You've probably heard Medigrowth this afternoon. Look, they're all potential clients of ours. When we have initial production, was initially taken up, but when we start producing, we'll have a flurry of people asking to buy from us, essentially. So whatever we can produce, we can sell. In terms of our financials, look, we've only got the club revenue for the first year. It's 5.5 million. But going from there, we'll be looking to get to about 62 million in 2028. It's only a fraction of that market, a small fraction of the billion-dollar market to achieve 62 million. That's replacing imports. And in terms of net profit, look, it's scalable. The biggest thing that we've got is the outdoor grow. An outdoor grow in mass production, that can be a very high gross margin. And I'm an accountant, so I love gross margin. But that's where it is at. I mean, it's highly, highly profitable if you got the metrics right and getting those costs under control, as well as ensuring quality. Okay, I'll just run through the experienced management team. Rod Zakstowski, a Canadian grower. We've got a Harvard professor, a cardiologist, Harvard trained, a pharmacist, myself. Our cap table, so we're currently looking at a post-raising EV of about $54 million. And in terms of use of funds, 34 million we've raised to date. We need another $5 million. Okay, in terms of just the opportunity, we've got Cannaponics as a potential spin-off to produce renewable energy as well, using agri-voltaics, carbon credits, huge potential. And then in terms of all the metrics, we're hitting them. Thank you very much.
Thank you, Willie. Now let's hear from ReadySet Short-Term Rental Fund, a company specializing in short-term rental property investments. Welcome Dr. Bruce Davey, the founder and the managing director.
Thank you very much, Belle. My name is Bruce Davey. My business, ReadySet Apartments, does everything short-term rentals, and today I'd like to talk to you about our short-term rental fund. First of all, what I mean short-term rental, colloquially most people know them as Airbnbs. What we're talking about is residential properties, houses and apartments, but instead of listing them for rent for a year or for 6 months, they're listed for one night or a week or a month. Before I got into this business, I used to run a business that sold software and consulting to insurance companies, and it was quite interesting at any party or social function doing that, when inevitably the question would come up, so what do you do for work? I tell you, my answer would be a one-way ticket for that person to suddenly need to use the facilities or go and get a drink. Moving over to short-term rental though, everyone wants to talk about it. I think a lot of that is the affinity of Australians for residential property investment. Hands up in the room if anyone has or has had at some point in their life a residential property investment. Reasonable numbers, so I think that's some of it. And I think another part that makes people want to talk about this is the experience of residential property investing. A lot of people have got some great capital growth out of investing in residential property in Australia. On the income side though, the average experience is typically not a lot of income once you've paid your expenses on residential property. Typically, maybe you need to reach into your pocket a little bit, or you've got a small amount of income. And so really, you're waiting until you ultimately sell the property, or alternatively draw down on a loan to get access to that growth. And so short-term rental has people essentially ask the question, can I have my cake and eat it? Can I get that capital growth that I like, but can I also have some more income? That's really the question. The investment we offer is a classic real estate investment trust. Essentially, investors' money is pooled in a trust. We use that money to purchase houses and apartments, and then the earnings from those houses and apartments is distributed on a regular basis, and then ultimately capital proceeds upon the sale of any of that property. So, why is this a reasonable thing to do? Really what drives this opportunity is that short-term rental is highly leveraged to expertise. Let me contrast with the regular long-term rental market. Standing here in Sydney CBD, I'm sure there's a one-bedroom apartment, maybe a block that way. There's probably another one-bedroom apartment a block that way. Different buildings, different age, different real estate agents, and yet, on average, the better of those two apartments might be bringing in maybe $30 a week more than the other one. So an absolutely brilliant property manager, there's only a small opportunity for them to do better than the average in that market. It's the complete opposite for short-term rental. What's up on the screen here comes from a data service called AirDNA. What AirDNA do is they track the performance of all of the Airbnb properties around the world. When I was prepping this presentation, I keyed in Melbourne CBD, where I live, and here's the first two rows of the 4,500 properties listed in Melbourne CBD. What really struck me is the revenue of the 4 properties on the first row. The 4 properties on the second row generate about double the revenue, even though they're in the same postcode, and nearly all of these are one-bedroom properties. The only 2-bedroom property is, ironically, on the poor-performing row. So this is both a trap, okay? If someone goes into short-term rentals with their eyes closed and just goes, that apartment will do, and I'll just whack it on Airbnb and wait for the money to come in, well, they're probably going to find themselves on the first row and pretty unhappy after a year. On the other hand, you do a good job of setting up and managing an Airbnb property, and there's quite an opportunity. And the difference really comes from all of the decisions you make that can be optimised around a short-term rental. Where to list it, how to set it up in terms of bedding and other furniture, what price to set, because we don't just say, what's the market price, we set it. We can change it for every single day. All of those decisions, they actually make a difference. My business as a whole, we've been in short-term rental for 8 years. I've got quite a few runs on the board in that. We were about to launch our fund in 2020. 2020, I think you'll probably all remember some things happened in 2020 that made it not the best time to run around and talk to people about property. And so what we ended up doing with our fund is we launched it on small scale proof of concept with inside money in 2021 to get some runs on the board, and then this year we're looking to scale it up significantly. On the small scale, we have actually already got some runs on the board in terms of beating our income benchmarks, which are, by the way, our income benchmarks are the income of long-term rentals in the same location. We've got an experienced team, experienced in business, experienced in the accommodation industry, and also experienced in funds management. That's all I really want to say today. By the way, I'll point out we've got both a wholesale fund and a retail feeder fund, hence we can accommodate quite a wide range of investment sizes. If you have an interest in residential property investing, particularly if you have an interest in either short-term rentals or getting a higher yield out of residential property investing, come and find me after the session and let's have a chat. Or alternatively, scan this QR code, which will give you some links and contact details so you can get in contact at a later date. Thank you very much, everyone, for your time.
Thank you, Dr. Bruce. Now, today we have our last panel discussion about family office investment trends. This session will cover how family offices are diversifying investments and adapting to market changes. Please welcome our panelists. Phoebe Teo, co-founder at The Art of Capital. Kevin Shen, investment director at Skyfield Capital. Kenneth Shaw, partner at Shaw Investment. Dr. Bruce Davey, managing director at ReadySet Short-Term Rental Fund. And Edward Carroll, head of global markets and corporate finance, MHC Digital Group.
Good afternoon, everyone. It's my honor to moderate the family office panel session today, and we will be discussing how far it has evolved over the years. So we will start off with introducing ourselves, and I will start by myself. Okay. So my name is Phoebe, and I run a fund called The Art of Capital, and we primarily focus on cross-border transactions between the US, Australia, and China. Kevin, your turn.
Hi, I'm Kevin Shen. I'm an investment director at Skyfield. We're a single-family office. The family has interest in real estate in Australia and Asia, and I look after the non-direct real estate investments. So that includes listed investments, and on the unlisted side, we have some venture investments and private credit.
This thing on? All right. Ken Shaw. I'm a recovering CEO and entrepreneur, and now running a third-generation family office.
Hi, I'm Bruce Davey. I run, again, a fairly simple family office. The dominant thing we do is algorithmic trading of equities and derivatives, and you all heard about the property side of our business just before.
Hi, everyone. My name's Ed Carroll. I run a firm called MHC Digital Group. We're an investment bank for digital assets. We've got a markets platform which facilitates buying and selling and custody of crypto and crypto derivatives, and we also have a funds platform as well.
Today we're going to cover a broad range of questions based on different expertise here today. So Kevin, I will start with you. Given your experience at Skyfield Capital, how have you seen family offices evolve over the years? Are they becoming more like institutional investor, and what is actually driving this trend?
Yeah, look, I can probably give my view as a professional. I'm not part of the family. So I think two things that are driving family office investment trends are the amount of capital they have and the age of the family office in terms of generations. So first generation family office, so the business, or they're still operating in the business, tend to be pretty hands-on in investment decisions. They want to make investments that they feel not only provide returns but are impactful, and oftentimes in the area that they have an expertise in. As you get into the later generations, you start to deploy more capital to get your return. So that might be in forms of property or credit, or the children might have the finance background and might want to start a fund of some sort. And then the later generations, it becomes much more institutionalized. You look at portfolio allocation, correlation of investments, etc. And I think the other big theme I've seen is that access to good alternative investments and top managers is no longer really an issue for family office. I would say 10 or 15 years ago, to really get to invest in the very best managers globally, you needed to have 10, 20, 30 million minimum check sizes, be an endowment or insurance fund. But I think nowadays the GPs themselves are targeting family office capital. So a lot of them are talking to us directly. They're making investments available through wealth platforms. So some investments that were exclusive for institutional investors are now available to family offices from as small as $50,000 to $100,000 check sizes, but they also have bespoke products like separate managed accounts that start from $100 million. So in that way, family offices do have access to not only alternative investments, but some of the best alternative investment managers globally.
So based on your current investment theory, what are the top 3 sectors do you think that's highly favorable by family office at the moment?
I think every family office is different. It's cliche that once you've met a family office, you've met one family office. And I think the sophistication and also what the principals want to do. So generally there's a bucket that's the more safe, high-yielding assets. So that could be whether in the form of property or private credit. And private credit's had a bit of a golden age, if you will, getting very good returns for certain credits at pretty good risk. And then there's the other bucket where it's impactful, or they want to make multiples of returns. And those could be in venture, in private credit, whether private equity, whether through investment managers or directly. And I actually think the listed space is fairly well suited for family offices. If you think about the goats of investing, Buffett and Munger, what they've taught us about being patient, long-term investors, be aligned with the management and not be greedy when others are fearful. Lots of institution fund managers cannot do that by the way they're set up, and they have to mark to market monthly, and they've got investors to answer to. Whereas family offices are by nature long-term patient investors, and we can be quite flexible in terms of leaning into investment sectors that are out of favour but are still fundamentally sound. So I'll say those are the interesting areas.
In that case, how do you actually balance listed equities as opposed to private investment? Because there is a range of portfolios that you need to manage as well.
Good question. It's about focus. So, a lot of my time is spent on the listed side. There's a huge universe of companies to invest in, but we don't need to invest in all of those companies, and we don't need to look at all of those companies. So I focus on the companies that I know and the sectors that I'm interested in. And then through the private investments, again, it's areas that I know. I've worked in private credit myself, so in terms of private credit deals, I can get a pretty good read on deals that are already structured. And in other instances, you can just go through managers that you believe. So you're sort of leveraging your capital in terms of picking who you think the best managers are and letting them select the deals for you.
Okay. Well, Kent, you have been both sides of the table and raising capital as a founder and now working with Scale Out specifically. So how are family offices leveraging their operational expertise to add value to their direct investment at the moment?
I think I'm the only operator / sort of as I said, recovering CEO up here. So I might address my comments sort of to that audience. By show of hands, who in the room's here to try and get money? Who's an entrepreneur or an operator looking to raise? Lots of you. Okay. Who in the room is a professional investor, actually writes checks or works at a, okay? Probably don't want to self-identify, do you? You get mobbed. Who in the room's an advisor helping one of the first two buckets? Okay, cool. Well, I might address the 50% of you that are entrepreneurs trying to raise money. I think Kevin said something important, well, a bunch of things that are important. Here's the issue with family offices, and that's what Kevin said. If you meet 50 VCs, right, there's, like literally, you meet 50 venture capitalists, there's maybe 1.5 business models between them, right? They're all 10-year closed-end funds. They want, they're writing checks between X and Y for companies of this size to that size. They're going to have 15 to 20 investments in a portfolio, blah, blah, blah. You meet 50 family offices, there's like 47 business models between them. That sucks as an entrepreneur, right? Trying to understand all of that. I'm a software engineer originally, and in programming languages, we have a shared syntax, right? And it has the benefit that everybody there therefore has a shared mental model of how to write code. There's no such thing with family offices. And so I raised a bunch of money and would have had 100 term sheets plus. The very worst term sheets I ever got were from family offices. And I actually consummated a deal with the family office, one family office, and they were, oh my God, it was like having Dracula on my board. It was just a nightmare. So those are sort of the negative comments. Then I'll fast forward to where I am now, and I guess I'd like to think I'd be different to that. Kevin also said something really important, which is he likes to invest in stuff he knows. You worked in private credit. And so, yeah, senior secured debt, great place to put money if you're allocating. But, the best writers, they write what they know, Jeffrey Archer's first novel was a vignette from his life. The best investors invest in what they know. So I think all of that is to say, if you're trying to raise money from family offices, you really got to do your research, get inside their heads, understand who you're dealing with, what motivates them. Are they the first generation entrepreneur who made the money? And by the way, they're the ones that you want to deal with, right? They're the ones, because that big negative I gave of the family office, all of them sort of being bespoke, is also their great strength. I advised on a deal with a family office where about 20 minutes into the pitch, the principal basically told the entrepreneur to stop talking and agreed to put in 1.5 million. The entrepreneur was asking for 250,000, right? So that's awesome when that happens, but that almost never happens. So with that huge preamble, I'll say when I'm looking at investments, I invest in what I know, right, which is B2B software. My father, he invests in what he knows, which is real estate. So those are the two asset classes that we play in. And that does, that works well for us. But I wanted to address the half of you who are here to get money.
But based on the family office portfolio structure, sometimes they do have quite a diversified portfolio here. So what would you advise family offices when they wanted to invest into a scale up? And what are the key factors do you think they should assess?
Yeah, so broadly the question is FOs looking to make direct investments. I'll stick to tech because it's what I know. And look, I advise sort of other families informally, sometimes formally. I'd say stay away from direct tech investments. Leave it to the pros, right? I think that's generally a good rule of thumb. Because tech investing is hard, right? There's a reason why, there are the Sequoias of the world. It's hard, so the elite go and work at the best firms. And I would say it is like quintuply true right now. We're going through the biggest tech disruption probably in the history of modern technology, right? AI. AI is by far the most impactful tech we've seen in like the last 100 years. I'm going back to airplanes and cars. 120 years. Let's go back to 1900. And it's being adopted far faster than any other technology ever, right? Internet took 25 years to go from ARPANET to mass use. PC took from like 1981 to 1994 to go to mass use. AI got to 1 billion global users in 3 months, right? It is nuts. So if you think about what the internet and PCs did to investing, venture capital investing, some of you remember the dot-com bust. I graduated high school in 2000, and I had, believe it or not, I had a whole bunch of shares and got wiped out. Good lesson. But the internet bubble buggered up the entire investment world, right? Because it was too disruptive, too fast. Well, AI is much more disruptive and much faster. So the smart money is hanging back. The smart money is waiting, right? Wait for the dust to settle. Yeah, so nutting all that out. My advice to family offices would be stay away from direct tech investments right now. In general, allocate through the pros, through managers, or hire pros, like say Kevin here. And that's, I would say that's a good catechism generally, but super true at this moment in time, this AI moment we're having.
You mentioned about AI. How do you think that's impacting the family offices in terms of investment landscape?
It's just creating so much noise, right? So investors, the minute you sort of present yourself as an investor, you get mobbed, right? I get, 1, 2, 3 emails or LinkedIns per day from people wanting to pitch me. And so that's already hard enough. And we're a small family office, right? With AI, the amount of noise and crap in the market has just, like, it's 10x'd, right? I'm somewhat of an expert on B2B software, and I'm confused. I've been doing this 25 years, and I mean, just for some context, like I built a B2B software company that was a Gartner Magic Quadrant leader. I had 200 employees, raised about 75 million Aussie and sold it. So I know something about this, and yet I'm absolutely stumped by this moment we're having. So yeah, my answer is I don't have an answer.
Okay. Well, now we're moving into a little bit more of the real estate focused topic here. In the recent years, alternative asset class have become increasingly popular due to market volatility. And it's been quite highly competitive. So we talk about the private credit funds and we talk about the real estate funds. And Bruce, we would like to talk a little bit more about the alternative investment here. For short-term real estate rental, they are becoming increasingly attractive to family office. And what do you think is driving this interest?
I think alternative investments of a lot of different kinds are quite a good match for family offices. I think the appeal of alternative investments to anybody kind of sits there in the name, alternative. They're an alternative to something, and for them to ever get any investors, they've got to be a better alternative to somebody for that something. And usually that's the thing they're better on is return, but usually they have some catches, and I think family offices are a good match for those catches. The size, a lot of the alternative investment markets are niche, which means on the whole, they're on the small side for big institutions, but the complexity takes them out of the realm of smaller individual investors. So I think on size, they're a good match for family offices. They tend to be unlisted and therefore illiquid. And I think that the patience that Ken was referring to earlier of family offices is important there, because some alternative investments, look, some of them, but there's certainly private credit funds where you can get in and out pretty quickly, but there are other alternative investments where you're in that investment for 10, 15, 20 years, and I think family offices have the patience for that.
There has been quite a high yield for short-term rental funds, and I think that what is the operating challenges from your perspective in this fund?
Short-term rentals, the operating challenge is basically property management on steroids. Instead of needing to let a property, once every few years, while you let it, once a week, instead of getting maintenance done a few times a year, the customer base are the kind of pretty fussy customer base, and so properties are getting maintenance on a regular basis and certainly cleaned on a regular basis. That's really the operational challenge, just a lot more.
So looking forward, how do you see the short-term rental market evolving in the next few years?
A few different aspects of this. I see it has been professionalising over the last 5 years, and that'll continue. When it started, it was all someone with a spare bedroom or someone with one place putting their own place there, but the operational challenges make that, it just doesn't make sense. It needs an economy of scale, and so it has been gradually professionalising, and it'd be about 50-50 at the present moment, and that's going to continue. The regulatory regime around it has gone some of the way to becoming absolutely clear, but there's another few rounds in different jurisdictions to work out whether it's allowed and in what manner that it's allowed. I think they're the two big themes in the short term.
Okay, thank you. Edward, now we're moving into digital asset topic. So we get to see from different sides of the table, understanding how the family offices look into digital asset as well. So Edward, MHE is bridging traditional and digital assets. Are family offices actively incorporating digital asset into their portfolio?
Sorry, was the question how they're integrating it?
How are they integrating into it? Because I understand that digital asset has been quite a challenging thing.
Yeah, I think the issue with digital assets for family offices and kind of the more sophisticated ends of the spectrum, all the way up to institutions, has been that there's been a kind of lack of clarity on the regulation, which hasn't really given the green light until recently for them to start to allocate. What we've seen the last sort of 12, 18 months is significant progress on that front, both from the type of products, being the kind of ETFs that were approved in the US for Bitcoin and others 12 months ago, into kind of a lot more regulatory clarity the last sort of 3-4 months, and we expect that to play out a lot in the next 12 months. And what that really means is that there is a bit more clarity around this, how credible the asset class is, which gives more reason for people to allocate. Now, in terms of what we expect and what we sort of advocate for family offices, I mean, if we start with just kind of like a Bitcoin allocation, we're very, very firmly in favour of a Bitcoin allocation in any well-constructed portfolio. We don't think anything more than sort of like somewhere between 1% and 5%, but I think the opportunity to use what is a very liquid asset, being Bitcoin, with an increasingly sophisticated product set around that to manage the volatility, to manage the potential capital appreciation you might see in it. We firmly believe the thematic behind that specifically is a logical starting point for allocation. And I mean, our firm has specifically designed itself to facilitate that by way of allowing, sophisticated investors, wholesale investors, to buy, sell, custody crypto and then crypto derivatives around that to kind of get that comfort. But I think that digital assets are very kind of broad-based kind of, it's a poorly defined asset class because people don't really know if you're talking about Bitcoin or meme coins. When I advocate for an allocation, I think the starting point should definitely be probably a focus on something like a Bitcoin. And as you get more sophisticated, you can look to allocate further down the spectrum. But I mean, kind of like to Ken's point, there comes a point where the level of complexity requires that you kind of do engage professionals who actually understand the technology, to understand the opportunity, to really help with the advice and the way you manage that allocation. And I think that it's very important to consider that when you're making those kind of investment decisions, because there is a lot of risk out there as well. And I think there's also a lack of trust. I guess just last point on that though as well is that this regulatory point I'm making is very important because really fundamentally what it comes down to is that when there is an increase in the regulatory oversight of these assets, it does not just give a green light for people to look to allocate to the asset, but it also requires that they find someone they trust to actually manage that allocation, whether that be, to buy, sell and custody it, or to allocate for an investment purpose. And I think what we're trying to service really is that more sophisticated allocation and to be the trusted partner for that, because we really think there's an opportunity in the market to deliver that in Australia and throughout Asia.
Yeah, just want to jump on that. So Ed and I were talking about in the lobby that like the irony of the digital assets, the bitcoins, right, is that like that was built. People who like Bitcoin have like an allergic reaction to regulation, right? The irony is, of course, that without regulation, big money won't flow into digital asset classes. So we need regulation. But I want to just make a comment about family offices. For those of you who are trying to wrap your heads around what is an FO and how do you approach them or work with them. FOs can buy Bitcoin, right? Because family offices, 50 family offices, 47 business models. There's far more flexibility. Think about, Aware Super or the big, the huge Australian super funds and instos, who are some of the biggest institutional investors in the world. They ain't going to write checks into Bitcoin and Ethereum and other digital classes until the regulation's there. The point I want to make, though, is family offices they're a class unto themselves. We can operate like retail investors. We can buy Bitcoin. We can go into alternative assets like short-term rental funds. We can go into private credit. We can do senior secured direct credit deals ourselves. That's actually a really lucrative, sort of model to put money into. But the point I'm making is if you're trying to wrap your head around FOs, it's really about the human being who created that wealth. And that person could be dead, by the way. But it is a man-on-man sport when you're dealing with family offices. Person on person.
Yeah, just want to echo that point. I think, everyone talks about, I think there's a lot of talk about data-driven, returns, etc. I think family office, some of them are more, I guess, taste-driven rather than data-driven. So if you ask...
Cowboys.
Well, if you ask certain family offices what your required return is, you might not get an answer because it's not an institution where they need 5% and 10% of this bucket to pay for certain things. There's a different motive to just pure financial returns to some of the family offices. So this is why, it's a lot relationship driven in terms of the deal you look at, what interests the family, and, on the listed side where the market's huge, you only need to invest in a number of companies. You don't need to invest in all of them.
I'd also just add that there is a kind of, we separately run a traditional alternative asset management platform as well as a sister company to MHC Digital Group, so we have a lot of experience at the family offices as well. And I guess one of my observations, and you guys will have a better view of this being family office guys yourselves, but some family offices are investors and others are allocators, and some are some hybrid of that. And generally, you're seeing the same thing at the institutional end of the spectrum with the superannuation funds doing a lot more direct stuff. But at the family office level as well, often what you find is that some of them will directly invest in things, some of them will allocate to a manager to manage that investment for them, and some of them will have co-investment rights with the manager.
Yep.
So what you find is that you want to know what they're doing, what their interests are, where they're going to directly allocate. But you also want to know who they're allocating through, because if you can speak to who they're allocating through, you may actually amplify the amount of capital you can get out of any specific fundraising objective, because you go to the manager who, no doubt, a lot of the family offices may have actual co-investment rights with, and then you can probably raise more capital through that.
That's like secret black art knowledge, right? Finding out who the Meyer family allocates to and co-invests with, never going to happen. I don't know. I reckon that's hard.
Yeah, I think generations, right? If you this to the entrepreneurs who want to raise capital, how new a family office is and how new maybe the chief investment office is also determines if they're more likely to talk to you. If family office has been in operation for a while or chief investment officers has been in that space for a while, they normally know who to talk to or what type of investment they are. They get a lot of inbound inquiries and can't return all of them, so they're sort of active in looking at, I want this manager or I want this investment. But if it's something new to that seat, they're more receptive to talking to everyone or a lot more people in the market to kind of calibrate where they want to invest in, and then once in that seed for a few years and they've made a bunch of allocations, it's a lot harder to try and to get them to look at new stuff.
But like the longer a family office exists and the more successful it is, the more it looks like a traditional fund, right? So let's stick with Aussie entrepreneurs. Greg Clark, right? Queensland boy, I'm a Queenslander, was CEO of Bluecoat, which you probably haven't heard of, but then CEO of Symantec, right? Makes Norton. Now he is an investor, but his family office is better known as Crosspoint Capital, a fully structured private equity firm with a raft of analysts and investment directors. Let's go closer to home. The Gateway Building, 2 blocks over, my old firm, Potential Capital. That's essentially a family office. It's a multi-family office of Tim Reed and Andrew Gray, right? $1 billion fund now, but lion's share of the seed capital to FOs. You know, there's like 30 people who work at Potentia, right? So the more successful, at least in tech investing, the more successful FOs are, and the less sort of control the founders like the Jerry Harveys or the Fatty Palmers, you know, have over check writing, the more like an institution it becomes. And if it walks like a duck, quacks like a duck, you know, it's a duck. So like the Meyer family, you may as well think of them as a PE fund. Yeah. My 2 cents.
Well, I believe that the audience here would love to know what are the things that you guys could advise, you know, as a portfolio companies. What are the things that you can approach family offices when you seek for investment? In a few words, what would be your advice to your audience group if they are seeking investment as a portfolio company?
I'll jump in. A warm introduction from a trusted person is the only way to talk to most family offices, right? VCs, they're structured. They have a funnel. You can call, an associate will have a coffee with you. Not my experience in FO land. Yeah, warm introduction, so valuable.
Kevin?
Yeah, I'd echo that. And the reason, depends on the family office. If there's something like a Potentia, it's not really a family office, it's more like a fund. So,
no, it started as one and then is now absolutely a fund.
Sure.
Yeah.
So, you know, a lot of family offices are not set up to do deep due diligence on multiple deals, to have introduction coffees all the time, whereas funds are set up that way. So you know, we have to be very selective in where we focus our time and attention. You know, all of the deals we've done is through warm introductions or a trusted source, and it acts as a filter for us because, you know, we need to, there's a lot of things we need to cover, right, unfortunately.
Well, Bruce, what would be your advice based on your personal experience running the ReadySet short-term rental fund?
I think the other thing I'd say is family offices have kind of verticals or areas that they're interested in. So warm introduction, or put yourself in front of people from a family office that have an interest in your area and work out who they are first.
And?
In my experience, it's try your best to do their job for them. Provide like the most well-formed investment paper for them. Make sure that all the T's are being crossed and I's are being, you know, you want to make sure that everything's done, and basically provide a well-structured, sophisticated investment paper, have the thesis sorted, understand the risks and sell the story. But obviously, like, not every family office wants to allocate to everything. So you have to be very conscious of what they like and then tell them what they want to hear.
And shameless plug for Steve and his businesses, you know, exhibit an event like this because we come to these. And if you can't afford that, get on Capital HQ, build a sick profile on there so we can find you, right? Yeah. And if you don't know Steve, you know, go introduce yourself to him. He runs this event, so.
Yeah, I'd echo that. And in terms of, you know, I talked about access is no longer an issue, and also social media has made access much easier. So if you're a subject expert and you have a presence on X, or you're on a very well-known podcast, then people reach out to you. You know, I've certainly reached out to fund managers in the US based off an interview I've heard or something that they've tweeted. So that's a good way to you know, leverage your exposure through social media platforms.
Okay, thank you everyone. That has been a very insightful night.
Thank you, Phoebe.
Thank you.
Thank you.
Thank you very much, Phoebe. Thank you very much, everyone. Now, as the person that's standing between everyone and drinks, I would just like to say thank you very much for coming along to Emergence 2025. The last 2 days have been incredible. The key thing I would just say with this, absolutely everything we do is about empowering innovation, capital, and ambition. Everything we think about is how we can actually build ecosystems and bring people together. How we grow is by you guys bringing in your networks, into this ecosystem, because the reality is this is one of the coolest ecosystems to be a part of. Literally, no matter what's going on in the world, it's always going to be a positive thought bubble inside this ecosystem. So, it's something that we're proud of, that we're able to create, and there's some great people involved. So, during the drinks, make sure you do a lot. That's too hard. Go and enjoy your drinks.